So very good morning everyone. So in the previous class we started with the concept corporate valuation. So in the corporate valuation chapter we completed the first set called as economic value added. And now in this session we are going to start today with the balance portion, being the main area called as FCFF and miscellaneous. There are totally 10 to 11 problems that we need to do. So once we do those 10 to 11 problems, we are done with it. And lastly, if I forget, remind me, convexity we completed yesterday. There is another model in convexity, I forgot to tell yesterday. So that model is also there. When price differences are given, how to do that? There is a formula approach for that I forgot to tell you. So remind me if I forget. I will make it. But if I forget, please remind me after this chapter. Clear? So now we are having, please listen sir. Now we are having two types of learning objectives here. One is a corporate valuation, another one is a share valuation. Means security valuation chapter in your study material will be having a big amount of problems where it will be broken into two parts. One is a bonds, another one is a shares. So once corporate valuation is completed, we will be going into the share valuation. There are also some good number of problems and some important questions are there. We will try to solve those. Once completed, as I already said, today we are going to start off with the options and futures. Okay. So which is most important from the exams point of view for this attempt especially. For 2023 May exams, definitely good amount of problems hopefully will come from options and futures. Clear? Once covered, along with options and futures, I will also cover the concept called as currency options and currency futures. Those also will be covered. Take any study material question, I will answer those. So the point is, material will be ready. Just it came to you. No, they didn't give. Just wait for another 5 minutes. I came there and only came here. It is almost ready. It will come. So I have given for today and tomorrow's session all the questions material I have given, including the yesterday's one bond valuation. Okay. So the material that we are giving now will be containing the questions on bond valuation, currency options, the futures, the forex, and currency options. Clear? So that will be there. Another one will be coming. That will be on the remaining portion that I am going to deal with. Clear? So therefore, yesterday's bond valuation chapter also I am giving you the material in this regard. Clear? So anyway, let us start with this particular concept, corporate valuation. In corporate valuation, we have completed economic value added. Economic value added is a calculation of how much operational value addition has come in the company. When the operational value addition is concerned about, we should consider only operating capital employed. That's a new point we learned in EVA. Yesterday we have done one problem. Entire 100% class, they didn't do that. So, but that one unique question that we need to do, EVA must and should do question is question number 15 or 16 something. Must and should do question for examination, because if you do that one question enough, EVA need not do all the other EVA questions at all, because it blends all the concepts of EVA inside it. Okay. So whenever I call EVA, what is the formula? EBIT into 1 minus T minus KO into capital employed. EBIT means what? Operating profit. EBIT into 1 minus T means operating profit after tax. Means that operating profit is now belonging to how many people? 2 people. Number 1 will be debt. Number 2 will be equity. So the total capital employed will be taken into total cost of capital. So when you do that, you will get the EVA value. Actually, if you see the formula, it will give impression as if it is a EVA to the entire company. But in reality, who will share the entire positive or negative EVA? Shareholders will share that negative or positive EVA. That's the next point we consider. After that we went into the concept. In that only WACC calculation we have done. When you are doing the WACC calculation, remember whenever underwriting commissions are there, underwriting commission will be write off again as a profits only. Okay, means reserves and surplus will be used to write off the underwriting commission. And next issue after that, investments in the other companies or plant which is not yet coming into operations, capital work in progress, all these are very, very important adjustments, because those are not involved in the operations of that particular company. We should not consider them. That's another thumb rule point we understood in the rest of this class. Everyone in the class, did you find that problem as a new thing or not? So every point is new in that question. You do that one question, EVL remaining questions you need not do. We have done one problem on reverse calculation. We have done one problem on concept. We have done one problem on capital employed, operating capital employed, etc. Nothing more than that, not at all required. Take any kind of question, it will be looking like that only. Clear? So therefore, this is the EVA as an accomplishment. Now listen, there is another question on EVA. Is this question what I am showing now is there in the study material? This one. Please see on the screen once. Which question? 12th. Okay, open that. This is also on value addition only. Comprehensive question on EVA. If you want to test your knowledge comprehensively, you can test through this question. Study material, security valuation chapter, question number 12. Sorry, corporate valuation, question number 12. Everyone please see there. If you have study mat, you can see there. If you don't have, at least see here. Okay. See here once. The following information is given for 3 companies that are identical except for their capital structure. Total invested capital 1 lakh, 1 lakh and 1 lakh. Debt to assets ratio 0.8, 0.5 and 0.2. Shares outstanding 6,100, 8,300, 10,000. Pre-tax cost of debt, cost of equity, operating income, net income. Tax is uniform 35% in all the cases. Compute the weighted average cost of capital for each company. Compute EVA. Based on EVA, which company would be considered for best investment? Give reasons. If industry PE ratio is 11 times, estimate the price of the share of each company. Calculate the estimated market cap for each of the companies. This is a question that is being asked. Please read the question first. We'll start doing the solution. First, answer my question. To calculate EBIT, what is the source first required for us? EBIT. First, see the question and tell. EBIT given, not given? Given or not given? How much is EBIT? 25,000 in all the cases. Okay. Next, tax rate given, not given? So, can we calculate directly no PAT or not? No PAT means what? Net operating profit after tax. Okay. So, can we calculate no PAT? So, 25,000 into 0.65. 16,000? 16,250. That will be same in all the 3 cases or not, everyone? That's 1 point over. Okay. First, he is asking us to calculate WACC calculation. First, tell me. He has given pre-tax KD, post-tax KD. Can we calculate post-tax KD? Please keep the heading. Step number 1, calculation of weighted average cost of capital. I will also do along with you. Help me with the numbers. Calculation of weighted average cost of capital. Do for all the 3 companies. 3 companies are given. Okay. Let us do first one. What is the EBIT into 1 minus T in all the cases? 16,250. Sorry. Weighted average cost of capital. I'm very sorry. So first let us calculate the weighted average cost of capital. Tell me what is the post-tax KD? Calculate and tell directly. 10.4, 8.45. Next. KE already given or not? How much? 26, 22, 20. Tell me what is the debt is to equity. First situation 0.8. 0.8. Simply, if you want notation separately, okay, I can tell like this. Debt how much? 0.80. Equity 0.2. What? Assets means, listen carefully. Listen, sir. Whenever I tell debt to assets, whenever you want to make investment, whenever you want to make what's a investment, whenever you want to make an investment of 100 rupees, investment will be serviced through two instruments. Number one, equity. Number two, debt. 100 rupee asset has to come into my company means from theft I can't bring. I can bring only through two sources. Number one, equity. Number two, debt. 100 rupee asset la 80 rupees debt means 20 rupees equity. Did you understand what I said? Debt is to equity if you give then you can take in the way you have understood. Equity 1 rupee, debt 0.8, total 1.8. Read the question properly. Debt to assets. Basics you are missing. 100, sir, in a company, I have to get an asset. What are the two sources? Sir, you can't get sources in assets company ki. Okay. There are only two sources of financing. Preference leave off. Number one, equity. Number two, debt. These are the only two sources of financing. Debt to assets means 100 rupees assets are there. 80 rupees of the asset is financed using debt. Means how much using equity? 20. Do that. Fundamental mistakes you should never do. Next, 0.5 and 0.5. Next one, 0.2 and 0.8. So please tell me WDKD plus WEKE, which is called as WAC. 13.52, 15.23, 17.95. First step completed. Hope everyone have done along with me. Everyone done. Next, step 1 over. Come to step number 2. Now, what is the second concept he is asking us? Pick the first one. Second one, compute the EVA of the company. Can we calculate EVA? Yes. So particulars. Okay. Tell me. First one, what is the EBIT into 1 minus T? 16,215, all the three cases. Sir, everyone do along with me. 16,250. Don't copy our answers. Why you are seeing the screen? This is not a regular class. You do. You check the answers. That's all. Tell me, EBIT into 1 minus T. Interested people can tell the answers. I will write. Minus capital employed, KO into capital employed, KO into capital employed. Tell me, KO into capital employed. How much is a capital employed in the first case? 1 lakh. 1 lakh into KO. 13,520. Next case, 15,230. Next case, 17,950. EVA, how much? 2730. Positive EVA, right? Next, 1020. Positive EVA. Negative EVA in the last case. How much negative EVA? 1700 negative EVA. Shall we go to the next point, everyone? Now we completed how many steps? 2 steps. Step 1 and step 2. See here. Question see there. First WAC calculation completed, EVA calculation completed. What is the third question he is asking? Now directly do here ranking. Okay. On the basis of ranking, which will be given the first rank? Next, in the same sequence you will give. Okay, ba? Next. After that, if the industry PE ratio is 11 times, estimate the price of the share. So tell me, I have EPS, I have PE ratio. can I calculate MPS? What is the formula? EPS into PE ratio is the formula. Okay, now, so let's do that. Step number 4, calculation of MPS. Particulars, orange, grape and apple. Do one by one. Please, sir, everyone, support me with answers. Tell me now. First, what we need to do? EPS. So tell me, when we are given with EBIT, okay, and we are also given with the amount of interest, can we calculate the EAT? Answer. There is a mistake in this question. Inconsistency is there. Actually, net income should be taken as EAT. Yes or no? But if you do EBIT minus interest minus tax, the EAT what you get and the EAT given here will not match. Therefore, 2 answers institute also will give there. I repeat once again. Please listen once again. Please. Hello. Take calculator once. How much is the EBIT? Answer, sir. From that, what we need to deduct? Interest. How much is the interest in the first case? 16% into 80,000. How much? Minus. Okay. You will get EBT now. From that, how much percent tax? 35%. Tell me what is the 7,930. But the answer is 8,970, which will not match. There is a fundamental mistake in the question. Okay. So therefore, you can do this in 2 ways. Directly taking the net income as EAT given in the question and you can do. Or you can do this way. But I suggest always go through EBIT model only. Clear or not, everyone? That's only called as a net income. Okay. Let us do that, please. EBIT. Do that. EBIT. How much? First case. In all the cases, it is how much? 25,000. Next, minus minus interest. How much is the interest? 12,800. Next. One second. Everyone doing please do along with me. Answer. 6,500. Last case. 3,000. 3,000. Okay. EBT. How much? 12,200. 18,500. 22,000. Minus tax. Minus a tax. Please tell me the number. 4,270. 11,700. Tell me what is that? 6,475. Tell me what is the EAT? 7,930. 25. How much? 14,300. So this is the EAT or EBIT. Divided by number of shares. If you do, what you will get? EPS. Directly tell me EPS. Don't do that. EPS how much? 1.3. Next. 45. Next. 1.4. EBT. $18,500. Correct? Right, don't confuse me right now. Sir, I don't have calculator. I'm not doing. I'm believing in your answers. Tell me, sir, EPS. One second. EPS in the first case is how much? 1.3. EPS in the second case 1.45, and EPS in the third case 1. Sir, EPS we have. PE ratio we have. How much is a PE? 11 times. can we get the MPS or not? Tell me first case. 14.3. Last one 7. Ranking on this basis you give me now. First rank will go to second company, and this is the answer, sir. Okay, everyone. Sir, first, how many problems? I promise you 4 EVA problems in the class. Tell me how many problems we have done till now? 4. Tell me what are the 4 types? The answers are 4 types. Basic one problem we have done. Reverse calculation one problem we have done. Worst case scenario we have done one problem. Comprehensive problem also we have done. Okay, these are all the various questions that we need to answer on EVA. One another concept is still there, that is called as market value addition. Okay, market value addition is a simple concept which I mentioned in the securities valuation chapter. 2 questions also I kept. We will do that. But even before that, listen, EVA yet another model is there. New models which are coming in the latest trend. 2022 one attempt it was asked in May or November. Last attempt I didn't remember exactly. That is assets side valuing the EVA. What side? Assets side. How can it come? How the questions can be asked? Let us also see that once. You need not even put the pen on paper. Just in calculator you can do. Question number 13. Ditto question came in examination. This I have taken from supplementary study paper. Last attempt question came in exam. Okay, please check the question. In calculator you do the workings and tell me the answer. One second. Let us read the question. Herbal Gan has average earnings of 12 lakhs after tax. Company strength is in its patented beauty cream for removing the pimples. The patent has 8 years to run and the company has been offered rupees 40 lakhs for the patent rights. Company assets include rupees 20 lakh of working capital, 80 lakhs of property, plant, equipment. The patent is not shown in the company books. Suppose the company's cost of capital is 15. What is it? EVA. This is a question that is being asked. Same question, ditto question came in examination with the change in some numbers and names. Beauty cream also same. He asked the same point. Numbers they changed in exam. Latest exam I am talking about, not old. But I have taken from 2016 supplementary study paper. Study material also it is there. Fantastic. Then see. Don't see the answer. Don't see the answer. Try on your own. First, till now, whenever we have done the problem, we have done from liability side. Means we have taken capital employed, we have taken debt amounts, we have taken equity amounts, everyone. Yes or no? But we forgot one thing. Always, just now I said, because of your debt equity mistake in the previous question, debt assets ratio is different. Debt is to equity is different. Debt is to equity means, for example, answer 2:1 debt equity means what? In every 3 rupees, debt is 3, equity is 1. 2:1 debt equity ratio means what? In every 3 rupees, 2 rupees is debt, 1 rupee is equity. Okay, means 2/3 is a debt, 1/3 is what? Equity. That's the meaning of 2:1. But a debt assets ratio you should not understand like that. Listening or not? Debt assets ratio will be said in this way. 0.5:1 means, in technical terms, what you have to understand, 1 rupee total assets are there. In that 1 rupee, how much is financed by debt? 50%. 50% is financed by equity. That's the real meaning. Listening everyone? What is the financial leverage? What is a financial leverage? Chusara? Adi. So these are all called as basic fundamental misclarities. Fundamentals lo, if you are very weak enough to understand, these type of questions will come. Problem is, I will tell you, EVA question also is asked on financial leverage basis. I think it is also there in study mat. Okay. Always remaining in that question, everything is crap except financial leverage. Sir, always remember one point. Leverages calculation is always made. Leverages calculation is always made on times basis, which is always more than one. Which is always more than one. Less than one leverages concept cannot be seen in the world. Leverage and guttupettukondidi. At least, because I can't tell the entire IPCC leverages to you now and waste your time. Main point is always leverage should be either one or it should be more than one. It can't be less than one. ఇప్పుడు కాన్సెప్ట్ లోకి వద్దాం. EBIT is bigger, EBT is bigger in any company in any time. Therefore, EBIT by EBT you will make a, EBT by EBIT you will make a. That's all. Answer over. All leverages, big amount should come on numerator, small amount should come on denominator, because they want to express in number of times. Clear or not, everyone? Now tell me, operating leverage. Contribute EBIT by contribution or contribution by EBIT? Why? Contribution will be always high, either equal. If no fixed cost, contribution and EBIT are same. If fixed cost is there, contribution will be more than EBIT. Therefore, leverages can be either one or more than one. That's all. This logic, though you don't remember the formula, easily you can do. Clear or not? Okay. So this is a point, sir. I'm not doing problem on that. I think I need not do. Just in that question, interest will be missing figure. EBIT will be a missing figure. Interest they will give. Sorry, EBT can I write as EBIT minus interest? EBT can I write as EBIT minus interest? That's the small issue that we will find in that particular problem. Remaining everything is common. I'm not doing that. Not so great. Let us come back to this problem. Tell me, in this question, did they give any debt to equity? Answer. But what they have given? Assets can be generated directly. Assets will be generated through financing. Financing in how many ways? What are the two ways? Therefore, in my company, there is a patent. Okay, there is a patent. How much? 40 lakhs. And the company assets include 20 lakhs of working capital and 80 lakhs of PP. Now the question, patent should be included into the assets value or not? Sir, patent will come out of what? Research and development. Okay, patent will be generated out of research and development will be coming free of cost with finance. That means patent is also financed. Clear or not, everyone? So therefore, patent is a financed intangible asset recognized also under Income Tax Act. Recognized also under Income Tax. Research and development is a allowable expenditure under income tax or not? From research and development, what will come? Product will come, idea will come. Idea has a patent. Clear or not? 150% to 200%, why they are giving? Are you understanding or not? For that unique idea, that deductions are given. Encouragement. Clear or not, everyone? So don't think that patents are not allowed under income tax. Patents are happily allowed. Intangible cases are there in depreciation also. How much percentage? That's all. So they are allowing depreciation also on that. You can amortize it. Income tax allow చేసిందంటే ప్రపంచంలో ఎవరైనా allow చేస్తాడు, because they don't allow anything unless and until there is a good cause. Clear or not? So therefore try to understand clearly, patent is a recognized asset or not, everyone? Patent generate from sky, patent will follow. To generate patent, what is required? Huge financing is required in the form of research and development. Therefore that financing will be done by equity or debt or both. Therefore, can we calculate? And moreover, sorry, I am very important point is, this particular company is in manufacture of what? To manufacture the beauty cream, which is having a unique ideology. This R&D is very important for that or not? Therefore, this patent is used in operations directly. Therefore, we have to include that into the operating capital employed. Like this lot of analysis we can do. Institute booklet directly they have put an answer, but this is the real meaning behind the discussion. Everyone understood the point or not? Okay, so now take calculator and tell me how much is the operating capital. What is operating capital? 140 lakh. How much is the EBIT? EBIT into 1 minus T. I mean EBIT into 1 minus T. Tell me how much? Sir, he has already given EBIT into 1 minus T. That's why tax rates. Tax rates are not separately given. How much is it? How much? 12 lakh. Minus KO. How much? 15. Into capital employed. Calculate. Minus 9 lakh. Hope everyone understood how to do this. Okay. That's also. With this, we have completed EVA. Sir, I promised you 4 questions on EVA. How many we have done? 5. Other corporate valuation, we have to do another 8 different types of questions from your study material questions we are going to do now. Okay. Study mat questions we are going to do. Worst case scenario, I have selected 8 questions. If you do those 8, you need not do corporate valuation chapter again. All important blend problems I have selected. You can see study material also, it is available. Those are on FCFF. What is the concept, sir? FCFF. What is FCFF? Free cash flow for firm. Even before going into that, first keep the heading in the notes. 2-stage dividend discount model. Two-stage dividend discount model. Two-stage dividend discount model. See question number 2. 3 minutes time to read, 5 minutes time to solve. Next 10th minute I want an answer. More than that, if you take now, you have to recheck your performance. I mean it. This is the question taken from supplementary study paper. Questions of the exam lo. Supplementary study paper questions will directly come and fall in exam. Do you know what is a supplementary study paper? Newly added questions. And do you know from where I have taken this? 2003 RTP question. Added in the recent supplementary study paper means institute is digging all the past questions back. Not last 10 attempts. Even before that, going back 20 years, past questions they are digging back, refurbishing the models and they are asking in exam. Put the question there, you can do. Krishna. Already 2 minutes over. This question will come for 6 marks in exam. Hardly you should not spend more than 6 to 8 minutes. Start doing the answer. Don't see that much time. Unnecessary confusion will come. Put pen on paper. Try to do. If you could not do, at least I will tell how to do. So put pen on paper. Start doing it. How many of you don't have calculators? Too much, really. So please have your calculators. Do the answer. You don't see the answer. Happily you are putting answer before you. So don't see the answers. Try on your own. the answer? 9.95. Wrong. ఎంత ఏది ఎక్కడుంది? డౌట్ఫుల్. Okay, see here. See here. First point. Selected question a worst case scenario in two-stage dividend model. So the question, do you want to tell the answer? Yes. Maybe. Chance is there. It may be correct. Maybe. Because I don't remember answers. Maybe. Chance is there. See here. First point number one, moral of the story. Questions comes like this if there is a difficult paper. That's a point number one. 1 out of every 100 only will solve that properly. But try to understand, we should be among that 100 means, first thing you have to do the difficult problems. Bunch of easy problems, 100 problems you do, waste of your time. Do one correct problem. Any kind of problem in that model you will be able to do. Clear or not? Okay. Now listen carefully. First point. Anyone in the class should first explain me what is the two-stage dividend model. Yes, correct. I am asking what is the intention of that model. Facts you said. Growth will be variable for some number of years. Later it will run constant after some number of years. Understood? Correct. That is how the model is. I am asking what is the intention of two-stage models. Without knowing that, please don't do two-stage dividend models. Like this you will make the mistakes. There are so many new concepts to learn in this question. One question you do, I will make you to do 4 to 5 questions on this now. Just like that you will do the answers. Take any study material question. I am telling you, open handed. Any study material question you take in securities analysis after discussing this problem, you will not take more than 2 minutes to solve it. I am the guarantee now in the class. But listen to the first question properly. What is the real meaning of a two-stage dividend model? See here. Yesterday we talked about the concept of a bond immunization. Remember or not everyone? Understood or not? 1.5 hours we spent on immunization only. Since everyone is leaving the topic. So bond immunization, okay. Everyone understood the intention of bond immunization? Huh? Yield will, reinvestment will, automatically I will sell in the market. Because of that what will come? So the loss of interest will be set off against the capital gains that we get. We will be staying immune. This is what we have seen in the immunization strategy or not? Hello everyone in the last bench to the first bench. Everyone understood? And now listen to the point now. Two-stage dividend model runs on a similar footing. Every investor should have a time horizon when he is investing in the share market as well. Clear everyone? Okay, now listen carefully. Every investor should have a time horizon. Don't invest for investment sake. Invest with a time horizon. Means I am investing today. Why you are investing? Because after 3 years, I want this much amount for me to purchase a car, or to purchase a house, or to do this thing. Yeah. So you are putting your money today for today's needs, a future needs. Answer, sir, everyone. In this question, there is a company called as a ICAl Corporation. Clear? I want to invest in ICAl Corporation company. I want to invest in what company, sir? ICAl Corporation company. I am an investor. Think from my point of view. Okay? After explaining everything, you revisit the question, your impressions on question, your ideology of thinking, everything will change just to 2 minutes after. Listen. See the screen, everyone. What is the name of company? In that ICAl Corporation company, I want to become what? Shareholder by purchasing the shares. I want to invest in the shares of ICAl Corporation. I will invest. I will invest for perpetual period. No. Listen, how to understand this? I wanted to invest from 2004. I will invest in the year 2004. Answer, I will invest in the year. I will be in the Civil Corporation shareholdership starting from 2004. Count the numbers. I will be a member from 2004, 5, 6, 7, 8. Eighth ending, I will sell the share and I will come out of the market. I want to hold this share for 5 years only. Listen or not, everyone. Tell me, I am becoming a shareholder of Civil Corporation when? 2003 ending, also called as a 2004, beginning of 2004. I want to become a shareholder at the beginning of, I will hold the share from 2004, 2005. Beginning and anduke. I know how you will think. So beginning of 2004 I purchase, mean 2003 ending I purchase the share. Now tell me, I will hold for the year 2004, 2005, 2006, 2007, 2008. How many years I am holding? What is my holding period? What is my holding period? 5 years I will hold. What is the 5th year? Numbers are, so tell me, 2004, 5, 6, 7, 8. 8th ending I will sell and I will come out. What is the value of any asset? Present value of future cash flows discounted at a required rate of return. Yes or no? Now tell me, when I am selling in the year 8, I should take D9 to infinity. I should take from, did you understand my point or not? I should take from which year to which year? First point number, one second. One fundamental question I have to ask. See here once. P naught equal to D1 by KE minus G. Everyone know this formula or not? Answer. Yesterday beginning class, I said one formula. Cash flow per annum divided by required rate. Do you remember that point or not? What is the point? Everyone repeat. Cash flow per annum divided by required rate. Had we covered this concept or not? In case of shares, what is cash flow per annum? Answer, sir. What is RR? KE. Sometimes dividend can be with growth or without growth. With growth. With growth, add deduct here G. Clear? Now listen. Fundamentally, if you have to understand certain things, see here. See the screen once. My question number 1. Tell me, P naught will consider all dividends next year dividend. Sir, here. P naught will consider infinite dividends very next year dividend. Everyone, infinite dividends. So see here, that's what I want to tell. Fastly I will cover this. That's why never underestimate a derivation to a formula, and that was given not to impress you, that is to make you intuitive to understand the concept. Like this, wrong intentions and impressions will fall on the points and formulae. You are thinking that P naught equal to D1 by K minus G. You are thinking that you are considering only D1 dividend. Yes or no? But it considers infinite dividends inside it. Okay. Sorry. Fastly, let us derive one point. Everyone should tell me what is the value of any asset. Present value of future cash flows discounted at a required rate. Tell me. Year, cash flow, PV at the rate of KE, PV, CF. Fastly, I don't want any wasted time. You should only tell. Year 1, cash flow given by a share is called as what? Participate, sir. First year dividend is called as a D1, D0, D2. Answer. Okay, D1. Next, D1 and second year will be called as D2. Third year is called as D3. So on up to n number of years we call as DN. Up to here everyone understood? Very good. Next, see the screen. I want to discount by 1 year. How to do the formula? 1 by 1 plus KE whole power 1. 2 years aithe 1 by 1 plus KE whole square. Do you believe in my point or not? Tell me how to do. 1 by 1 plus KE whole power 1. 1 by 1 plus KE whole square. 1 by 1 plus KE whole cube. So on up to 1 by 1 plus KE whole power n. Whole power n. Okay. Now tell me, multiply and tell me what is a PVCF now. D1 by 1 plus KE, D2 by 1 plus KE whole square, D3 by 1 plus KE whole cube, so on up to Dn by 1 plus KE whole power n. What is the total called as? What is this total called as? Fair value of a share. Don't call it PVCF from now. It is called as a fair value of an asset. Here the asset is a share. Clear or not, everyone? Now see here. See the screen. Point number 1. Tell me. I am adding infinite dividends. I am adding next year dividend. D1 to D2, D3, so on up to Dn means I am adding 1 year dividend, 2 year dividend, infinite number of dividends. Okay. Now answer my question. What is the value of any asset? Tell sir. Don't get irritated. Unnecessarily, I don't ask you questions. What is the value of an asset? See here. When I am telling present value, I am noting down certain things. See here. Tell me, what is the value of an asset? Present value of future cash flows discounted at a required rate is called as what? Value of an asset. Justified everyone in the class? Everyone? Okay, now, please have patience. Assist me in writing this formula now. Tell me what is the value of P0 now. Sigma, tell me, D1 by 1 plus KE plus D2 by 1 plus KE whole square plus D3 by 1 plus KE whole cube plus so on plus Dn by 1 plus KE whole power n. Am I correct or not, everyone? Now tell me, this is power 1. Tell me, 1 plus KE power 1, 1 plus KE power 2, power 3, like that it is going. Okay? I will call it as first term, second term, third term, fourth term, like that it will go. How many terms it will go? N terms it will go. Tell me now, this is some x power 1. This is x square. This is x cube. Tell me, x power 1 will have more value, x square will have more value. Sir, 1 plus KE is always same. KE 10% if you take, 1 plus KE is always same or not? I will call 1 plus KE as x. Can I call like that or not? Yes. Tell me, denominator in the first case, it is called as x power 1. Next one, x square. Next one, x cube. Now you should only answer who will have more value. Term 1 or term 2 or term 3. When you compare 1 and 2, who will have more value? 2. When you compare 2, 3, who will have more value? This is called as a geometric progression. This is called as what progression, sir? Geometric progression. Listening, everyone. This is called as a geometric progression. Geometric progression means the succeeding term will always be equally more than the preceding or predecessor term. Is called as a geometric progression. They increase at a same rate. Clear or not, everyone? Okay, just see here now. You should assist me in doing from here. There is a formula for geometric progression. Tell me, if I write AR square, AR cube, AR power 4, AR power 5 like that, I can write up to AR power n or not. Infinite number of terms will get generated or not. But I don't want that infinite. I want one lump sum amount today itself. Yesterday I asked you one question, 1 lakh, 1 lakh, 1 lakh, 1 lakh forever. Tell me one lump sum amount today. People want uncertainistic future, certainistic present. They want certainistic present. Therefore, present value concept came. Who want the future? I want present value of the future. Tell me now. That's how the people ask. In future, I will give you this much. Don't tell about future. Tell me how much you will give today. I will give you D1, D2, D3, D4, Dn means how much you pay in the future. Who cares? Tell me today what you will give. Clear, everyone? So, for listening, sir, everyone, to make it more and more viable for the readers and to the analysts, they found out one concept in geometric progression called as y equal to a by 1 minus r. Please tell me what is it? Y equal to, y here represents P0. Y represents what? Listen carefully. A represents first term. A represents what term, sir? R represents highest term by smallest term. Highest term by, please assist me. Just 2 minutes we will complete this. Now you should answer. First I want one question and one answer. We have taken in this particular sequence totally, we have taken 1 year dividend, 2 years dividend, infinite dividends. Answer. Very good. Now answer. I will take this as a first term. I will take this as a second term. Or this is the lowest term. This is the highest term. You can call in any way. Clear or not, everyone? If you take between 2, 3, 2 will become lowest term, 3 will become highest term. I will take between 1 and 2 for understanding sake. Now tell me. You should tell, I should write. A equal to what? A equal to what? D1 by 1 plus KE. Okay, 1 point over. R equal to what? Highest by lowest or lowest by highest? Highest by lowest. So tell me, what is the highest one? D2 by 1 plus KE whole square whole divided by D1 by 1 plus KE. Can I write like this or not? Now, you only renotate and tell me D2 can be written as what? D1 into 1 plus U whole divided by 1 plus KE into 1 plus KE whole divided by D1 by 1 plus KE. Can I write like this or not? Okay. If you take this towards D1 into 1 plus G whole divided by 1 plus KE into 1 plus KE into tell 1 plus KE divided by D1. D1. 1 plus KE, 1 plus KE. So tell me the net answer. 1 plus G by 1 plus KE. This is the answer for A na R 1 minus R. R. This is the answer for R. We want R 1 minus R. So tell me what is 1 minus R? 1 minus 1 plus G by 1 plus KE. Take a common LCM. Tell me 1 plus KE minus 1 minus G. Minus 1 plus 1. Cancel. So what is the result? KE minus G by 1 plus KE. Up to here everyone understood? We want A na R 1 minus R, A by 1 minus R. So P naught equal to A by 1 minus R. What is A? D1 by 1 plus KE whole divided by what is 1 minus R? KE minus G divided by 1 plus KE. 1 plus KE, 1 plus KE cancel. P naught equal to D1 by KE minus G. This is how the formula has been derived. Now from this, the moral of the story, answer has obtained by taking infinite dividends very next year dividend. This is realization. So it don't consider the next year dividend, it will consider infinite dividends, but the formula will always manipulate your thinking process. Because when you see that now P not equal to D1 means next year dividend. No, it considers infinite dividends. Clear everyone in the class? So tell me D1 by K minus G will consider next year dividend, infinite number of dividends. Infinite number of dividends will be considered inside that P naught calculation. Clear everyone in the class? Now this is the question I want to ask you. Tell me now. P naught equal to D1 by K minus G kada? I will ask you a question. What is P 2008? P 2008 equal to D 2009 divided by, as simple as that. We explain that. I explained all this. Understood the concept or not, everyone? Tell me, I am a shareholder holding the share from which year? I will hold for 2004, 5, 6, 7, 8. And then the 2008 year, what I will do? Sell. I want to sell in the year 2008 or not? At what price I have to sell? What is the value of the share at the end of 2008? The value of the share at the end of 2008 equal to 2009 to infinite dividends divided by K minus G. Are you understanding the concept or not, everyone? Hello? Clear? So therefore, my point is 2008 I want to sell. I want to hold it for how many years? I want to hold it for how many years? I will ask you one common sense question now. Tell me, I will be holding from which year to which year? 2004 to 2008. How many years? 5 years I am holding. When I am holding for 5 years, In that 5 years, I will expect 1 year growth rate may be 10, another year growth may be 12, another year growth may be 13. Like that I can estimate. Clear? When I am selling in the year 2008, selling the share in the year 2008, selling the share in the year 2008, my share is changing the hand, still in my hand. Answer. Changing the hand means another person will take, yes or no? When the share is not in my hand, why I need yearly growth rate? Therefore, we will take one stable growth rate. Shall we tell another twist? Always that growth rate will be lesser than growth rate of your holding period. Any question you take. Yes, Gadu. Why? Reason is when the future is increasing, your estimation will have a lesser accuracy. Therefore, don't take that growth. So tell me how institute will be in the next year. If a person asks me, I can tell something. After 3 years, how ICAI will be, maybe I can tell. After 8 years, how institute will be, can I estimate or cannot? That means when the future is increasing, my estimate will have accuracy, lesser accuracy. Therefore, when I estimate a growth of 10% today, I can estimate because the share is in my hand. But after 5 years when I sell the share, at that time, what growth will be there? How would I know? I will take a lesser growth conservatively and calculate the price of the share. That's how the growth for the stable period will be always lesser than the growth in the variable period. That's how the concepts have been derived. Everyone understood the concept clearly? So this is how the two-stage dividend model started. అందుకు 2 stages వచ్చాయి. Stage 1 is holding period, stage 2 is selling period. Understood or not? ఏం అర్థమైందో? Read the question now. Now with all this understanding, read the question. Completed? Understood the question, everyone? Hello, sir, tell me, did you find any difference between your understanding before explanation and after explanation at least now? Tell me, I am purchasing the share in which year? 3 ending means technically 4 beginning, and I want to hold it for how many years? Answer. and they want to sell the share at the end of which year? Answer, sir. Okay. What are the two questions he asked? That's why he asked that question. Why we aren't expected price at the end of year 2008? Because you have to sell at that time. Understood the question now? That's how you need to understand the question. That's why I'm telling you, sir, please don't take it otherwise. When you are reading the question in SFM, reading the question, you should complete 60% of your understanding. Then you will get that 90 plus, 80 plus, 90 plus targets will keep in SFM. Now, first, by the time you read the question, out of practice it will come, I know. But by the time you complete reading the question, half the concept you should understand what we have to do. While putting the pen and paper remaining, anyway, the brain will help you. So the first point, number one. Tell me, in this question, this is a one stage dividend, two stage dividend model. I am holding from which year to which year? 2004 to, and I am selling at the end of the year 2008. Okay, now answer my question. In this question, another bad thing that he has given is they have given two KEs. Because beta is same, beta is different, different. When beta changes, automatically KE will change. So first step number one, what we need to calculate? Calculation of KE. Please, let us do. Let us start. This problem we have to do in the class. Start writing. Step one, calculation of KE. Calculation of KE. Sir, fast, I can't wait for you till you write. Very fast, let us do. Even if you have done previously, now do again. Present it in a correct way. Write down. Holding period, perpetual period. Tell me, in my holding period, what is the info given to me? RF is how much? Sir, everyone in the class, please put your calculators, pens and papers, and everyone please start doing the answer. How much is the RF? Plus beta 1.4. RM minus RF. RM minus RF 5.5. Okay, tell me. 13.95%. Okay. Next, perpetual period. Tell me. 6.25 plus 1.110 into 333 303 30 na. Okay. 30. Sir, step number one, everyone have done this up to here. Next, calculate. Step 2. Step 2. How many of you find out that payout ratio is changing? This is another worst adjustment. Do you know what he has done? Sir, tell me, I want to ask you one question. Whenever in our total concept, please no noise, G equal to 10%, I said. What is G? Growth. Growth equal to 10% means it is a growth in what? Growth in EPS, DPS, both. I can understand now how much clear you are with regard to these basics. When I say growth equal to 10%, I am talking about a growth in dividends, growth in earnings, growth in both. When I say growth equal to 10%, it means growth of dividends or growth in DPS or growth in EPS or growth in both together. EPS or DPS or both. E or D? How many of you think that it is growth in EPS only? Only. Sir, I am not testing, just asking you. EPS only. How many of you are thinking? Only EPS growth. Okay. No, sir. It's a DPS growth. Both growing together. Both growing together. Sir, listen. Listen, sir. Whenever growth equal to 10%, it is a growth in EPS or DPS or both is a question. It is growth in both EPS as well as DPS sometimes. It is only EPS sometimes. Listen carefully, let me explain. You should only answer me. Calculator though you answer, just working I will do. A particular year, please, in a particular year, company is having a EPS of 10. It declared a DPS of 5. Declared a DPS of 5. Okay. Now tell me, how much is the payout ratio? 0.5, sorry, 50%, sir. 50% is the payout ratio. Am I clear or not? Okay. Now, next year, earnings increase it to 15. Earnings increase it to what's the? 15. 15 into, again 50% we need to do. Payout ratio. Okay, tell me how much it is? 7.5. 7.5. Now tell me, what is the growth in EPS here? 10 became 15, means 15 minus 10 whole divided by 10 into 100. How much? How much percent? So growth equal to 50%. Growth equal to 50%. Now tell me, 5 became how much here? 7.5 minus 5 whole divided by 5 into 100. How much? 50%. Now tell me, growth in earnings equal to growth in dividends or not? First point. Yes. Second case. ED equal to, నేను ఏది సరదా కోసమే అయితే చెప్పట్లా. Please listen carefully. According to the problem need, I am giving these principles. Okay. So tell me, E equal to, say for example 10, D equal to 5. Growth in earnings is 50%. Say for example, it went up to how much? 15. Okay. Now, see here, 10 la 5 was declared. How much is the payout ratio here? Next year, I am maintaining 30% payout. How much payouts are? 30% payout. 50 la 30. 4.5. Now tell me, what is the growth here? 5 became 4.5. So tell me, what is the growth here? Negative growth. How much? Minus 10%. Now tell me, growth in earnings is growth in dividends. That's what I want to pinpoint here. Growth is a growth in both earnings and dividends if the company follows same payout ratio. In the given case, the payout ratios are changing. ఎవరు సరే క్వశ్చన్ తయారు చేసింది? ICAI don't prepare any question for your kind information. They borrow from CFA questions. They don't prepare anything. అంత లేదు. They don't prepare anything. So finance మీద అంత ఇంట్రెస్ట్ అసలు పెట్టడు. So they don't prepare anything. They borrow questions. Okay. Similar questions when I am doing CFA, we have seen these type of questions. Similar questions they borrowed here. Their extra level concepts they will tell. Here okay type of questions. Here what you are seeing as an advanced, there may be moderate questions they will be in the CFA. But point is very clear, sir. Understand, this is a comprehensive question. Point number 1. And answer and tell me, when I am holding, what is the payout? See and tell here, when I am holding, what is the payout? That's why he has given one hint. EPS is how much? What is the DPS? Can we calculate the percentage or not? 0.69 by 2.1. 32.58. 86. Sir, 32.86. 32.86 is what? Payout ratio during my holding period, post holding, holding period. Post holding payout is increased to how much? So can I take the growth directly? Cannot take. Cannot take. We have to recalculate the growth and calculate that. That is another adjustment we need to make. Shall we do the answer? Right answer, everyone. Step 2. Calculation of payout ratio for holding period. Calculation of payout ratio for holding period. Write down. Some people have done wrong by taking 2.1 into the table. 2.1 into table, not you. So many people have taken. Your brothers are there. So 2.1 you should not consider it. That's a base year information given. What information, sir? Base year. Sir, 1 second. Think and answer. I am holding from which year to which year? 4 to 8. Why I will be considering the past information? You only telling the present value of future cash flows. Then why you need past cash flows? Tell me, what is the payout ratio? Tell me. DPS by EPS, EPS by DPS. DPS 2003 by. Tell me, what is the DPS 2003? Euro 0.69 divided by Euro 1 into 100. Tell me. 86, okay, 32.86%. Up to here also everyone comfortable? Next, sir, step number 3. Write down. Investment table. Investment table. So let's prepare a table of investment. Write down clearly year, EPS, TPS, PV at the rate of. Tell me, I am calculating all these in the year 2004, I mean 2003 ending, 2008 ending. I am asking you question. When you give an answer, think and answer properly. I am doing all these calculations in the year 2003 ending, 2008 ending. 3 or 8? 3, not 8. We are purchasing the share in which year? So 2004 means 2003 ending. So you are taking all these decisions at that time. Do you know why I am asking this question? If you take the assumption that I am doing all these things in 2008, this K you will use in PV factor. I am doing all these in which year? Write down. PV at the rate of 13.95% PV CF. Take it. Do one by one. Write down along with me. No delay. 2004, 2005, 2006, 2007, 2008. Help me with the numbers. How much is the growth in EPS? How much is after growth? Tell me the number. All are in euros. Okay, separately don't write again. Okay, tell me. 2.42. Round it up to second digit. 2.78. 1 second. 3.2. 3.68. 2, 3. Stop there. Tell me, first 5 years, 2004, 2005, 2006, 2007, okay, and 2008. My payout ratio is how much? I mean, my company payout ratio is how much? 65%, 32.85%, 86%. Tell me 32.86% or 2.42. 1 second. Let me write. 0.79580. Next. 0.91. 1.05. 1.21. 1.39. PV factors, please. 0.878. 0.7 0 6 7 6 5 2 1. These numbers also you give me once. 0.6 60, 697, 70. Next. 70, 71.72. Don't do the last one. Listen. One second. Let me do. I will give you answer. First, up to here, everyone comfortable with the table answers? Now tell me. I am holding it for how many years? I am holding it for how many years? 5 years. 2004, 5, 6, 7, 8. Yes or no? Okay. Now tell me. We will calculate one price again now. Okay. That will be the price at which I will sell at the end of which year? That calculation I will do first. I will give time for you to copy. Please help me with the numbers. Tell me. I will be selling at the end of 2000 dash. You only said me 2008 dividend will be, value will be dependent on dividend in the year 2009 divided by K minus G. First point number 1, answer my question. 2009 dividend. Okay. 2009 dividend means only 2009. 2009 till infinity. This is realization. How you understand this? Formula derivation. That's the reason why I said derivation. You understand the concept behind that in clarity. Okay, that there are infinite dividends inside, not just a next year dividend. Okay, see the screen now. D2009 will be D2008 into 1 plus D. Yes or no? No, because payout ratio is changing. If you take D2008 plus 1 plus G, your answer will be wrong because D2008 belongs to G of, payout ratio of 32.86. Did you understand what I said or not? Again, I'm asking you answer. D2009, can I write as D2008 into 1 plus G? Why you cannot do like that? Why you cannot do? Don't tell like that. Don't do conclusions. D2008. Here if you observe, 1.39 came as 4.23 into 65. 4.23 into 32.86. Answer. If you take 1.39 into 1 plus G, you are taking 32.86 payout to perpetuity instead of taking 65. Yes or no, everyone? So therefore, you should consider D2009 as, I repeat, you should consider D2009 as D2008 into 1 plus G, E2009. Now you should only answer me. D2009 can be written as E2009 into payout ratio whole divided by K minus E. Can I write like this or not? E2, listening? What is the E2009? The growth for perpetual period is how much? See there, sir. See the question and tell. How much is the growth, sir? See that. What is the stable growth? What is the variable growth? My holding period time, what is the G? My sale period, what is the G? So tell me now. I should consider 6 or 15 or 6. Tell me what is the E? 4 point, take the base, 4.23 into 1.06 into 65% whole divided by 12.3% minus 6% because when I am trying to sell, KE fell to 12.3% only. You only have done, sir, 2 Ks you have done. Tell me. Numerator value 2.91 divided by 6.3%. Tell me value. 46.19. ఒక ఆన్సర్ చెప్పండి సరే ఎవరు ఆన్సర్ కాదు I will make 20 46.20 some number came. See here 46.20 or 46.19, whatever the case may be. See here now, this is the value at which I will, it is the value at which I will at the end of which year? 2008. At the end of year 2000. Okay, tell me what is the value? 46.20. 46.20. Don't again write dividend for this. And what is the PV ratio? 0.521 only. That's why last 2 years same PV factor will come. Students are also mugging up that last 2 we should use same PV factor. Why? I don't know. Now at least you understood why. Because you are selling in the same year. Therefore, tell me answer. So that 1.39 into 0.521. This one 24 point. See, not this. Previous one, tell me point. Again 0.72. This one 24 or 5. Point 07. Total 27 point. This is the final answer. And moreover, the question is, he is asking what is the value at the end of 2008. This is the answer. Listening or no? Last, what is the value of the share at the end? 27.62. This is the final answer for this question. For this, he will give 8 marks. What are the points we learnt in this question? అసలు ముందు నేను ఏం నేర్చుకున్నానో డౌట్ రావాలి ఫస్ట్. So, this is a classic example of which model? Two-stage dividend model. Which stage dividend model, sir? Two-stage dividend model. At least everyone have study materials with you? Study materials, everyone? Okay. Then I will do one thing. From the study material, I will be giving you 5 questions on two-stage model now. Selected questions, sir. Shall we do? Take the study material. Question number. Chapter. No. I will tell you the page number for them. Where is the corporate valuation? Last. One second. Please come to security valuation chapter. Try to solve question number 5. Don't open the answers. Don't see the answers. Numbers change. Page number 4.29. X limited just declared a dividend. 5th question in securities valuation chapter. Everyone, study material. 5th question. So if you want that question, I will show you on the screens. They're also in my book. This one, first question. Okay, do one thing. Right there, ISM question number 5, security valuation chapter. Clear? Close the book, see there. Automatically your eyes will fall on the answers. No, Sir, do that. I will give you 3 minutes time. Try to solve. First, explain me the model of this question. Hello, everyone. 1 second. This person want to purchase the share today and want to hold it for how many years? How many years? And at the end of which year he want to sell? But at the end of which year he want to sell? 3rd year. At what price? In this question he has given that 360. That's all. That's the only difference. వివరాలొద్దు. You do. Have you done the bit 1 first? Bit 1, everyone. Bit 1, what is the formula you used? Maximum amount Mr. B should pay for the share if he required a required rate of return of 13% per annum, he asked. Okay. So P naught equal to D1 by K minus G. What is the D1 already, D0 already given? 14 into 1 plus G. What is the growth rate? Sir, anticipating a growth from 8% to 9%. Okay. To continue for 3 years period, like that he has given. Clear, everyone? So the point is, the expected growth rate present is 1.08, but the anticipated growth rate is how much? 1.09. So after doing this, please tell me the final answer what you got. 288.57. Everyone got this answer? I will do then. D1 is 14. So 14 into 1 point. 1 point. Whole divided by what is the KE given in the question? 13% minus 9%. 14 into 1.09. 15.26 divided by 4%. Please. 280. 381.50. Then how you got 288.57? Huh? What is your point? So see here, for which question you done the answer? Maximum price. Oh, sorry. Okay, understood. Okay. First bit only for 3 years. Okay. So now tell me, first one, point number 1, Mr. X is holding this particular share only for how many years? 3 years. So tell me, first year, how much dividend he will get? 14 plus. 14 plus. Very good. Next, plus another 9%. Another again, plus another 9%. Clear? And at the end of third year, he is selling the share at how much price? 360. So you should multiply first year dividend with a PV factor, second year, third year, and the sale value using a same PV factor. Clear, everyone? How much is the answer you got? Then you got 288.57. Okay, done. Next. Maximum price Mr. B will be willing to pay for the share if he is of an opinion that 9% growth will be maintained indefinitely. Now tell the answer. 381.5. Okay, then I said the answer for this. Next. The price at the end of 3, already you might have done this. Price at, one second. Price at the end of third year means I want V1, V2, V3. Answer. V3 will be dependent on D1, D2, D3, D4 to infinity. Divided by what is a KE minus G. Tell me. He is asking 9% growth, assuming 2 to be correct. So tell me, D4, how much? 14 into, elaborate, 14 into 1.09 whole divided by, tell me, 13% minus 9. What is that? D0. Okay. How much is the D3? Okay, tell me. 18.13 into 1.09 whole divided by 4. How much? 490.04. That's so first year dividend is 14. Next year dividend, 0 year dividend is 14. First year dividend how much? 15.2. Next year? Last year, third year? Okay. 18.13. So these 3 questions are 3 different models. First question is for a holding period of 3 years and selling at the end of third year. Second question will be a perpetual growth holding for perpetual period, and the third question is on calculation of the price of the share at the end of first year, second year, third year. Third year dividend, third year value will be dividend dependent on first year dividend, second year dividend, third year dividend, 4 to infinity. So d4 to infinity. So d4 can be written as a d3 into 1 plus g. So d3 some value you have said 18 point some amount into 1 plus g. He has clearly said that growth to be considered at 9%. Ke minus g happens to be 13% minus 9%. You are 494.04. That's all. Sir, first point, everyone tell me. Everyone got this answer, sir? Done. So first and second questions are some good questions that you can do from this particular area. Next, I will give you another one question. Try. Best questions are there. To some extent, difficult and variety type of questions are also there in this. Question number 26 in my book. It is also there in your study material. I will see where it is, in which chapter. Please check security valuation chapter. No break. First do this. I will check. Give me the book. Or else others, please take it from the screen directly. Do this question. Oh, it is not there in that. I will check and tell. They didn't give in this study mat, but still it is there. 8 marks question. May 2012. In my attempt, when I have written the exam, when I passed it, this is a question. It's a 8 marks question. It was registered in my mind. May 2000. You can check. If anyone have the question bank, you can check. This question came in May 2012 attempt for 8 marks. Perfectly, I have done that. I remember May 2012, the attempt in which I have given my first attempt for the group number 1. So same question has come. Please solve it. May 2012 question. Do that. So have you done? Done? What is the answer? What is the answer? What is the year? May 2012. Which year this is? May 2012 attempt. And I'm not telling for joke's sake, sir. Unnecessarily, I don't want to become fool. Okay. So this is a question. అరే నేను పాస్ అయినట్టు నాకు గుర్తుండదా ఏ క్వశ్చన్లు ఏమి వచ్చాయో. దిస్ ఈస్ అ క్వశ్చన్. Didn't remember answer. I have to do. Everyone. So the question, this is exam question. May 2012, 8 marks question. So one good question that was tested, not so difficult, not so easy as well. First one, in the question, KE is not given. What is not given, sir? KE. So when KE is not given, how to calculate it? Assume. Then assume answer directly. Right to assume KE. So, sir, listen now. So everyone agreed that it is an exam question. First point. Okay, na? Sir, next. So unless and until it is asked in exam or some importance is there, I will not put. So believe it. So see the screen. Let's not do directly and waste your time. I will show you the answer how to do that. From that you can only understand what is the new point that we are going to learn there. Did you see that? Oh, then okay. Yes, this one. Sorry. EVA. No. Yes. Yes. Beginning. Which one? Yes, this one. I'm very sorry. I thought I kept it the last. Okay. See here. First point number 1. Sir, if we can observe the question there. Okay. See here. DEF Limited is regularly paying a dividend at the rate of 19,20,000 per annum for several years, and it is expected the same dividend would continue at this level even in the near future. There are 12 lakh equity shares of rupees 10 each, and the share is traded at par. The company has an opportunity to invest rupees 8 lakhs in 1 year's time, as well as further 8 lakh in 2 years' time in a project, as it is estimated that project will generate cash inflow of rupees 3,60,000 per annum in 3 years' time, which will continue forever. This investment is possible if the dividend is reduced for the next 2 years, whether the company should accept the project. Also analyze the effect on market price of the share if the company decides to accept the project. Okay. First point number 1, tell me, this company is regularly paying a dividend at the rate of how much, dividend of how much rupees? 19,20,000. Okay. Now, what is the growth rate of the dividend here? Growth rate. At what growth it is growing? No growth. Why? They are telling that clearly. If you can observe, one second. What they are telling is they don't have any retained earnings. That's why the only way of financing their projects is they have to stop the dividend and they have to finance the projects. They don't have any retained earnings to grow their projects. Clear or not, everyone? Okay. First, tell me how many equity shares are there? Can we calculate the existing D0? D0, how much is a D0? 19,20,000 divided by 12 lakh. How much is answer? Write down, sir. Step 1. Calculation of dividend. Calculation of dividend. Calculation of dividend. Okay. D equal to 19,20,000 divided by 12 lakh. 19,20,000 divided by 12 lakh equal to rupees 1.6. So that 1.6 will grow na? Cannot grow na? Cannot grow because the company don't have any kind of retained earnings to grow. Okay. So retained earnings will be there, then growth will be there because G equal to B into R. Retention should be there in order to have a growth. Retention, not that means what will happen? Growth will not be there. As simple as that. Okay. So next, the company has an opportunity to invest 8 lakh in 1 year time, another 8 lakh in 2 years time, which will generate 3,60,000 per annum in 3 years time, which will continue forever. Now tell me, this project will have investment today na in the next 2 years. Means outflow will happen at the 0 era, year 1 and year 2. That's a new point we have seen. This is a typical type of capital budgeting question also. In a capital budgeting question, it is a general assumption that we will make investment today, but cash flows will come in future. In this question, investments are not even made today. Investment will be made in the next year and the next year. Generally, in capital budgeting, outflow will have a PV factor of 1. Why? Because in year 0 they will make, but here outflow also have a PV factor. Clear, everyone? Tell me, what is my earning every year? See the screen and tell, what is my earning every year? What is my earning every year? 19,20,000. 19,20,000 like 8 lakhs will be reduced in order to make the investment. Yes or no, everyone? 19,20,000, how much I should sacrifice? Balance will be available as a dividend for the first year and second year now. Everyone in the class understood or not? So try to understand this. 19,20,000 is the total earnings that will be available for year 1 and year 2. In that, how much I will use for the project? 8 lakhs. 11,20,000 only will be available for me for the payment of dividend. Am I clear, everyone in the class? So therefore, how to do this? See here. Up to here. Now we calculated DPS. From the DPS, can you calculate the KE? Yes. Write down. Second step, calculation of KE. Calculation of KE. Calculation of KE. Clear? KE equal to D by P. KE equal to D by P. Growth is there? Growth is there. What to do? D1 by P naught plus G. But here what is not there? Growth is not there. Therefore D plus P, D by P equal to 1.6 by 10 equal to how much percentage? 16%. Up to here, understood, everyone? Next. See here. This is the easiest way to do the same. Everyone, please look at the answer once, later you can solve. First point, evaluation of MPS and the project. You can do this question in two ways. Number one, you can take the existing earnings minus you can make the investment outflow, balance you can take, like that you can take. Much more easiest way I have done. Please see the screen. Everyone in the class, answer. My every year EPS is how much? 1.6. How much? 1.6. Now you can see there and tell in the first year how much investment I need to make? 8 lakhs. How many shares are there? That means how much outflow I need to make? 0.667 per each share I have to make an investment. Am I clear or not? So outflow for the first year will become minus 0.575. Next, second year. Second year again I have a inflow na, outflow na. Again how much outflow? Same 0.667, but the PV factor will be same or different? Different, because the investment is not made in the first year. Investment is made in the second year. So 0.496. Third one. Last, from then, please listen sir, from then I will be getting 3.6, 3.6, 3.6, 3.6 forever till perpetuity or not? Third year I am getting 3.6, 3.6 divided by 12, 0.3 I have taken, and from third till infinity also I am getting the same perpetual value I calculated. Please say that. P3 equal to what? Below see there, P3 equal to what? D4 into D4 divided by K minus G. Growth is there or not there? D4 equal to D3 into 1 plus G divided by K minus G. But D3 is already 0.3 whole divided by 16 because growth is 0. So you get a perpetual value of how much? 1.875. 1.875 I have written. 0.641 we have taken the PVCF. Project value has given me a share appreciation of how much? Plus 0.323 per each share I have got. That is a value. New value of the share. MPS without project is 10. Value addition due to the project is 0.323. So MPS with the new project is 10.323. So project is giving a positive NPV of 0.323 and the price has increased to 10.323 from the existing 10. It is recommended to take up the project. Abhidon sir, if you have any doubts, you can ask. మార్కెట్ ప్రైస్ చేసిన మార్కెట్ ప్రైస్ చేసిన ఒకటే ఆన్సర్. First one completed a first table. Next also copied on the new value of share. So once after doing this, take a 10 minutes break and come soon. We'll go with FCFF model. So completed doing. So the same question you can do it in various ways. This is one of the way, easy way. But I want to do it in another way if you want. I will tell you how to do. You can also solve that way. Tell me how much is the dividends existing now, earnings? 19 lakh 20,000. From that you deduct 8 lakhs. Clear? Balance will come. Using those cash flows also you can calculate. Same answer, 10.323 will not change. Are you understanding my point or not? You do in any way, you will get the same answer, or else you come during the break time, I will solve for you. Okay, you tell any which way you want, I will solve in that way, you will get the answer. I have done in 3 ways, but I selected one from the 3 which is very easy to understand. Okay, so take a break, 10 minutes, please come fast. We have to start with FCFF model, important. So see here. So let's continue. In your study material, this question is there. Corporate valuation. Please open that FCFF model. Please keep the heading in your notes. Free cash flows. Free cash flows. Free cash flows. Free cash flows. First, listen, before we start with the concept of free cash flows, free cash flow is one of the most famous question in examination. Every attempt one question is generally been given. Last attempt around 12 marks came from the free cash flows in 2 question format. Every attempt you can expect 6 marks to 8 marks from free cash flow models, because it is one of the most popular internationally accepted models of valuation. So therefore, every attempt generally one question will be represented from the area called as free cash flows. Shall we start, everyone? Listen. Free cash flows, whenever we have to calculate, there is a normal tail and error method, tailor-made method of calculation through the formula approach. So many things are there. First, tell me what is your say about the free cash flow models, because first I should know what you have a basic knowledge on. On that we can build the remaining part. Like yesterday, convexity, I asked you first, what is your knowledge? If I can understand that, I can do. The regular classes from the bare basics I can tell, irrespective of the fact when 1 or 2 students have the knowledge. But here, if I understand to what extent you had a clarity on this concept, I can continue from there rather than explaining the concept from the beginning. So what is your answer about how this free cash flow model works? Okay, logic okay. Problem solving, everyone comfortable as free cash flows. Solving the problem, big problems or small problems, what are the case? Are comfortable in doing FCFF model? Sir, okay. See here, the point is, three questions are given in the study material. First, we will do those. Sorry, Uma. I will tell you the question numbers. Mark them. We will do them first. In my notes also they are. Question number 7 and 8. First, we are going to do those. Study material, question number 7 and 8 in corporate valuation. Question number 7 and 8. And sorry, Uma. Question number 3. Mark it very important. 4 times that question came in exam in a similar format with a change in numbers. Question number 3. That also we'll solve in the class now. Next. Next. Security valuation chapter, question number 10. That is also on free cash flows. They have given in security valuation chapter. Question number 10, security valuation chapter. Calculate the value of the share from the following information. Hello, I'm talking to everyone. How many questions are selected now? 4. Another question is also there. That question is not in study mat. That's an RTP question. That question itself I will show you on the screen. Remaining we can do. So 5 questions I am selecting from free cash flows. Hello everyone. How many questions we are going to do? 5. 5 the best questions and 5 different models. FCFF lone different models. Okay. Before going into FCFF model, first let us understand the concept behind free cash flows clearly. See, some level of clarity is required, patience is required to understand the concept. Time and again I have been telling you the same, not just this chapter. When we come to the next area called as options and futures, okay, if you tell that you are having a good amount of clarity in this, with no exaggeration I am telling you, the top notch discussions I will make in options and futures and forex. Okay. So technically to comprehend, you can really understand that if you felt these concepts as really good understanding, better than your previous learning, I am telling you definitely options and futures will be another level. So first let us complete this corporate and securities valuation. In this is one of the most important model, free cash flows. In this free cash flows, there are 2 types. Equity free cash flows, firm free cash flows. What is the free cash flows? Equity free cash flows. Second one, firm free cash flows, also called as a FCFF, FCFE. Clear everyone? I'm talking to everyone in the class. Don't miss any part of our discussion that we are going to make today. Very important. See here. What is the name of the model? Free cash flow model. Study material has given the entire content like that, but they didn't try to make any reasonable explanation on that concept. But in the book I have written everything. Starting from here, some important noticeable points I will show you. You can note it down. How this concept has come. There is a concept called as total fund approach versus equity shareholders approach. Have you heard about this or not? So concept I will discuss later. Leveraged approach and unleveraged approach. In that not levered from unlevered from in portfolio. Leveraged approach, unleveraged approach, or geared company, ungeared companies. Okay. In that total fund approach and equity shareholders approach, understanding the difference between both of them, then coming into the concept. That's why I have clearly given in-depth analysis using an illustration. After that, we will be coming into the tax shield interest components. Later, the formulae. Lastly, again explanation, then problems. Free cash flow is a big world in itself. Okay. See the screen once. First point number 1. Look at the screen. These are the 4 formulae which will be used throughout this discussion of 5 problems. I give you guarantee, do free cash flow in the class today. Take any question that is given in the past examination, you will be able to do without seeing the answer. But first point, we need to understand the concept, the formula, the derivation, everything clearly. Shall we continue? See the screen once. There are 4 formulae given. Number 1, free cash flow for firm. In that, free cash flow for firm has 2 formulae again. One is using PAT, another one is using EBIT. Tell me, PAT using, what is the formula? PAT plus depreciation plus interest after tax plus or minus capex. Sir, I sell the asset. Plus capex or minus capex? Plus capex. Cash will come. మనం చేస్తున్న మోడల్ ఫ్రీ అసెట్ మోడలా, ఫ్రీ క్యాష్ ఫ్లో మోడలా? That means we need to check about assets or cash. So if I sell, cash will come in or come out? Obviously add it. That's all. Okay. Capex negative means what? Cash flow going out. Cash flow going out is called as a capex negative. Next one. Plus or minus? Plus or minus changes in working capital, not working capital. Plus or minus changes in working capital. Okay. Using EBIT. Tell me, what is the formula using EBIT? EBIT into 1 minus T plus depreciation plus or minus capex plus or minus changes in working capital. Okay. First listen. Before we go into this, I will first explain you certain important concepts, understand them, and then after we will go into the next one. Tell me, what is a primitive way of valuing a share? What is the primitive way of valuing a share? P not equal to? That's all. That's called as a primitive valuation model. P not equal to D1 by KE minus G. D1 by KE minus G. First point number 1. You can copy all these later. Some people are copying this when I am discussing. At the time of discussion, if you write, at the time of writing, you will start discussing with others. Because you couldn't understand the concept. Please listen first. Concept is not that easy. Please see there. So the point number 1. The concept name is called as a free cash flows. Now tell me, a basic valuation model is P not equal to D1 by KE minus G. That's a general valuation model. That general valuation model is suffering from some deficiencies. Deficiency number 1, it considers only growth companies. Number 1. Clear? Second, very much a difficult problem is growth can never be more than KE. KE minus G la, G is more than KE. What will happen in the denominator? Negative. Yes or no? Can share have a negative value? Mathematically, denominator can have negative, but share la negative can be there. No, that means model is efficient or deficient. Deficient when the growth in a company is more than the cost of capital of that company. Everyone understood the point clearly. Very good. Next, do you know when it happens? Banks. Banks, when you value, banks cost of capital is very cheap because they borrow from RBI where the interest rates are only 3.5 or 4% for them. Listening everyone. But the growth of a bank will be somewhere around 12%, 13%. Then if you reduce the KE minus G, the problem is G will be more than KE, which results in a negative value of a share of a bank. So banks don't follow that. Clear everyone? These are practical impressions on deficiencies of Gordon's model. D1 by KE minus G. So D1 by KE minus G, did we see the derivation or not? Entire derivation, dividend is common or not? My company is a non-dividend paying company, then what will happen? I don't pay any dividend. My company don't have a habit of paying dividend. D0 is 0. Will there be a company without paying any dividend? Microsoft hadn't paid even a penny of dividend till date, but it's still the darling of the Wall Street. So how? Because they propel growth. The share price is growing like anything in USA. Wall Street, one of the Wall Street journals will be released every month. Every month it is a listing. I'm talking about in the last 20 years, every week in the Wall Street Journal, it is standing one in the top of 10. How? Not paying any dividend, but still it is gaining its value because of growth, capital appreciation. So tell me, I can pay dividend on par value or market value? Answer. My par value is 100. Maximum how much dividend I can pay? Answer, sir. My share price is 10,000. Okay. It will increase by another 500 rupees. Now you will go for 100 rupee dividend, 500 capital appreciation. Obviously, people want only capital appreciation. That's why people like bonus shares than dividend. Here or not, everyone? Sorry, okay. Now, listen carefully to the point. Bonus issue, all these leave off. Main point is, can there be company without paying any dividend? Answer. In that case, I have no dividend in the past. No intention to pay dividend even in the near future. Now tell me, my D1 will be some number, 0. Then my share price will be? Obviously, D1 0. What is the share price? 0. Microsoft share value is 0. Then, therefore, there are a lot of, listening everyone, there are a lot of deficiencies in valuing through D1 by K minus G model, which requires some alternative. Okay. Next, last question I am going to ask you. Tell me, you are an investor investing in the shares of a company. You are an investor investing in the shares of a company. Now tell me, if you are an investor investing in the shares of a particular company, you will look into the dividend, you will look into the sales, revenues, profits, depreciation, all these things, or you will look into dividend. Answer, you will look at the dividend. DPS you want. Whatever company do, I don't care. But at the end of the day, I need my dividend. Listening or not? Tell me, if you are a investor, you will look for dividends, entire income statement. You want only dividends. Dividends want to be paid. Now listen carefully. X Limited is in dealing of merger with Y Limited. Who want to acquire whom? X wanted to acquire Y. Everyone answer. X want to acquire Y, or X want to take over 70% equity of Y Limited. Who want to acquire? Which how much percent? 70% of Y Limited. Section 235 of Companies Act. Take over bid. Dissenting shareholders 90% approvals of those who send the notices. Section 235 subsection 1. So it will be discussing on merger decisions in a company. 235(1). So listen carefully. Under section 235(1), companies can also go for a takeover bid. Takeover bid means balance sheet is essentially same. Assets don't get transferred, liabilities don't get transferred. I will just take over the equity of a company. Are you understanding or not, everyone? What I will acquire directly? Equity of a company. When I acquire equity of a company, merger will happen, takeover will happen. Sir, coach eక్కడ ఉన్నాను సార్ ఈ లోకల్లో. Balance sheet of X Limited, balance sheet of Y Limited. Y Limited assets are taken. Y Limited liabilities are taken. Y Limited became dissolved. This is a merger amalgamation. Clear? X Limited, Y Limited balance sheets are there. X Limited assets are there, liabilities are there. Y Limited assets are there, liabilities are there. Essentially everything is same. Y Limited share capital is now taken by 1 lakh. Now I am purchasing those 1 lakh shares. Or I am purchasing 70,000 shares. This is amalgamation merger, takeover. I am taking over company, I am taking over company shares. Ownership is changing, total company changing. Like that also I can control a company or not. Now you should only answer my question clearly. Everyone in the class, please see here. Tell me, when I am acquiring 70% of the total shares of a particular company, I will become holding and that company will become subsidiary to me. Yes or no? X Limited acquire how much of Y? Then Y Limited will become what? Subsidiary. To whom? To whom? It will become a subsidiary company to X Limited or not? And now listen to my answer. Please follow up. Now, if I become a subsidiary company, if I become holding and that company becomes my subsidiary company, all decisions, majority decision making will be in the hands of X Limited or not? Point number 2. Point number 3. Now tell me, when I am having 60%, 70% of the total capital of a particular company, listening, I am having total 70%, 60% capital is held by me. Answer my question. Ordinary resolutions can be passed by one single company being X Limited or not? Tell me, in a general meeting, annual general meeting, dividend declaration requires an ordinary resolution or not? Answer. Now tell me, who will say yes, dividend will be paid? If X Limited say yes in the general meeting, dividend will be paid. Yes or no? If X Limited say no, that means dividend whether to be paid or not to be paid is in whose hands? Then why I will take dividend as a base for my valuation? When something is in my hand, why it becomes a base of valuation for me? D1, whether should be there or should not be there is in whose hands? That's all. If I say yes, say dividend will come. If I tell no, dividend will not come. Whether to come or not to come is in my hands. Then why I will be bothered about dividend valuation? Science. So therefore, out of all these things, people found that it is undesirable to use P not equal to D1 by K minus G when there is a takeovers and acquisitions. So when takeover and acquisition is there, instead of P not equal to D1 by K minus G, what model we have to use is becoming a question. Then they thought that, can we go for EPS model? No. EPS model also you can't go. Okay. Why? A question arises. So, okay, DPS don't take, at least take earnings as a base. Clear? What we need to take as a base? Everyone. Earnings as a base. Take earnings as a base. Take earnings as a base. They said that no, we should not take earnings. Profits. Earnings means profits. Take profit as a base, not dividend. Take profit as a base at least. No, profits we cannot take as a base. Profits adjusted can be taken as a base. Listening or not, everyone? Profits I can't take. Profits adjusted I can take. Okay. So adjusted what? Adjusted to non-cash flows I can take. That means, listening sir, everyone, tell me, capital budgeting, dividend chapter, I mean security valuation, corporate valuation, bonds, whatever we have done till now. First column year, second column, why not profit? Always why we write cash flows in SFM? Why always SFM considers cash flow? Non-cash, I know. This is the answer always I will get. Sir, understand this point also. Listen carefully. See here. Example sake I am telling you. You can understand in a way why always cash flows will be superior to that of profits. Capital budgeting, all these things leave off. SFMA considers what? Cash flow. Wherever you see cash flow everywhere. Clear? See here now. Tell me. I am a person or a client who came to you. I asked you one question. Sir, please prepare a P&L account for me because I am going for a bank loan. I asked you. Clear, everyone? I asked you, please prepare my balance sheet and P&L. Okay? Bob, prepare this one day. Please prepare me a balance sheet and P&L. You said that, okay, we will prepare. Then you asked, what assets do you have? I said, sir, I have a factory building. I have a land. I have gold. I have shares. I have some stock of inventory. Like that, I have given all my details to you. Clear? Now, you asked me, did you get your books audited before? I didn't get it. My factory is not working that well. So I am not into the tax audit limit. But definitely we will go in future to the tax audit limit. So please prepare a balance sheet and P&L for me. Is that okay? I will prepare. So factory building. Sir, factory building is subjected to depreciation or not, everyone? Answer. But there should be some life or not? Life should be there or not for that? Life is a guarantee, accounting estimator. Stock valuation is a guarantee, accounting estimator. FIFO and LIFO are not exact. Those are also estimated, but scientifically proved estimates. Rather than making whatever you want in stock valuation, a systematically prepared models are FIFO and LIFO. Clear? Now tell me, provisions, estimator, guaranteed. Answer, sir. Contingencies, very good. Depreciation rates, all these are estimates only, scientifically proved estimates. But clear? Life of an asset. Now listen carefully, sir. Please listen carefully. Point number one. I have a asset. I have a asset. Sir, I am a client. I went to two chartered accountants. Listening. I asked the first chartered accountant, please prepare my balance sheet P&L. I also asked second chartered accountant, please prepare my P&L and balance sheet. Both the chartered accountants will end up with same profits, different profits. For a same person, both of them will get the same profit, different profits they will arrive at. So tell me, two chartered accountants preparing the balance sheet of a same company will get same balance sheet answers, same P&L, different. Definitely different. Because my estimates are different, your estimates are different, my depreciation rates are different, my depreciation life is different, you are taken life is different. Like that, so many factors that there can be a changes. My presentation will be different, your presentation will be different. Both of them will get the same answer, different answer. Yes, they will get two different answers. Clear? Okay, now answer. See this. What is this? 500 note. What is this? Another 500 note. Tell me. So listen, sir. No fun here. Please listen carefully. I asked her, what is the total value of this currency notes? 1,000. Very good. How much? Everyone tell me how much? Why it is not changing between person to person? Because these are cash flows, not profits. Are you understanding or not, everyone? Because these are cash flows. These are not profits. Okay? Reason number one. Why SFM consider cash flows? Reason number two. Tell me, I've taken this 1,000, deposited in a bank. Deposited in a bank. Okay? After 1 year, I will get back 1,000. I will get back more than 1,000. What they will pay me in excess? Interest they will pay. Clear? Okay, now tell me. I have deposited one chapel in locker. Seriously, I have given one chapel. Put it in a locker. After 1 year event, will they give another extra slipper? At least a big size slipper? Put small size? Slipper అనేటప్పుడు మీకు ఇదేదో జోక్ లా ఉందనో లేకపోతే ఎటకారంగా ఉందనో అనుకున్నారు కదా. సరే, లెట్ us interchange the same with your known example, gold lockers. A chapel means, okay, you found it more obnoxious, perplexed to listen to an example. Now answer, it is not like that. Gold you deposited here, 1 kg gold you have deposited in a locker, they will give you 1 kg plus 0.00001 gram extra. Na? Gold ki they don't give extra. Why they will give extra to a cash deposit? Because cash is subjected to inflation, not the products. Inflation can affect cash flows. Inflation don't affect the products. So tell me, this iPad cost last year, this year will be same, will be more? Answer. Answer. Now tell me, iPad is subjected to inflation or not? No. iPad amount is subjected to inflation. iPad is not inflated. Are you understanding or not? Sir, iPad inflated means iPad size inflated. At 12.9, 13-inch iPad becomes 16-inch iPad. Inflation. 10% inflation means what? Oh, 13-inch iPad become 13 plus 10 means, oh, 14.3 iPad. Sir, pen cost in the last year. Pen cost 50 rupees. Pen size inflated. Inflation will affect the product. Inflation will affect the cash flow to buy the product. So, answer my question now. Profit is like a product. Cash flow is like a cash flow. Therefore, it will affect what? Inflation will affect cash. Inflation will affect the assets. And the products or cash. Cash is only subjected to inflation. Everyone understood the point clearly? This is another reason. Third, last example for you to understand. I take a paper. And on that paper, I will give a letterhead. Okay? So and so, Suresh Siva and Co Chartered Accountants, Hyderabad, Vijayawada, I will give details. My firm. I will write a P&L. I will prepare a P&L. End profits after tax I will write. And the net profit you call in your general scenario. Clear? 10 lakh net profit. How much? 10 lakh net profit I have written. Signed. Chartered accountant is signed. Membership number given, seal given, stamp given, everything done. Listen. You didn't holler everything. Okay. Everything done. Listen. Approved financials are unapproved financials are. Approved financials. AGM shareholders also approved this. Done. I took that P&L account. I gave to the banker. I said, please deposit these 10 lakhs. Please take a deposit. Yeah, sir, where is deposit? There. See. Enakamal. So, there, see. So I asked, where it, Enakamal, you see everything. So listening everyone. So see there, you turn at the last code better. So you will see last page, you go, you will find my signature, chartered accountant approved documents here. Why you are questioning me? How much is the profit approved? Answer here. I said, please take this 10 lakhs, make a deposit. He asked, sir, where is your money? There. Where? There. There is money, no? No. So, listen carefully. Now tell me, though it is for a fun sake you understood, but tell me, will any bank accept that profit amount approved by a chartered accountant and deposit the 10 lakhs? What they will accept? Cash flow is only subjected to return, not the profits. Profits don't give returns. What will give returns? You deposit same 10 lakh cash, they will take a deposit. But same profit approved by a chartered accountant, if you deposit, they don't take. Now tell me, profits superior, cash flow superior. That's the point. That's why SFM considers cash flows from the very beginning. Okay, which are more accurate. Cash flows are more accurate measures. So therefore, free cash flow models have started, not free profit models. Clear everyone? So cash flow models have started. Once we have to understand this, see here now. So look at the scenario now. Very complicated concept. 5 minutes I will complete, 5-10 minutes discussion I will complete. Problems you have to solve. That takes some time. 15 minutes time it will take to solve each problem. But still, answer to my question. We are doing profit model, cash flow model. D1 is dividend. Dividend is a small particle of profit. Are you understanding or not? Dividend is a small particle of a profit. Sir, dividend is also called as a divisible profit. Also called divided profit. That means it is only profit. It's not a cash flow always. Clear or not everyone? So, listen carefully. Whenever we have to calculate the value of a firm, I have to sit and start projecting the company's future. Because I have to do Bhavishyavani now. Because I am not just estimating a end result called as a D1, I have to estimate everything about the company. Clear? When I say I have to forecast the future, I have to forecast the company sales. Because, try to understand clearly, cash flow will not come from sky. Cash flow will come from sale. Sale generates the first cash flow. What generate? Sale cash flow, what we deduct? Expenses. We get EBIT. Answer, sir. EBIT will be shared by debt. That will be shared by government. That will be shared by preference. After that will be shared by equity. Listening. That means to get a last cash flow, first we need to have the sales. Therefore, free cash flow models concentrates on analyzing the dividends, analyzing the cash flow. So what is the source of a cash flow? Therefore, they should start projecting from the company's sales itself. That's why in all your free cash flow question, first they will give revenues and sales. See there, in all your free cash flow question, they will give revenue and sales first. You can see. Institute what mad I kadu, but mananta telivita leni vadu kadu. So he has prepared questions correctly. We don't understand that in a right sense. That is entirely different story. So he want to convey correctly. Start projecting from the sales of a company. Don't start from the end result. Okay. So when I start projecting, I should start projecting from the company's future. Future means I need to take the present of future sales. Now tell me the entire income statement. Sales, variable cost, contribution, fixed cost, EBIT. Okay, and now tell me, okay, 1 second. Sir, contribution is a variable. Contribution is a fixed cost, is a constant. It will not change across any cost structure. Whether you use high raw material or lesser raw material, do the production or do not do the production, increase the capacity or decrease the capacity, fixed cost is always the same. Clear or not? So, first thing I can do when I have to calculate the cash flows from the income statement, I can take the cash flows in two ways. I can take EBIT as a base. I can take profit after tax as a base. I can take EBIT as a base, or I can take profit as a base. Again, I am repeating. I want profits or cash flows. Answer. When I want a cash flow, I can analyze the cash flow in two ways. Number one, EBIT model. Number two, profit after tax model. Profit after. There are two models here again. Again, sub-models are divided. One is called as free cash flow for firm, free cash flow for equity. Free cash flow for firm and free cash flow for. Now tell me, free cash flow for firm. Firm means equity or debt or both. That means we need to calculate availability of cash flow for payment to the both. Simply, free cash flow model, free cash flow for firm model is also called as V model. WEV. Are you understanding or not? Free cash flow model is also called as V model. Free cash flow for equity is called as ME model. These are officially approved in CFA curriculum. So you need not question on that. V model means andaram. ME model means nenu. Are you understanding the concept or not? Tell me, what are the two models? V model, ME model. V model means we consider debt also as a owner of the company. We consider debt also as a owner of the company. Okay, ME model, only equity is a owner. V model and ME model, in other way around in our institute book, they will write as V model, they will write as a free cash flow for firm. ME model will be written as a free cash flow for equity. First point, everyone understood or not? Tell me. Okay, na? So last conclusive discussion. Listen carefully. Listen carefully, sir. Is PAT a cash flow? Is PAT a cash flow directly? PAT has so many non-cash items inside this or not? What is the first popular non-cash item? Everyone, depreciation. Depreciation is the first cash or non-cash? Non-cash. Sir, after decreasing, after adding, don't see the formula. Okay. Don't see the formula. I want your logical answer. Tell me, depreciation is a cash flow or non-cash flow? Very good. Depreciation is a non-cash flow. So depreciation we have to consider, we should not consider. Are you understanding or not? Why depreciation should not be considered? Adu sir. Adi manakala artham kavadaniki peddavalu ala chepparu ante. Elders have said that to make us understand. Do you know why? Capital expenditure you are deducting means that capital expenditure part say depreciation. Inka velakapothe 2 minutes silence. Total, sir, depreciation will come from capital expenditure or revenue expenditure? You are already reducing capital expenditure or not? In that means in future that only will be broken into depreciation or not? When you are considering capex already, why again depreciation? Are you understanding or not, everyone? Did you understand the point or not? Sir, asset I consider. Again, I have to consider depreciation. Asset I am deducting as a outflow means already the asset is reduced. Asset will be broken into small parts called as depreciation. Again, if you consider depreciation, what will happen? It will result in double deduction. Therefore, we will add. Adi reason. Non-cash le pakkan mettandi sir. Non-cash ante meaning ide. You are not spending cash again. Are you understand the point or not? Enter Maya lokam. So Point number one, tell me, PAT is a cash loan, not a cash loan? PAT is a cash loan, not a cash loan? PAT is a cash loan, not a cash loan? What is the first waste expense? Depreciation. Because already what you consider? Now listen carefully. Now listen. I will add back depreciation, taking it as a non-cash. Means no cash really spent. Non-cash means that is the meaning. Already spent, I am not spending again. That's the meaning of non-cash. Okay. How can you tell depreciation is non-cash? Already cash is spent. Again you are not spending. That's the meaning. Clear or not? What is the meaning of perpetuity? Never ending. Yes or no? No, it is ending. I don't know the end. కింగ్ఫిషర్ ఉందా ఇప్పుడు? సత్యం ఉందా ఇప్పుడు? మరి పర్పిచుటీ ఎక్కడైంది? అంతం లేనిది కాదు పర్పిచుటీ. అంతం ఎక్కడో నాకు తెలియదు. దెర్ ఈస్ అన్ ఎండ్. ఐ డోంట్ నో ద ఎండ్. దోస్ ఆర్ కాల్డ్ as perpetuity. Nothing is perpetual in the world except God. So therefore, how can you tell that companies are perpetual after all? Incorporated under bloody Companies Act. So therefore, వదిలేండి, వేదాంతంలోకి వెళ్ళకండి, బ్యాక్ వచ్చేయండి, ఉన్నదే ఏడలేకపోతున్నాం. సో ఫస్ట్ పాయింట్ నెంబర్ వన్, PAT is a cash loan, not a cash loan. Very good. Why? PAT is not a cash loan. Why? It contains so many non-cash items inside it. Yes or no? Sir, I added back depreciation. Then PAT is a cash flow or not? Why? Working. అంటే అన్నానంటే నేనే. Tell me, in P&L, working capital will come or will not come? I am asking profit after tax. Means I am talking about balance sheet of P&L. And restrict to that point. Okay. So tell me, in your P&L, you have to consider PAT. You added back depreciation. Okay. Is there any deduction which is there still, or addition or deletion? Answer. We are valuing free cash flow for firm normal profits. Firm free cash flows you are calculating. Yes or no, everyone? Now, the thumb rule always you remember. Okay. Point number one. Profit after tax is not a cash flow. Reasons are very clear. All the cash inflows and outflows are not projected in PAT. Reason. Capital expenditure is a cash inflow or cash outflow. Capex outflow, but not coming into P&L. Therefore, we are deducting here. Profit after tax is a cash flow. I will ask same question till you answer properly. PAT is a cash flow, not a cash flow. First add back what? Add back what? Depreciation. Okay. Now we are taking free cash flow for firm equity. Firm. Firm is who is also a owner. It is also a owner. That means we are calculating the cash flow available for whom? Both debt as well as equity. Both debt as well as. When you calculate the cash flow available for both debt and equity, don't take the payments made to the debt, therefore add back interest. Okay, answer here everyone. Add back what? When you add back interest, you should add back with the tax or without tax. So excluding the tax you need to value. Excluding the tax. Logic is there, but adi gantal veltanu okay oka reason valla I am controlling. See here, I have given a clear analysis. See here, why interest, why tax will be always considered. I have given an in-depth analysis here. Why this will be considered? See here, interest is not an outflow, but it is an appropriation, like that I have given. See here, what is the question I asked here? Why should we add only I into 1 minus T? I have given the clear reasoning here. Illustration impacting the discounting, like that I have given. But I am not considering that. Because if I touch that now, it will minimum take another 30 minutes, which is not the spirit behind the revision class. Therefore, I am not dealing with that. First, remember this. This is point. Add back interest after tax or before tax. Answer. Yeah, there is a reason for that. Good reason is there. Why they are doing like that. But as of now, exams point of view, tell me, what is the formula? First, PAT is a cash loan, not a cash loan. Add back. We are calculating FCF, FCF, who is also a owner. Therefore, payment made to them should not be considered. Okay. Plus Interest. Sir, by calculating PAT, already interest is deducted or not? What you have to do now? Add back. When you are adding back, interest should be taken with the tax or after tax. So I into 1 minus T over. Next, capital expenditure is a cash inflow or outflow now. Sale of asset. These both inflows are considered into P and L, will not be considered. But those are outflows and inflows are not. Now you consider them. Therefore, sale of asset, add, capital expenditure, deduct. Listening or not? Now tell me, sale is considered in, sale is a cash flow or not? Sale need not be credit sales, will be reflected in creditors. Purchases is a cash flow, need not be, credit purchase is a debtor. Therefore, make the changes in working capital. That's cash flow. Understood or not, everyone? Tell me, what is the formula now? From profit after tax. Use your brain. Nothing more. First, profit after tax plus depreciation plus interest after tax plus or minus capex plus or minus changes in working capital. Answer over. Now, tell the same from EBIT point of view. Common sense are required. EBIT is before interest or after interest? Do we need to add back interest once again? Tell the formula now. EBIT. Don't do EBIT. Tax government is collecting. Okay, EBIT into everyone. EBIT into 1 minus T plus depreciation plus or minus capex plus or minus changes in working capital. I will answer. This is how you should remember. Understood the point or not? Let's do the problems now. Take question number. In your book, what is the number? First, this I will show you the question. You tell me the number so that all the others also can see. This one. Question 7, study material. So, institute study material, question number 7. 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 Okay. 1 second. Don't get excited unnecessarily. First point. One question we will do together. Second question I will give you a chance. You do. If you do mistakes, I will do something on that. Okay. First question. Let us do together. We approach. Let us do. Okay. Sorry. Okay. Let me do. 21. In my book 21. In study material 7. Read. Following information is available in respect of XYZ Limited, which is expected to grow at a higher rate of 4 years, after which the growth rate will stabilize at a lower level. So tell me, we will start here. You should not take I am holding the share for 5 years, not like that. Here I am estimating or forecasting the company future or not. Sir, I can gauge the market maybe for 1 year or 2 year or 3 year or 4 year I can gauge. After that it will be very difficult for me to project the future. After that I will assume a perpetual growth at a lesser rate. Clear? So therefore let us start. So tell me, how many years is a variable growth? Answer, sir. How many years of perpetual growth? From there till infinity. So first see that. Base year information. What year information, sir? Base year. Okay, tell me. What is the revenue? Sales 2000. In that EBIT is 300. Capital expenditure is 280. Depreciation is 200. Tell me. Growth in revenue and EBIT 20%, 10%. Sir, what you can understand? Growth in EBIT, revenue and EBIT 20%. There is no fixed cost. There is no fixed cost. Then only revenue and EBIT will grow at same rate, or else they will not grow at same rate. ఏంటి SCMP లో ఉంటుంది కదా ఇది. Financial break-even points, all these things. Then read. Growth in revenue and EBIT 20% and 10%. Growth in capital expenditure and depreciation. How much? 20%. Capex offset by depreciation. This adjustment I will tell you how to understand. Next, risk-free rate. How much? 10 9 equity beta, market risk premium, post pre-tax cost of debt and debt equity ratio. Point number 1. Can we calculate without any knowledge WACC calculation or not? Can we calculate post-tax KD? Can we calculate KO? Sorry, first one KD. Can we calculate KE? KO? Can we? Let us do those three first. Start. Give a better presentation than what institute does. Make it clear. Your answer should be more clear in its intent. Start from the beginning, one by one. Step 1. Calculation of post-tax KD. Calculation of post-tax KD. Particulars. Variable growth, stable growth. Particulars, variable growth, stable growth. Particulars, variable growth, stable growth. Completed, huh? Next. Variable growth and stable growth. Tell me, first one, what is the pre-tax KD? Answers are two. See and tell. 13% and 12.86. What is the tax? 30, yeah? Tell me what is the post-tax KD. First one. 9.1. Okay, next. 9. 9%. Next. So we completed step 1. First, everyone answer step 1. Everyone completed. Don't be very busy in copying the answers. Please, sir, we are having exams. Please do on your own. You check the answers. Step 2. Calculation of KE. Variable growth, stable growth. Tell me, what is the formula for KE? RF plus beta into RM minus RF. Help me with the numbers. What is the RF? Check చేసుకోండి సార్, మార్చినట్టున్నాడు. There is a change. 10 9. Okay, tell me what is RF? 10 plus 1.15 into R means are directly given 6. Tell me what is the value? 9. 9. Okay. Next. 10 9. 9 plus 1 into 5. So that will be equal to 14%. Write down. Step 3. Make it fast. Step 3. Calculation of WACC. Calculation of WACC. Variable growth, stable growth. Okay. WD KD plus WE KE. Tell me what is the WD KD WE KE. What is the WD? Half. 1/2 into 9.1 plus 1/2 into 16.9. Answer please. Next, same thing. Change in the percentage. 2:3. 2/5 into 14. 9. I don't have information. I will write what you say. Next, 3/5 into 14. Please tell the answer. WACC. First to do up to here. Sir, like this, if you do in exam, stepwise marking will be given. Don't anticipate. Uhinchukokandi. This will not get a mark, therefore directly you calculate and put the number there. Half mark gone. Like that in the paper, minimum 10 halves gone, 5 marks gone. Don't assume anything. Put everything on a paper. So that's why, see here sir, one second. In the book I have clearly given stepwise, because markings are given on stepwise basis. Step 1, calculation of post-tax KD. Step 2, small calculations also do in the exam. Okay. So calculation of KE, calculation of KO, like that you have to do everything. Clear? Let us start, sir. Next. Tell me, step number 1, 2, 3. Everyone had a clarity, yeah? Next. Step number 4. Sir, nothing you need in brain. Tell me, what are the things we are going from EBIT point of view, PAT point of view? EBIT, PAT point of view. EBIT, tell the formula first. EBIT into 1 minus T plus depreciation plus interest after tax minus plus or minus capex plus or minus change in working capital. Here we require two information. One is a capex information, working capital change information. Yes or no? Those become next working notes. Step 4, step 5. So first step 4. Keep the heading. Calculation of capex. Calculation of capex. Calculation of capex. Write like this: year 0, base year 0, 1, 2, 3, 4. Write down P later. What do you mean by P? Perpetual growth period. Okay. If you present like this now, it will be easy for the valuer also to understand what you are trying to say. Tell me, what is the growth during this period? What is the growth during this period? 20, yeah? What is the growth during this period? Offset ichada. Okay. Okay, no problem. So offset by depreciation. So up to here everyone has done. If you are okay up to here, I will go to the next one. Can I do the problem, everyone? One second, see here. First, we need to have capital expenditure details. So growth in capital expenditure is how much? What is the base year capital expenditure? Write down. Capex 280. Tell me, 280, I will also do along with you. 280 plus 20%. How much? 336. Plus 20%, 403.02. Plus 20%, 483.84. Plus 20%, 580.61. 580.61. Don't write the perpetual. Don't write the perpetual. First, everyone understood up to here or not? Perpetual. Right there in the perpetual, offset by depreciation. Means what? The capital expenditure, what extra you put in a year, will be offset by the depreciation on total assets of a company. Means how much depreciation will come on all the assets, including this addition, will be assumed as equal to the capital expenditure extra you put every year. Clear, everyone? Therefore, that's the assumption only. In real life, it will not happen. But how many years you can gauge the market here? 10th year, how much capex you put? How can I tell today? Listening or not? These are all logical, scientific assumptions. Clear? So total total depreciation on all the assets. Say it came to 1,000 crores depreciation, 20%, 30% rates. Yeah. Extra capex on a particular year you are putting around 960 crores, something around that. 10th year time. Because 4th year you are keeping 580 crores. Listening or not? Maybe 10th year time you are putting a capex of 980, 970 crores. Total assets, the depreciation amount is also coming to how much? 1000 crore. Rather than assuming like that, 1000 and 970, 980 are nearing to each other or not? Now tell me, in calculation of free cash flow, depreciation is added back or reduced? Capex will be? Answer. Therefore, if I assume that both are almost the same, that adjustment can be avoided or not. Therefore, capex minus depreciation will be taken as 0 in the perpetual period. Understood or not, everyone? Okay, done. Next, step 5. Market important adjustments, working capital adjustment. Calculation of change in working capital, not working capital. Change in working capital. Write down. Year 0, 1, 2, 3, 4 and perpetuity. Write down clearly. Year 1 to 4, what is the growth rate? 20. What is the growth in the last? 10%. First tell me, working capital in the base year. How much is the working capital in the base year? Sir, please see there, 25% of the revenue. First write down, I'm very sorry, don't write working capital then. First write down revenues. Please write revenue. What is the base year revenue? 2000 plus 20%, 2400 plus 20%, 2880 plus 20%, 3456 plus 20%, 4147.2 plus 10%, 4561.92. My calculation is done. Have you done or not, everyone? So, what is the proportion of working capital in this? 25%. Tell me, 25% of 2000. 5000 into 2000 into 25%. How much? 500. 2400 into 25%. How much? 1600. 600. 2880 into 25% equal to 720. 3456 into 25%, 864. 4147.2 into 0.25. How much? 1036.80. Next, 4561.92 into 25% is 1140.48. Clear? Sir, I am going little bit fast, but still okay. Everyone understanding the concepts? Now, answer my question. This is a working capital. Yes or no? Answer here. This we have to take into the free cash flow table. Yes or no? No. This is working capital. We want working capital. Changes in working capital. Write down. Changes in working capital. That's why I told you this is important. This is 0, 100, 120, 144, 173, 2.8, 103.68. Have you done or not, everyone? Up to here. Can I go to the next step? So tell me, what are the ingredients required for the final product? EBIT into 1 minus T. We can directly calculate there itself. Second one, depreciation. Calculate. Depreciation we didn't calculate, kada? Let us do that. Step number 6. Calculation of depreciation. Year 0, 1, 2, 3, 4, P. Tell me now, what is the base year depreciation? Given in the question already, you can see there, how much? 200. Next, tell me, 20% increase, how much? 240. 240 plus 20%, 200. 88 plus 20%, 345.60 plus 20%, 414.72. Perpetuity offset, don't calculate, waste of your time. Okay. This is what? ये क्या है? Depreciation. So now tell me, finally, are we ready with preparing the final dish? All ingredients are available. See, check properly, or else the taste will be very bad. EBIT is a main bond here. EBIT. It is not ingredient here. It is a source. All ingredients are ready. Masala prepared. Shall we cook the final product? Let's. God grace should be on us. Let us do it correctly. Here. 0, 1, 2, 3, 4, P. 0 here is only for your clarity. Exam you need not do. For your clarity, I am writing that. Okay. So G equal to how much here? 20. Here G equal to how much percent? 10. Everyone, first take calculators. Tell me what is the base here EBIT into 1 minus T. 2000, sorry, EBIT anta 300. 300 into what is the tax rate? 30 means 0.7. How much? 210. Directly to this 210 you can add 20, 20, 20, 20 now. 210 plus 20%. How much? 252 plus 20%. 302.4 plus 20%. Plus 20%. 435.46. Okay. Plus 10%. 479. First calculate up to here, everyone. Calculate. So this is how we need to do. Hope everyone understood the concept clearly. Right? So, see here. Information when you take. First, what are the steps we have done? Tell me. First, step number 1. Post-tax KD. Next, KE. Next, KO. CapEx, depreciation and changes in working capital. Sir, one by one we have considered. Everyone understood the concept clearly. Yeah. Okay. Sir, I have done separately EBIT, but here I have done directly. The answer, sir. There I have presented separately, but examiner you can directly write EBIT into 1 minus T. Okay. Sir, okay, now tell me. Up to here everyone understood? Now, to this, what we need to add or deduct? Add what? Tell me, what is the depreciation? Sir, 200. Next year, 240, 288, 345.60, 414.72 offset. Yeah. Next to this, what we need to deduct? Capex. Change in capex. Capex. Tell me, what is the capex? Capital expenditure. First, tell me, 100. 280 first. Next, 336. 402. 483.84. 561 offset. Next, working capital, all are positives and negatives. All are positives and negatives. Represents a outflow. Represents a outflow. Tell the numbers. Working capital changes. Tell me what is the numbers. First 100, 120, 144, 8. Tell me what is the free cash flow for firm. First one don't tell. 0 here I am striking off. Now tell me for the first year on. How much? నేను చేసుకుంటానండి క్యాలిక్యులేషన్. 56 67.264. Next 0.32. Up to here, do and leave. First, sir, what we calculated now? Free cash flows for the firm. First, everyone tell me understood up to here clearly. Everyone understood up to here clearly. Now, listen carefully. Tell me, we want a perpetual value for this or not, everyone? Tell me, from the perpetual period, it will grow at the same rate, yes or no? Okay, I am first erasing this. First tell me. Formula, P naught equal to D1 by KE minus G. Very good. Next, P4 equal to divided by KE minus G. Okay, keep aside. Likewise, value of a company equal to free cash flow for firm 1 divided by KO minus G, because we are taking both debt and equity. Answer, sir, everyone. Next, I want value of the firm at the end of first era, second era, third era, fourth era. Fourth year ending, I want. Okay. So tell me how to calculate. FCFF 5 whole divided by KO minus A. Sir, FCFF 5, how can I write? Sir, we have FCFF 4 or not? Everyone in the class, tell me how to write. FCFF 4 into 1 plus G whole divided by KO minus G. What is the FCFF 4? 96.77. Continue. Into what is the growth in the stable period? How much? 1.10 whole divided by what is the KO during the stable period? 12% minus 10%. 18,766. ఆయన మహానుభావుడు బట్టి కొట్టేశాడు, లేదా బుక్లో చూసి ఆన్సర్ చెప్పేశాడు. ఒక్క నిమిషం ఆవేశ పడుకో, అక్కడే ఒక పాయింట్ ఉంది, అది చెప్తామని. సో టెల్ మీ 96.77 into 1.10. 106.45 divided by 2%. 5322.3. Wrong. Like this we should not do. Why? I'll explain you, sir. Very important point in this question. See, in reality, we have 96.77 in the fourth year FCFA value or not. Generally, as a flow, we will do that as well. But here, in these cases, we should not do. Why? Why? అస్సలు కాదు. CapEx is offset against depreciation only in the variable growth, not in the stable growth. If you take 96.77, it is considered depreciation capital expenditure. Anduku. So the reason is 96.77 has considered depreciation capex or not. But stable growth, there is a offsetting depreciation capex. There is a depreciation capex also in stable period. Then if you take 96.77 to perpetuity, it gives a meaning that you are also taking capex and depreciation to perpetuity. That's why you should not take 96.77. You should take directly this amount. Instead of taking, అందుకు చెప్పేది బట్టి కొట్టకండి SFM ని. బుక్లో అలా ఇచ్చాడు కాబట్టి ఇలా బట్టి కొట్టాలి, దీనిలో గుర్తుపెట్టుకోవాలి, అయిపోతావు. Then flowలో, do you know what the people will do? Capex offset depreciation, if not given also, they will do in the same way. Do you understand the problem in mugging up of questions? So I always see lot of students in SFM only where they will mug up the model. If given like this, do like this. If given this way, do this way. You have to understand as per the logic of the question, move on. Why we should not consider 96.77 into growth mean? There is a logic behind that. 96.77 calculation, if you observe, capex is there or not there? There. Depreciation is also there or not? But as per the question, there should be offsetting capex and depreciation in the stable period. If you consider 96.77, what meaning will it give? You are again considering the depreciation and capex or not. Everyone answers, sir. Therefore, don't do this way. If question is given like this again, if at all, one question is there where there is no offsetting question, offset question low. In that case, you should not consider this way. You can consider directly this. Sorry, you can consider this directly. So therefore, tell me now, can I use this formula now in this question? No. Directly what we have to do, V4 equal to FCFF5 divided by KO minus E. What is FCFF5? 375.32 whole divided by 12% minus 10%. Now it will come 18,000.766. Okay. So you can rewrite this 18,766. Please tell the PV at the rate of, we are calculating today. Say for today's PV factor, you should tell 13% and KO. How much at the rate of 13? Huh? Tell me 13%. 1 second. Now what is that? 0.89, 3 digits. 88, then 8858. 889, then 885 correct. Next 783 693 613 54. ఎగిరిపోతావు. Both belongs to same year. Okay. So tell me PV of FCFF 49.56 2 88. Next 11 0.56. Total all this 11 720.8 89. 11 720.94. So check the study material answer, how much they got? Exactly. That's all. This is FCFF model. Sir, everyone understood how to do the question or not? Hello everyone, I am talking to you. So someone asked me, sir, please solve this question. Bro, are you satisfied? Huh? Thank you. Sir, okay. Everyone understood this question or not? How to do FCFF model? Everyone in the class? Will you do a similar question? Take a break. 10 minutes. Small question only. 6 marks question I will give you. Study material next question. 8th. Next question. I will show you the question. Tell me. This one. Okay. Start doing this. Sir, why this is given only for 6 marks? Reason is KE, KO, KD, everything they have given in the question. You need not solve anything. Means 4 working notes are saved for you. अभी स्पॉट सॉरी to consider only 3 years. Fourth year in the case of 4 years, sir. ఏం ఆఫ్సెట్ బాబు, క్వశ్చన్ ఇస్ గివెన్ ఓన్లీ ఫర్ 3 years. ఇది బట్టి అంటే అన్ని ప్రాబ్లంలు ఒకేలా ఉండాలా? హౌ మెనీ ఆఫ్ యూ డూయింగ్ ఫర్ 4 years? The question they have given only for 3 years. From fourth perpetuity. So fourth you should not consider. Previous question is for 4 years. Fifth onwards it went for perpetuity. I mean fifth beginning or fourth ending. Here 3 years you have to consider. Capital expenditure. Done? Completed? అసలు వివరాలు అడగండి, నేను చెప్పను. మీరు చెయ్యండి అన్న అంతే. డోంట్ ఆస్క్ ఎనీ డౌట్స్. So time up, everyone. Done with the answer? How much is the answer? $28,000. Hmm, 28. Okay, done. 28. Done, everyone. Can you go to the next one? Not going to next one. Don't get scared. Just tell me the final answer. How much you got? Okay. 28,851, something, some amount you got. Now my question, completed doing na? Tell me. So by understanding you can do, or by remembering the answers you can do. In two methods you can do this, because already if you have done it for 1 or 2 times, you will remember the model. So new question comes up, then only problem will come. Tell me, in this particular question especially, revenues, cost of goods sold, operating expenses, capex, depreciation, everything has been given or not? Given. High growth period, what is the growth rate? How much? Very good. Next one. Capex and net of depreciation will grow at 15%. So tell me, how much is the base year capital expenditure? What is the base year capital expenditure? Okay. Next, depreciation included in COGS and operating expenses, how much it will be? 600. That's a base year. Simply depreciation is 600. Answer here. Now tell me, what is the capex? 750. What is the depreciation? First tell me. I will ask you 4 or 5 questions, answer. With that I can understand whether understanding you are doing, or by remembering the numbers I can understand. Okay. First tell the point one by one. This company is having how many years of variable growth? How many? After that? Perpetuity. Okay. Next. What is the KO? What is the tax rate? 30%. Next one. Tell me, what is the base year capex? Base year capex. Base year depreciation. Very good. Next, what is the growth in capex? And in 3 years time, what is the growth? Obvious. Answer, sir. What is the growth in depreciation in that first 3 years? Answer. Wrong. There is no growth in capex and depreciation separately given in the question. Capex net of depreciation only will grow. Individually they don't give the growth in capex and depreciation in this question. That's the first observation you need to make. Don't mug up the answers. Your past experience will be helpful only if the past questions come. Okay. So in this question, capex is not growing individually. They didn't give, it may grow individually. They didn't give in the information. Depreciation, how much it is going, I don't know. But I know only one thing. What is the thing I know? Capex minus depreciation will grow at. That's all. That will grow at 15%. So like this you need to do. See here, sir. First, everyone have done working capital changes like this. Answer. All the cases there is an increase in working capital, fall in working capital, increase. That's why I kept the arrow mark upside. Calculation of net capex. Tell me, what is the base year capex? What is the base year depreciation? What is the capex net of depreciation? That will grow at the rate of 20%. Sorry, 15%. So, see there, see here, net capex, okay, will grow at the rate of 15%. So tell me, have you got the same values or not, everyone? 150. After that, how much? 172. Okay, 172.5 plus 15%, 198.38 plus again 15%. How much? Okay, last capex is offset again is the depreciation. Up to here, everyone understood? Lastly, calculation of FCFF and value of the firm. Working note I have given here for EBIT clearly. See, what is the revenue? Base year 500 minus COGS and operating expenses excluding depreciation I have done. For clarity's sake, I separated depreciation first. Take the calculator, see the question. Take the calculator, see the question. Depreciation is included in two things. What are the two things? Okay, operating expenses and COGS. Tell me, 3000 plus 2250. How much it is? 5250. In that, how much depreciation is involved? Therefore, 4650 we need to consider. Minus depreciation, separately we should deduct. Clear, everyone? So, EBIT that has grown at the rate of 20% each year. Hope you might have got this answer, everyone. But this is a better way of presenting the same question. Institute didn't present like this, but I have done just to show the student that this is how they have done the answer. Clear, everyone? So this is the way: 2700, 3250, 240, 3888 and 4199.04. So those numbers I have imported here. Tax 30%, no PAT, net capex, change in working capital, FCFF, PV at the rate of 15%, value of the firm for me came to some number changes back up 28,871. So everyone understood this last adjustment also. Always when depreciation is offsetting against the capex, we need to take that year cash flow. We need to take the previous year plus growth. Previous example also we have considered previous year plus growth. Actually that year cash flow we need to consider. That year cash flow we need to consider and do the problem like this. Hope everyone understood the concept clearly. FCFF model, everyone. First tell me, how many types of models we have done in FCFF now? Two models. Model number one is a core model. What we have done. Second one is all information is given. Capex net of depreciation directly given there. Clear? After the break, another 45 minutes to 1 hour we will spend on this to do another model called as FCFF lone. There are another three types of problems we have to do. One is a FCFE model. Which model? FCFE. Listening. After that, there is a concept called as advertising expenditure concept. That we need to do. Clear? Lastly, one very important difficult problem is there. That also we have to see. Once you visit to those problems, confidently you can present your answers in the exam with regard to FCFF model. Clear, everyone? Another three questions we will do. With that, this chapter also will be completed. I will directly go into the futures. Okay. Today at the last, I will do 7 to 10, 8 problems in the securities valuation chapter and I will close. First, let us start off with the futures after this. Clear, everyone? Take a break and come. Sir, first tell me, everyone, one has understood the concept clearly. Sir, we will again come by 3. 3 we will start. So in the previous session we just read the question. Now let us continue. Okay. So in this particular video we are going to complete this chapter. First we are going to start with the pending problem number 25. Okay, after problem number 25, small questions are there. Those questions also will be completing and then we'll be going into the main part of discussion with regard to the forex management. Okay, mergers and forex I will simultaneously start. So mergers is a basic area, and basic area I will not call. It's a very good marks gaining area, but still when compared to forex it is not so technical. I will start both simultaneously. So let us start with the content carrying problem number 25. Okay. So problem number 25, as I already said, what is so great in this question? If that be the case, I will ask a question, what is not great in this problem?
Shall I tell you what great in this problem? Number one, this problem shall be solved either from FCFF or FCFE, any model you can use. This particular problem you can do in two ways. One, FCFF model, another one, FCFE model. Any model you can do. Answer will not be same. Answer, how it will be same? Answer can never be same. FCFF will give one answer, FCFE will give another answer. No doubt in that, because FCFF entire project will be said to be managed by both debt and equity in the proportion of their investment. But in equity, we will bifurcate everything. Income we will bifurcate. Actually, for example, from the debt holders I take 100 rupee. From equity I have taken 100 rupee. How much is there in my hand? 200. 200 I purchased something and sold for 400. Okay. Or 200 I purchased, I sold it for 250. 250. Really, you can't buy 1 rupee to 1 rupee, 1 by 1 ratio. You can't tell 1 rupee came from debt, 1 rupee came from equity. You can't tell like that. Each and every item of income statement, you can't bifurcate with equity and debt. Therefore, when you calculate free cash flow for firm, it is an overall picture. Okay, total debt and equity, we will calculate the value. From there, we will remove the value of debt. Balance will be the equity. That's how we analyze this particular concept called as free cash flow for firm. But when it comes to free cash flow from equity, it's completely different ball game. Only from equity point of view, we'll analyze everything. So here and there some changes will come. Because of that, the value also will change. So this particular problem we can do in two ways. I will do both. FCFF model we will do, FCFE model you can do. Moreover, this problem can be done from EBIT point of view. This problem can be done from EPAT point of view. Any point of view you can do. This question is there in the study material once upon a time, but recently in one of the latest RTP I found this question, therefore I inserted this in the material. Please, very important question, mark it very important. Okay, first point number one, let us solve from alternative one. What is the first alternative? Free cash flow for firm. Free cash flow for what, sir? Firm. So once we complete the free cash flow for firm calculation, then we will be going into free cash flow for equity. Okay, we will do PAT or we will do EBIT. A question may also arise. Okay, what we will do is we will take EBIT as a base and we will do PAT. If you want, you do at home. Okay, PAT if you want, you do, answer will be same. Answer will be same. Take FCFF, do from EBIT point of view, do from PAT point of view, both will give same answer. Okay, let us now solve the particular question. Let's take the viewpoint. First, if you observe the question, share price now it is trading at 66. Outstanding debt is 1934. Number of outstanding shares are 75 lakh shares. PAT is 17.2 lakhs. EBIT 245 lakhs. Interest expenses 218.125. Capex will be 234. Depreciation 234. From the beginning itself, both are offsetting each other. Growth during the variable growth period is 8. And from the stable from 2014, it will be 6%. Free cash flows from 2014 onwards 240.336. Capex will be offset by depreciation and the debt is expected to decline by 30% in 2014. Okay. Now listen carefully. Debt is expected to decline by 30% in 2014. This one will not have any impact while calculating FCFF. I repeat, this particular point will not have any impact while calculating FCFF. Do you know why? FCFF, what is the formula? EBIT through EBIT into 1 minus T plus interest after, interest is not deducted, plus depreciation plus or minus capex plus or minus change in working capital. That's all. Net borrowings plus or minus net borrowings means what? If you borrow, amount will come in, we need to add. If you pay, it will go out. But that will be used in FCFE model. We are doing FCFF first. FCFF debt holder is also treated as a owner only. So payments to the owner, payments receipts from the owner, we should not consider. Therefore, interest is a payment to the owner, we should not consider. Anyway, we don't consider while calculating EBIT. So we will not deduct again. Okay. Likewise, when payment is also made, net borrowings is made, that net borrowings we should not take into impact. But while calculating FCFE, the same debt impact will be shown in the books because debt will be treated as an outsider. Then how the value will be same? Value changes. So therefore, we are going to see a different viewpoint of FCFF and FCFE in this problem. I don't know Previously, if anyone have already done this problem, in what viewpoint you have done, but the viewpoint what we are going to see today is completely different. A breakthrough of understanding the FCFF and FCFE. Shall we start doing the problem? Now, let us start. First put the heading. So we completed problem number 9. Now we are going into question number. What is the question number? 25. Question number 25. Question number 25. Okay. First, even before we solve the problem, first tell me, I am going through EBIT. First tell me what is the formula. EBIT into 1 minus T plus depreciation. Okay, plus depreciation plus or minus capex plus or minus change in working capital. Okay, all these things when we use FCFF, we require discounting of this with this is FCFF. I want to discount this using KO. Okay, first answer my question. Is a tax rate given in the question? Check the point now. Tax rate. Check it. They didn't give. We need to calculate EBIT, PAT. EBIT 245. Interest cost is there. PAT is there. Missing figure will be tax. So tax we need to calculate. Depreciation anyway not having any impact because depreciation and capex offset each other. Working capital existing is 44. It will grow along with the sales. So therefore we need to give impact to that particular point. Okay now. So this is another issue that we need to consider out. Okay. So next, working capital we need to do. So working note 1, tax rate. Working note number 2, working capital. Working note number 3 is the KO. Working note number 3 is the KO. KO is very, very important in this question because KO prior to 2014 and after 2014 will be different because 2014 30% of the debt is repaid. Means the proportion of debt will reduce. Therefore, KO will change. So we need to calculate 2 KO during the variable growth, during the stable growth period. Stable growth period 30% of the debt has been repaid. So we need to calculate the KO accordingly. So KO has to change. KO has to what's that? Change. When I told you very clearly, when calculating the free cash flows as a schedule, we should not consider debt. But PV factor we need to consider that. Therefore, PV factor we give impact to that. Okay, 30% debt reduction will be there. We need to calculate the KO. So estimate the value of the company, whether the ruling market price, we need to see that. Cost of equity is 16, 30% debt repayment is made in the year 2014. Sir, in the year 2014 means at the end of the year 2014, debt repayment has been made. That's how we need to interpret. Okay. So this is the question that he has asked. From this, we need to go on analyzing this particular concept. Okay. So how much is the growth rate from 2010 to 14? 8%. Working capital also should increase in the same proportion. So KE we have, KD not given. So KD how to calculate? From the interest day we need to calculate the KD, that will be pre-tax. We need to calculate post-tax. So many steps are there in this problem. Let's do one by one. Okay, let's start. Keep the heading one by one. Let's do together. Let's do together. Step 1. Calculation of tax rate. Calculation of tax rate. Write down. We need to calculate it as a balancing figure. We need to calculate it as a balancing figure. Let's see. Write down. Amount rupees in lakhs. Please, let us solve together. First, tell me what is the schedule we need to write. Okay, EAT. So first answer one question. First answer me one question, everyone. How much is the EBIT? 245 lakhs. Okay. How much is the interest? 218.125. Okay. So take calculator. Take calculator, everyone. Do it. 245 minus 218.125. 26.875. PAT is already given 17.2. Okay, 17.2. Now answer. Tax will be balancing figure. Tax will be the balancing figure. How much will be the tax amount? It will be 26.875 minus 17.2. How much? 9.675. 9.675. So if you want to know the tax rate, so this is the amounts, na? Tax rate. Below write down tax rate. So how much is the tax amount? Rupees 9.675 divided by 26.875 into 100. 36%. So how much is the tax rate? 36%. Okay. So the first working note is completed. Now let us go to the next one. Second working note. Step 2. Calculation of change in working capital. Calculation of change in working capital. Let us see. Calculation of change in working capital. Particulars, or I will write down directly year, 1, sorry, not 1. Years are given 2010. Okay, write down 2010, 2011, 2012, 2013, 2014, and perpetual period. Perpetual period means what? From the end of 2014 onwards. Okay. Okay. Write down clearly. Working capital. So it will grow at the rate of how much percent for the first or for clarity sake I am writing this. You need not write. Okay. So let's solve. So year 2010, 11, 12, 13, 14 and perpetuity. So first working capital. Okay. So 2009 ending the working capital stands at 44. Stands at 44. Okay. 44 plus 8% means how much? 47.52. 47.52. Write down everyone. Next. Plus 8%. 51.32. Plus 8%. 55.43. Plus 8%. 59.86 plus 8%. 64.65 plus 6%. 68.53. Okay, right. This is the working capital. We need working capital. Change in working capital. Change in working capital. 44 has become 47.52. 3.52. Next, 51.32 minus 47.52. 3.80. 55.43 minus 51.32. 4.11. 59.86 minus 55.43. 64.65 minus 59.86. 68.53 minus 64.65. 88. In all the cases, working capital has been increased only. Increase in working capital is a reduction in cash inflow. Technically, you can take it as cash outflow. Okay. So this is the working capital change. Okay. Next issue. Next step. Next step. Step 3. Calculation of, see here, tax rate, okay, done. I'm erasing whatever we have completed. Tax rate done, depreciation done, capex done means what? It's not required. Working capital, okay, done. So now we need to calculate KO. If that is done, all the ingredients are ready to make the main dish. Let's solve. Calculation of post-tax KD. First, let us calculate like this. A. Pre-tax KD. Let us first write the formula. Pre-tax KD. Okay. Now, tell me, how much is the interest cost? How much is the interest cost? 218.125. Whole divided by how much outstanding debt is there? 1934. 218.125 divided by 1934 into 100, 11.28 percentage. 11.28 percentage. Pre-tax KD into 1 minus T. How much is the pre-tax KD? 7.22 percentage. 7.22 percentage. So that will be the pre-tax or post-tax. Post-tax KD. How much is the post-tax KD? 7.22. 7.22 is the post-tax KD calculation. Now we need to do calculation of weighted average cost of capital. Because K is already given, we need to just calculate the weighted average cost of capital. So step number 4. Take step number 4. Step 4. Calculation of WACC, weighted average cost of capital. Let us solve. When you are calculating this, there are two calculations. From 2010 to 2014. From 2010 to 2014. So 2010 to 2014 situations will be this way. Source. Debt. So let's write down the numbers as well. How much is the equity amount? Market value weights we need to take always. What is the market price? 66 into 66 into how many shares are there? 75 lakh. 75 into 66. Rupees 4950 lakhs. Debt already given in the question. So total 4950 plus 1934. Rupees 6884 lakhs. Rupees 6884 lakhs. Okay. So proportions, let us calculate. 4950 divided by 6884. 0.72. 1934 divided by 6884. 0.28. Cost. Equity cost already given in the question 16. This we calculated now 7.22. 16 into 0.72, 0.28 into 7.22. 13.54. So 13.54 is the KO for what? KO from 2010 to 2014. Now, next issue. Calculate. So for the perpetual period, let's do together. No need to wait for my answer. You do on your own. Equity, same answer. Okay. Next, debt, very important thing. See here, when you are writing debt, rupees 1934 lakh, rupees 1934 lakh minus rupees 1934 lakh into 30%. Why 30%? It's repaid. So 1934 into 30%, 580.2 minus 1934, 1353.8. Let's do. What is the total? 4950 plus 1353.8, 6303.8. Proportion 4950 divided by 6303.8. Okay, write down. 0.79, 0.79, 1353.8 divided by 6303.8, 0.21, 0.21. So the cost same. Cost will not change. When proportions change, a weighted cost will change. $12.64, %. Okay, so this is the calculation of KO, WAC calculation for both the periods. Okay, now let us now start solving the problem. Everything has been done. What is left out for us? Calculation of free cash flows. Right on. calculation of free cash flows. Alternative 1 means you can also calculate FCFE. Okay, so why in the question he clearly asked calculate the ruling market price. Okay, first you have to value the company as a whole, and the ruling market price also you need to calculate. So market price means what? Market price of what? Market price of debt, market price of equity. So the market price of equity we can calculate using two models, FCFF as an overall approach, FCFE as an equity shareholders approach. Let us do both for this problem. Okay, so alternative 1, write down. Year, perpetual period. Please, let's do together very clearly in detail. Let's do. First, we are taking EBIT as a base. Sorry. 1 second. Let's clearly write down. So this period we call as S means stable. How much percent? 6%. Okay, now let us solve the question. Write down bits by bit everything. Let's write down EBIT. Okay, EBIT. What is the things we need to write? Everyone, first tell me that EBIT minus tax, no PAT. After that, add back depreciation and capex anyway not there, so therefore deduct change in working capital. Deduct change in working capital. Discount it with a PV factor at the rate of, we are calculating FCFF. Therefore, try to understand clearly. Today we are valuing. Today what is the cost? 13.54. So that we need to take PV at the rate of 13.54. So once we take all this information, we can easily answer the question. Let's do. What is the EBIT? I mean after the growth of 8%. Base EBIT 245 lakhs. Base EBIT 245 lakhs. Okay, now 245 plus 8%. Write down. 264.6. Next one, 264.6 plus 8%, 285.77 plus 8%, 308.63 plus 8%, 333.32 plus 8%, 359.99 plus 6%, 381.58 minus tax at the rate of 36%. 264.6 into 30%. Okay, sorry, I think I made for 30%, 36%. I'm very sorry. 264.6 into 0.36. Sorry, 95.26, 169.344. Okay, next 285.77 into 0.36. 102.88. Let us first do everything. 0.63 into 0.36. 308.63 into 0.36. 111.11. Next. Technically you can write it 120. 359.99 into 0.36. 129.59. 381.58 into 0.36. 137.38. 137.38. So let's now calculate the balancing. 285.77 minus 102.88, 182.89. Next, 308.63 minus 111.11, 197.52. 333.32 minus 120, 213.32. 359.99 minus 129.59, 230.4. 359.99 minus 230.4. Okay, last 381.58 minus 137.38, 244.2, 244.2. Okay, let's now deduct the change in working capital again. Change in working capital means we need to take the working note 3.52, 3.8, all these. First year. 3.52, 3.8, 4.11, 4.43. 4.79, 3.88. Okay, let's do 169.344 minus 3.52, 165.824. Everyone, don't skip writing the notes. Do along with me. Minus 3.8, 179.09. 179.09. Next. 197.52 minus 4.11. It will be 193.41. 213.32 minus 4.43. 208.89. Next, 230.4 minus 4.79. Okay, 230.4 minus 4.79. Okay, minus 4.79. That will be 225.61. And last, 244.2 minus 3.88. 240.32. So if you see here 240.32. See here, we got 240.32 FCFF for perpetual period. Okay, free cash flow from 2014 onward, 240.336. 240.336 or 240.32, just 0.0 we got a difference. Okay, so 240.32, or you can take 240.336 directly, just a decimal. So PV factors, all these numbers, so small differences will come. Okay, now we got 240.32 means 100% what you have done is right. That's how you can check your answer. So anyway, let's calculate PV at the rate of 13.54. 1 divided by 1.1324, 0.883. 1 divided by 1.1354. Sorry, 0.881. 0.881. 0.776. 0.683. 0.602. 0.53. 0.53. 0.53 and 0.53. 240.32 anyway I will erase na at the last. You can put a star mark there and you can do. For me I will directly change it. Okay. So now let's try to understand how to value this. Present value of free cash flows for the firm. 165.824 into 0.881. 146. 146.09. 179.09 into 0.776. 138.97. 193.41 into 0.683. 132.09, or you can write 132.10. Next, 208.89 into 0.602. 125.75. 125.75. Next, 225.61 into 0.53. 119.57. Last one we need to calculate. Okay, so let us now solve the problem. FCFF 15. 15 means 15 onwards. Okay, 15 onwards, how much it is? Okay, there we got 240.32, just to 0. Sir, 240.32 minus 240.336, 0.016. Negligible difference because of P factors. So you can directly take the institute material. He has given the question, he has given the, take it directly. Okay, 240.336 divided by KO. What is the changed KO? 14.16. 14.16 minus 6%. So 240.336 minus, okay, 240.336 minus 14.16 minus 6, 8.16. 2945, 2945.29. 29 lakhs. Simply erase there and write down. So 2945.29 into 0.53, 1561, 1561. Okay, now 146.09 plus 138.97 plus 132.1 plus 125.75 plus 119.57 plus 1561. Rupees 2,223.48 lakhs. Okay, 2,223.48 lakhs. So this is the value of the firm without any deduction of the debt inside it. Okay, without deduction of debt. So see here, value of the firm minus so value of the firm is rupees 2,223.48 lakhs minus present value of debt payment. Debt payment is made in which year? End of 2014. End of 2014 when PV factor is 0.53. So how much debt repayment was made? How much debt repayment was made? 1934 into 30%, 580.2. 580.2 into 0.53, 307.51. So 1916 lakhs. So is this the total value of the equity? Is this the total value of equity? No. Do you know why? Only 30% has been repaid. Means 70% is still there or not? Okay. So therefore, value of equity, you kept the heading. First, this is value of the firm after debt repayment proportionately. After you repaid the debt proportionately, this is the value of the firm, because entire debt is not deducted in that 1916. Okay, so value of the firm minus value of debt. $1916 minus, so how much is the debt repayment? 1934 minus 30%. How much balance is there? This will be the value of equity. This will be the value of what, sir? Equity. Now let us understand rupees 7.50 per share. This is the answer we have obtained. Okay, rupees 7.50. What is the share traded price? 66. So conclusion we need to calculate. Step number 6. Conclusion. The share is really worth rupees 7.50. Hence it is highly overvalued. So this is how you need to do. Okay, here if you want you can write value of the firm before debt reduction. After debt reduction it will be 1916. Okay, I am writing one small disclaimer here. So this is a disclaimer. Means what? I will tell you. When I do this, I have taken PV factors with three digits. When I take here proportion, I have taken 2 digits. If you take 3 digits, answer in the institute study material will become 14.11. Okay. So 14.16 because proportion I have taken 2 digits. So no problem. So then if it is 14.11, automatically this PV factor will change. When PV factor changes, automatically the answer change or not? That change is very little. 5 to 10 numbers it will change. For example, if it is 2 to 23.48, you will get normally 2 to 1718 like that. 5 or 6 differences will come. Likewise, even here, if it is 1916, if you see the study material, you will find 19, 20, 22 like that. I didn't exactly remember, but maximum 1 to 10 change will come. So don't unnecessarily create an issue for that. No problem. It will be dependent on how you take the numbers. You can write a disclaimer in the examination as well. Okay. So answer may differ in 1 to 10 numericals, which student can ignore. Okay. So you can write your own assumption in the examination, how many digits you are taking as a decimals. If question clearly take 3 decimals, take 3. Okay. So if you take 3 decimals here, now answer may become 14.11 or 14.12. I didn't really remember the answer in the study material, but there will be little change which you can ignore. Okay. So the stock price really worth is only 7.50, but it is trading in the market at rupees 66. Hence it is highly overvalued. Okay. So this is the answer for the given question. So this is how you can do this. Now, this is alternative 1. We can do the same in a alternative 2. What it is? FCFE model you can take. Okay. How it will be? Let us see. Using FCFE model. Using FCFE model. Sir, if you use FCFE model, what will happen? Debt also will be treated as an outsiders. In such a case, in this schedule itself, debt deduction will be made. In this schedule itself, we will make the reduction of debt. Okay. And interest should be treated as a cost because he is an outsider here. Okay. So calculation of value per share using FCFE model. Okay. Okay. Let's start. So see here, for convenience sake, I have done everything because really in the question you need not do FCFE. If you calculate this way, it's enough. But still, out of my own curiosity, we can calculate also through FCFE. Values will definitely change, but the answer will not change. Means what? Price per share should not change. Valuation methodology will change, the numbers will change. Okay. What is FCFE model? Formula through EBIT. EBIT into 1 minus T minus I into 1 minus T because they are outsiders. Actually, it should be plus depreciation plus or minus capex. Anyway, both are offsetting here. Minus change in working capital. Minus debt repayment in the year 2014. Debt will be repaid out of the funds or not. That's a fund to the equity. Outflow to the equity only. Next, FCFE. PV at the rate of 16%. PV of FCFE. I have done everything. Value of equity came at 568.23 lakhs. 568.23 lakhs. So the present value of free cash flows, total value of equity is 568.23 lakhs, 2014 year. So value of equity is 568.23 lakhs. Some important points to have a clarity because concept is same like a previous one, just a small change. Instead of taking EBIT, we will be taking EBIT into 1 minus T and I into 1 minus T we have already deducted here because debt holders will also be treated as a outsiders in case of calculating FCFE. Minus change in working capital, minus debt repayment. Debt repayment is made in the year 2014. So consider 580.2. FCFE calculation you have made. And lastly 1426, how it obtained? Take calculator. 244.2 minus 97.72 minus 3.88 will be 142.6. That's what I have taken here, value at the end of 2014. So value at the end of the year 2014 will be 1426. So that will be the value that I have taken here. discounted at the free cash flows being 0.476, we got the value as 568.23. Here if you take 568, now here 562, small difference. Sir, all these will come because of taking the PV factors. Here I have taken 3-digit number, so small change will come. Okay, so therefore the value of the share comes to rupees 7.58. Here 7.5, 5 or 52 it came, I rounded it up to 7.5. So here it came to 7.58. Answer should be same whether you calculate through FCFE or whether you calculate through FCFF. Answer should not change, it should be same always. This is a basic motto behind this particular model. Okay, so please copy down this particular answer. Alternative. Alternative. So please also do the alternative method of valuation of this particular thing. Okay, so value it.
Hi everyone. So in this session we are going to start with a new chapter called as derivative futures. So when it comes to the derivative futures chapter, as I said, this is very simple when compared to derivative options. So why it is simple? Reason is two things. Number one, it is not so complicated market architecture like options. In options, more than half the students will don't even understand that there are four positions. They will only see call holder means he will buy the share, but what he will do with the option no one is knowing. Same even with put holder. Generally you ask your friend what a put holder will do, they will tell sale. Okay, actually they should ask a question. Your question is incomplete. What put holder do with the option means what? He will buy an option only. So that confusion is there in all the students' minds generally. So we have cleared those myths in the basics of our options chapter. So main point what we want to explain is this market called as a futures market is not so complicated like that of options, because here so many complications will not be there. In the forex chapter, how there is a banker and buyer, banker and seller, here also only two parties will be there. How many parties are? Two parties will be there. So banker and buyer, banker and seller, here buyer and seller will be there. Okay, so much complication will not be there. But first question on futures we'll be discussing about. Okay, first question on futures we'll be discussing about how the futures market works. How the futures market works. So first question is the heart and soul of our class. Entire discussion what we are going to make in the coming topics of futures, this lecture will become the basic introduction. If you miss this, you need not listen to the futures. As simple as that I can tell. Okay, if you miss the today's lecture, that means if you don't listen to this lecture properly, you need not read futures. Okay, as simple as that, because the entire point of futures concept I will be discussing in this lecture. You can understand the importance of what I said. So let us start with the discussion. One small thing to tell. Till now, for all the chapters, though it is a pakka fast track, still I made a wholehearted effort that it should not disappoint any student. Okay, every point by point I have written with so much patience. 583 pages of notes I have written. Okay, just to present SFM in a right way and in a correct way and in the way in which it has to be presented. Okay, generally not to boast about the things that we have done, but we have analyzed SFM not like from CA exam point of view. I analyzed that from business schools point of view. Means how we have to analyze the entire subject called as SFM, how really the financial management has to be understood. If you read the foreign author books, now you will be in a position to understand the language. Okay, understand what they want to tell. Market price fluctuations, all those things you will understand. Okay, futures chapter, in contrast, I will do the problems, notes, I will just tell you the concepts clearly, but really how fast track will be, you will see in futures. Because students also asking, please complete fast, please complete fast. So I just explain every concept. In explanation of concept, I don't take a choice. Everything I will explain. But notes writing, I will avoid. Questions we will solve. Question, the logic, everything I will explain. Notes writing will not be there. Okay. Okay. Let us see how this has to be solved. Let us directly go to question number 1. Uh, Before going into this, learning objectives of futures. Learning objectives of futures. Okay. So the first learning objective, understanding futures market. Understanding futures market through question number 1. Through question number 1. Next one. Fair futures pricing. Fair futures pricing. Next one. Commodity pricing. Commodity pricing and commodity pricing and related concepts. Next. Contango, backwardation, basis, negative or positive. Contango, backwardation, basis, negative basis or positive basis. Contango, backwardation, basis, negative or positive. Okay. And convenience yield. Convenience yield. Number 5. Arbitrage in futures. Arbitrage in futures. Next. Hedging in futures. Hedging in futures. Next. Beta hedging. Beta hedging. Next. Target beta hedging. Target beta hedging. That's all. These are all the areas that we need to cover in futures. Understanding the futures market through question number 1. Fair futures pricing, commodity pricing and related concepts, contango backwardation basis, convenience yield, arbitrage in futures, hedging in futures, beta hedging, target beta hedging. Okay, let us go into question number 1. So we are going to learn the complete basics with regard to the futures using question number 1. Let us read. Mr. X buys 2 March futures contracts for TCS at the rate of 2278 on 1/3/2014. It may be not 2014, take 2022. Numbers only will change, concept will remain. That's why I've taken the same. On 27/3/2014, being the contract expiry date, the futures are closed at 2285 or 2272. Two situations. Spot price 2275.75. From the information given, answer the following. What are the various types of market entries? What are the various positions a person can take in futures market? Can futures be traded individually in singles? How contracts are settled on maturity? What is the position on the date of maturity in the given problem? Can we exit before maturity date? What is the difference between company futures and Nifty futures? Okay, except G point, everything we will cover now. G point will come somewhere in the middle of our futures discussion, because G point to answer, first we need to explain Nifty futures. So therefore, that concept of Nifty and Nifty futures will come in the middle. So at that time we will learn. As of now, these are the things that we need to learn. Okay, first read the question properly before we go into the solution part. So read the question properly before we go into solution. Read the question. So hope you completed reading. So see here. Let us read the question together one last time before we start. Point number one. Notes say I will not give. I will not write notes. I will not give you notes. I'm talking about oral notes. Problem, explanation, send percent like options only we will discuss. No problem in that. Okay. See here. Mr. X buys two March futures contracts for TCS at the rate of 2278 on 31/3/2014. On 27/3/2014, being the contract expiry date, the futures closed at 2285 or 2272. They have given two situations. Spot price per share 2275.75, today's price. From the following, answer these questions. Okay, 6 questions we have to answer. Okay, first, what are the various types of market entries? What are the various types of what's a market entries? What do you mean market entries? Listen carefully. First, A bit. Write down market entries. Write along with me. There are two types of market entries. One is cash market, another one is futures market. One is cash market, another one is futures market. Okay. Cash market means what? In this market, we buy or sell a share today. We buy or sell a share today. In this market, prices are quoted today for a transaction to happen at a future date. For a transaction to happen at a future date means cash market means it is a price quoted today for a transaction to happen today. Futures law, it is a price quoted today for a transaction to happen at a future date. It will be something like forward rate in dollars. Spot rate means what? It is a rate quoted today for a transaction to happen today. Means what? Pay cash and take. That's why it's called as cash market. Cash market also called as spot market. Cash market is also called as spot market. Okay. That means TCS share will get traded in two places. Number one, in the cash market, second one in the futures market. Okay. In the given question, you observe. Okay. You observe. Take a minute time. You observe properly. Tell me what is the cash market price? What is the futures market price? Cash market price is 2275.75. It is a cash market price. Okay. Futures market price is 2278 is the futures market. No, sir. Futures market price is 2285, 2272. No. I will explain what is the difference. 2275.75 is a price of a share if you buy and sell today. It is a price quoted today for a transaction to happen today. This is the spot price. This is a price quoted today for a transaction to happen at a future date. On the future date, price will be 2278. It can be more than that, it can be less than that. If it is more, we assume 2285. If it is less, we are assuming 2272. This is the answer. Hope you understood the point clearly. This is the idea. Okay, there are three rates. Rate 1, cash market price. It is a price for a share quoted today for a transaction to happen today.
Futures market price is a price that is quoted today for a transaction to happen at a future date. Okay, futures actual price is a price where the futures are actually closing at that rate on the expiry date. Okay, these are the three things. From the following information, bit 1, various types of market entries. So you can enter into share market in two ways. You can buy a share in two ways. Number 1, cash market. Number 2, futures market. In the given question, what is the cash market price? Rupees 2275.75. Futures market price rupees 2278. Rupees 2278. Bit A over. Bit B. Bit B. What are the various types of positions a person can take in the futures market? Okay, write down. Types of positions. Types of positions. Write down. There are two types of positions. One is long position, another one is a short position. Long position, short position. I have a book. I have what's a book. I will put another book on that. I will put another book on that. It's a longer, shorter, long. When it is long, when you buy the book, it is longer. When you sell, it is longer. When you put more and buy and put more, it's long. Therefore, long is called as buy. Short is called as sell. Short is called as what's a sell. So long position, short position means what? Long is called as buy futures, short is called as sell futures. Buy futures means what? I will buy on a future date. Sell futures means I will sell on a future date. Okay, that's called as long buy and sell. Types of positions are two types. What are the two types of positions, everyone? One is a long position, another one is a short position. Okay, so this is another point that you need to understand. In this question, Mr. X is long futures, short futures, long futures. He buys to March futures contract. He buys to March futures contracts for TCS. So Mr. X buys to March futures contract to March futures contract. So what you have to understand, buy means what? Buy means long. Buy means long. Long position means to buy. Short position means to sell. Okay. So this is a point. So Mr. X buys 2 March futures means Mr. X long on 2 March futures contracts for TCS at the rate of 2278. Okay, he promised to buy. How dollar we will tell? I will buy dollar after 2 months at 85 rupees. I will tell like that we will tell here. On the expiry date, really dollar can be 90, dollar can either be 80. Yes or no? Like that only, same concept here. Okay, next number 3. Can futures be traded individually in singles? Write down C. No. Futures can't be traded in singles. Futures are always traded in contracts. This is called as standardized lot size. Standardized lot size. That means if you want to buy TCS futures, 1 share of TCS future, 2 shares of TCS futures, you can't do. One lot there will be around 100 shares. It changes from monthly basis also. Okay, 50 shares lot if they tell. What does it mean? If you want to buy TCS shares in the futures market, you can't buy 1 share or 2 shares. You have to buy minimum 100 shares in one lot. So therefore always futures are traded in lot sizes. Sir, what is the reason? Why? What is the reason? I will tell you when we come to the another concept. There I will clearly explain why it is like that. Okay. Next. So in this also, if you observe, Mr. X buys two March futures contracts. He didn't buy two March futures. March TCS futures he didn't buy. Contracts he bought. Okay. If for example contract size is 100. Say for example contract size is 100. Okay. Means how many shares he promised to buy? He promised to buy 200 shares. Like that we have to understand. Okay. Next. Next, how the contracts are settled on maturity. So listen, DEF, very complicated. If you understand DEF, seriously I am telling you, not joking, 80% of the futures chapter you will understand. When if you really understand D, E and F properly. Okay, so this question was prepared by me. ఈ క్వశ్చన్ నేను తయారు చేసింది. ఎక్కడి నుంచి? స్టూడెంట్ మైండ్లో నుంచి వచ్చే డౌట్స్ని బేస్గా పెట్టుకొని నేను చేసిన క్వశ్చన్. మీరు ఎక్కడ చూడండి, క్వశ్చనే ఉండదు ఎక్కడ. ప్లీజ్ ట్రై టు అండర్స్టాండ్. మీన్స్ వాట్? I want to explain basics of futures. For that I created a scenario. Okay, randomly I have taken some numbers. Okay, numbers are not relevant here. So TCS share is today trading at how much? It is trading at 3000. Instead of 2278 you will put 3000. That's our numbers will change. Concept anyway will not change na. So this question I prepared. This is not study material question, but if this question is understood, 90% of the futures, whenever I tell something, you will first catch it. Okay. So therefore, how the contracts are settled on maturity? What is the position on maturity date in the given problem? Can we exit before maturity date? These are the three very important questions which we need to answer. Okay, one by one let us answer. Settlement on maturity. Keep the heading. Settlement on maturity. Write down. On maturity date, on maturity date, on maturity date, buyer will take a counter sell. Seller will take a counter buy. Seller will take a counter buy. Sir, what do you mean by this? Buyer will make a counter buy, counter sell. Seller will make a counter buy. What is this? I will explain. Like binomial risk neutralization model, first write down. Okay, explanation and everything I will once complete, I will make it. Okay, copy down first. Settlement on maturity. Buyer will take counter sell. Seller will take a counter buy. Meaning I will explain. Okay, so on maturity date, buyer will take a counter sell, seller will take a counter buy. Okay, what is the meaning? Let us see. EBIT. Position on maturity date. Position on maturity date. Listen carefully. This itself I will first to do, and I will then give a time for you to copy. Okay, see here, two things can happen on the maturity date. Okay, actual price can go to 2285, actual price can come to 2272 82 72 2272. So actual price can go up to 2285 or 2272. Sir, only two prices are examples, sir. That means one price above the futures rate, one price below the futures rate. That's my intention. Okay, So one price may be 2285, another price may be 2272. These are the two prices that are assumed for understanding sake. Okay, AP 2285, AP 2272. This is the point. Okay, now listen carefully to the point how it works. Now you have a futures contract to buy the shares of TCS, to sell the shares of TCS, to buy the shares of TCS. Okay, so now you can observe clearly, you promised to buy at how much? 2278. Try to understand. Let us take a dollar forward. $1 equal to rupees 80. You entered into a forward contract with a banker. Okay, you entered into a forward contract with a banker. How you will enter into forward contract with a banker? Obviously, you will go to the bank. You will lock yourself to a rate. That rate we call as a forward rate. That rate we call as what rate, sir? Forward rate. You will tell, I will buy a dollar at 80 rupees after 3 months, or after 1 year, after 6 months. Like that you will tell something, yes or no? So we will go to the banker and we will lock ourselves at a price. On that day, even if price goes to 90 or price falls to 70, I will be forced to buy each dollar at 80 rupees or not. Likewise, observe here and tell, I locked myself at 2278 to buy share of TCS after 1 month. 27 4 4 or 3, 27 3, 27 3. I promise to buy each share of TCS at 2278. Therefore, I will buy a share which is worth 2285, which is worth 2285 only at 2278. That means I will buy a share at 2278. Price fall to 2272. Even if the price has fall to 2272, I should buy by paying 2278. This is the point. Okay, like this it will not happen. This is what you need to understand. Futures market law, this will not happen. How it will happen then? Listen carefully. Whenever I tell about a contract, there should be two parties. Futures contract, there are two parties. One is a buyer, another one is a seller. One is a buyer, another one is a seller. Buyer promises to buy, seller promises to sell. Okay, let us try to understand. I promised that I will buy each share of TCS on 27/3 at 2278, at 2278. But what is the real actual price on the day? 2285. Now imagine situation like this. Imagine situation like this. If really like cash market, if you have to buy, you would have bought at what price? 2278. That means a share which is worth 2285, you will be buying only at 2278 from the seller or not. So technically what will happen? You buy at 2278. Immediately if you sell that in the market, how much you will sell? 2285. Means how much profit you are getting? Totally I'm getting, okay, 7 rupees profit. How much profit, sir? 7 rupees profit I am getting. Instead of you really buying at 2278, instead of seller really buying at okay 2285 and selling at 2278, technically what the stock market or stock exchange will do is, it will directly deposit 7 rupee profit into your account. Okay, sorry, I didn't understand. I will re-explain. I know this concept is complicated. Listen carefully. In case of futures, real buying and selling of assets will not happen except in case of some commodities. Means, sir, if I want to buy a share, I can't buy a share in futures market. You cannot buy. Sir, then if I want to buy in for future, then there is no chance. Options are there na. Options la physical delivery is there. Futures la physical delivery of share will not be there. It is only net settlement. It's like a gambling. It's like a betting. Okay, listen again. I promised to buy one share of TCS on 27/3 at how much price today itself? 2278. Price is locked today for a transaction to happen at a future date. On that future date, when it comes actually, price may not be the locked price. It can be more than that, it can be less than that. If it is a real physical delivery like a dollar, how the situation would be? I should buy each share at 2278, which is traded in the market at 2285. Means immediately by buying a 2278 in the market, if I sell, how much profit I would get? I would get a profit of 7 rupee per each share. Okay, 7 rupee per each share. Take the second situation. So tell me, how much is the actual price of the share on the maturity date? 2272. How much, sir? 2272 means you are purchasing a share which is worth 2272 for 2278. Means if you buy at 2278, you locked yourself now, you have to buy. Say for example, you bought at 2278, share is there. Immediately you sold the share in the market. How much loss you would get? I would get a loss of -6. I would get a loss of -6. Instead of really buying by paying 2278 and reselling at 2285, or buying at 2278, reselling at 2272 and making obvious loss, instead of doing all these things, concept of future said that we will make a net settlement only. We will make which settlement, sir? Net settlement. Sir, answer okay. Answer okay. What do you mean by this answer? That means if I would have really bought, I would have bought at 2278. If I would have sold it, I would have sold it at 2285. Means I am making an obvious gain of 7 rupee. Understanding everything okay, sir. But still, how this 7 rupee will be deposited? How this 6 rupee will be withdrawn? How all this will happen? Listen, you should not understand this way. You should understand from the other person's point of view also. Okay, let us say for example, there are two persons. There are how many, sir? Two persons. Buyer, seller. Buyer, seller. Buyer promised to buy at 2278. Seller promised to sell at 2278. Okay, price can be 2285, 2272, 2285, 2272. Now you people only should answer me now. Now tell me, I promised to buy the share at how much? I promised to buy share at how much? 2278. A share which is worth how much? 2285. Means if I buy, I will buy at 2278. Immediately if I sell, I will sell at 2285. Eventually I'm making how much gain? 7 gain. Instead of really doing all these, you do as a net settlement basis. Which settlement basis, sir? Net settlement. Means what? Means see here. See the screen. Okay, instead of doing all those things, what they will do? See the screen once. See the screen here. 2285, 2272. Two rates are there. Yes or no? Okay, see here. Now I can explain clearly. Buyer. Buyer promises to buy at 2278, but the price has actually become 2285. Okay, if buyer would have purchased, at what price he would have purchased? 2278. Immediately he would have sold it. How much price he would have sold? 2282, 2285. Means obviously he's making a gain of how much? Plus 7. Therefore, seller from his account he will deposit 7 rupees to the account of the buyer. Really buyer will not buy the share, really seller will not sell the share. Means what? Buyer has a right to buy at, sorry, is having a chance to buy at 2278 only. So he will buy, and immediately if he sell to the same seller, okay, to him only if he sell, he would have made a gain of 7 rupees or not. Instead of really doing all these transactions and wasting so much of brokerage, how much profit you would have got? 7 rupee. That 7 rupee I will deposit in your account. Anyway, net settlement of that only will happen anyway. So therefore, try to understand, buyer will become a seller on the maturity date. Buyer will become a seller. Means what? Buyer really will not buy. Buyer really will not sell. If you have, you would have bought at the locked price and sold immediately, what profit you would make, that profit will be deposited into your account. What loss you would have made, that loss will be withdrawn from your account. From the seller point of view, how it look like? Let us see. Seller promised to sell at how much? 2278. What is the price? 2285. He has a market, if he would have sold, he would have sold at 2285. Okay, he would have sold at 2285. But to the buyer, he would have sold only at how much? 2278. 2278. Okay. So now how to understand this? You sold it to 2278. Okay, you sold it 2278, and immediately you bought this share. You sold it 2278. Money got into the hands. Again you want to buy the share. How much you will buy? 2285. Means you are having a loss of how much? 7. So from the account of the seller, 7 rupees will be shifted into the account of the buyer. That means all sellers will become buyers on maturity date. All buyers will become sellers on maturity date. This is the logic of futures. That's why it's called as buyer will take a counter sell, seller will take a counter buy. Means really they will not buy, really they will not sell. If at all he would have bought and sold immediately, how much profit he would have made? Now itself they will deposit that amount. Clear or not, everyone? So therefore, in reality, in futures market, buying and selling do not happen physically. Shares will not be bought, shares will not be sold. Net settlement will happen, also called as a cash settlement. Also called as what settlement, sir? Cash settlement. So last time, I locked myself as a buyer at how much price? 2278. 2278 I locked a actual price that will be prevailing on 27/3. I locked that. Actual price can be higher, actual price can be lower. If the actual price is higher, if the actual price is what's up? Higher. What will happen if the actual price is higher? If the actual price is higher, buyer has a chance to buy at a lower price. Immediately he can sell in the market at higher price. Let us assume that he sold to the seller only directly. Then what would happen? He buy from him at 2278, sell to him at 2285. Automatically what will happen? He will make a gain. How the seller position will be? He sell at 2285 and buy at 2278 and buy at 2285. He is making a loss. From his bank account, 7 rupee will be deducted. Into his bank account, 7 rupee will be added. This is how the futures actually work. Reality, I will not do any buy, I will not do any sell. Hope you can understand the point. All buyers will become sellers, all sellers will become buyers. On which date? On the maturity date. This is a point I want to discuss. Hope everyone understood up to here clearly. Okay, let's continue. So understood the concept, everyone? So this is the point I want to convey. So really buying and selling will not happen. Buyers become sellers, sellers will become buyers. On which date? On maturity date. Next. So can we exit before maturity date? Is the next question. Can we exit before maturity date? See the question once. Mr. X buys 2 March futures contracts for TCS at the rate of 2278. Okay, on 27/3/2014, the contract expiry date, futures will be closed at 2285 or 2275, 2272. Spot price is 2275.75. Answer the following, he asked. 7 questions, the 6 we need to answer. The 6th one we are in. Can we exit before maturity date? See here. What he is asking is, we entered into futures market on which date? 1/3/2014. Expiring on which date? 27/3/2014. Okay, I promised to sell a buy at how much price? 2278. Okay, now I promised to buy on 27/3/2014. Okay, now what happened, let me explain. He is asking in the question whether I can exit before the maturity date, or I have to continue and hold it till maturity. Is a question now. Till expiry date I have to continue, or I can exit before a maturity date. See here now. A person entering into futures market need not stay till the maturity date. This is the striking feature of futures. In case of options, if you tell that you are buying a 4 months or 3 months or 6 months call option, to exercise that you have to wait for 6 months. In the middle you can't exercise, you have to wait till maturity date. But on that day you may exercise, you may lapse. That is entirely different ball game. For call holders SP less than AP exercise, for put holders XP greater than AP will be exercise. That is entirely different ball game. Whether you exercise or not will be dependent on the price prevailing on the maturity date. Therefore I have to wait till the maturity date. In case of what? In case of options, we are doing options of futures. Futures, when you are in Rome, behave like a Roman. The same saying will apply. In which market we are in? We are in options market or futures market? Futures market. So don't think that futures and options market both are same. Both runs like this, not like this. Okay, both are divergent concepts. People come to futures market with one intention, people will come to options market with another intention. Intention of coming to futures and options we will see at a later stage. First let us understand how the futures works. Okay, so now the question is, on 1/3/2014 I enter into a contract expiring on 27/3/2014 to buy a share at 2278. Now I got a doubt. Can I exit before maturity date? Before maturity date means before what date? Before 27/3. Can I go out? Okay, let us see. See here, cash market, futures market, cash market, futures market. Okay, cash market. I'm taking 3 days prices. Today cash market price is 2275.75. Today this is 2278. Okay, 2278. Now next one, T1 means 1 day after. Okay, D1 or day 1, you can understand. Cash market la price went to 2292. Price went to 2292. Futures is a derivative instrument which derives the value from the value of its underlying asset. It price of the cash market is increased, automatically futures market also will increase, except in some exceptional cases. Futures market value will also increase, except in case of exceptional cases. So we should explain the concept to the students, taking exceptional cases are general cases are general cases. Sir, what is that exceptional? That itself we will discuss in an area called as contango and backwardation. Name itself is clear, backwardation, reverse case like it will happen. Okay, cash market will increase, futures market will fall. Why? We will see in the backwardation market. Which markets are backwardation market? Okay, so today cash market has a price of 2272.75. These are numbers given in the question. First two, 2278 is the futures market. Next day, that's the anticipated number. Next day, price went to 2292. Futures went to 2297. Say for example, T2 2289, it fall to 22, say for example 2290. This is how the prices are. Means, observe here. Okay, now listen carefully to the point. This is more complicated issue. Listen carefully. Day 1, okay, day 1, A is a buyer, B is a seller. A and B entered into a contract. A promised to buy, B promised to sell. Share of TCS at 2278. Okay, sir, why 2278, sir? Why not 2275? We are in Rome. Behave like a Roman. We are in which market? Futures market. So trading will be done on futures. Then why you have written cash price, cash market price? Two reasons. First, cash market will influence future market because it's a derivative, to explain that. And second, very important thing is, you will understand now why I have kept that. Okay, tell me. A and B, buyer and seller. Okay, now tell me, this is day 1, day 2. Okay, now listen carefully to the point. Second day, A want to leave the company. A want to leave the company means what? A want to exit from the market. A want to exit from the market. You see the cash market now. You purchase the share of TCS today in the cash market. Normally demat account you use. Using your demat account, you purchased a share. You purchase share of which company? TCS. You want to leave the company. You want to leave the company. What you will do if you want to leave? You will throw this phone in dustbin. Automatically you will become non-member, or you delete a app in the phone, you will become non-member. So to become non-member, what you need to do? You bought the share and became a member. You sell the share and become a non-member. That means buyer should become a seller to exit. Buyer should become a seller to exit. Therefore, A has to give a sell. So you will sell at 2292 and you will leave. Same thing happens also in the futures market. A will give a sell quotation. A will give a sell quotation. Someone has to buy the futures or not? Who is that someone? Mr. B. Wrong. B is a seller already. A and B already contract created. Here who want to leave? A want to leave, B want to leave, A want to leave. A is having which position? Buy position. He want to leave. He has to do what? Give a sell. Okay, give a sell. On which date? On day 2. On day 2, what is the sell? 2297. 2297. So some C will come between these two. C will become the buyer. C will become the buyer. Okay. So 2297, 2297. This is how it will happen. Okay. Now revised position will be like this. A is a seller. A went out. Now this contract is between C and B. C and B. Okay. Next, day 3. C is a buyer. B is a seller. Day 3. Day 3. B want to leave. B want to leave. What B will do? B will take a, originally what is the position? Sell. He want to leave the market. Means what? He has to take a reversal position to leave the market. Okay, reversal position to leave the market means what? He has to take a buy position. He has to take a buy position. So day 3, day 3, what will happen? B, or I will write like this, C has taken a buy position already. Okay, C has taken a buy position. B has to take a buy position now. Which position, sir? Buy position. He has to take a buy position and he has to leave. Once he have taken a buy position, automatically what will happen? Original position is a sell position. He has taken a reversal position. He will go. In his place, new person will come. Okay, let's say D will take the sell position. D will take the sell position. Okay, that means he will take a reversal position. His seller position will be taken by some other person, perpetual succession type. Okay, some other person will take a sell position. He will reversal, give a counter buy, and he will leave the market. So buyer want to leave. What to do? Give a sell. Seller want to leave. What to do? Reversal, give a buy. Give a buy quotation, you leave the market. But how these buy and sell quotations will be given? We have two problems on that. Those two problems, if you do, full clarity. But one point we need to understand, can we exit before maturity? That's the answer. Okay, please write down. Can we exit before maturity? Write down. Yes, we can. Yes, we can exit the futures market we can exit the futures market before maturity date also. That means all the buyers, if they want to exit, all the buyers, if they want to exit, they have to take a sell position and leave. They have to take a sell position and leave. And if a seller want to leave, if a seller want to leave, he has to take a reversal buy. He has to take a reversal buy and need to leave the market. He has to take a reversal buy and need to leave the market. And need to leave the market. So a person entering into futures, so a person entering into futures need not wait till the maturity date. Need not wait till the maturity date. Need not wait till the maturity date. Okay, so this is the completion of question number 1. So D, E, F. Once again I will revise and then I will go to the next part. How the contracts are settled on maturity. On maturity date, buyer will not really buy, seller will not really sell. Buyer will take a sell position, sellers will take a buy position. Profit may come, loss may come, anything can happen. Next, what is the position on the date of maturity in the given problem? I have shown you 7 rupee profit, 6 rupee loss. Seller 7 rupee loss, 6 rupee profit. Like that it happened. Can we exit before the maturity date? Yes. no need to continue till the maturity date. You can also exit before the maturity date. So if you want to exit before maturity date, what you need to do, all the buyers has to take sell position, all the sellers has to take a buy position and leave the particular futures market and you go. Your sell position, you remove the shoes and you go. Your buy position is there, you remove the shoes, in the same shoes another one will come and sit. Okay, he will be stepping into the shoes of another, he will go, another will come. Likewise, once a contract is created between two parties, contract will not get cancelled, parties may change. Okay, contract will not be cancelled, no contract is cancelled, all the contracts are honored. So every contract will be honored, just the parties may change. Originally on 1/1/13/2014, contract may be created between A and B for 2278. A and B may change, but the contract will remain. Okay, in the middle, A may go, A may come, B may go, B may come. A may become seller, B may become buyer. Sometimes A becomes seller, B become buyer. Whatever can happen, it is like a literal gambling work that happens. Okay, so you can exit before maturity. Buyers has to give a sell, sellers has to will give a buy. Sir, I am having misclarity, sir, not yet clear. Question may arise because I didn't take any great numbers here to explain. Therefore, now I will put a attempt to explain you these concepts with problems. With what's a problems? We will now do problem number 3, 4, sorry, problem number 2, 3, 4 and 5. 2, 3, 4 and what's a 5. Let us try to understand problem number 2, 3, 4 and 5. If you do that, you will really understand what is the concept of settlement on maturity, position on maturity, exit before maturity and mark to margin. So you may get it out, sir. You said 7 rupee profit will be deposited, 6 rupee loss will be taken from where, sir? Bank account means from my bank account. Who the hell he is to take? That's why we will create an account called as a deposit account, also called as a margin account. How it actually apply, we will see in this particular problems. Clear, everyone in the class? So let us first try to understand what is this concept. Okay, before even going into this one last time, I will revise A to F. What are the various types of market entries? There are two types of market entries, namely cash market and futures market. Cash market and futures market. So cash market is a place where we will buy a share today. If you want to buy and sell a share today, that market is called as a cash market. If you want to buy and sell a share in the future, so we enter into futures market. Next, various types of positions. One is a buy position, also called as a long position. Another one is a sell position, also called as a short position. Can futures be traded individually in singles? You can't. Standardized lot sizes will be there. How contracts are settled on maturity? If you wait till maturity, buyer become a seller, seller become a buyer. No sir, I want to go before. Then also take a sell if you are a buyer, take a buy if you are a seller, leave the market and go. What is the position on maturity date in the given problem? It is only numbers. Next one. So hope everyone understood question number 1 clearly. Okay, so though I didn't give any notes for this, only explained, you copied the notes fastly. I explained for 1 full hour. I have taken 1 hour time to explain how the futures concepts will actually work. So basics are the main point for the futures. If you understand the basics properly, remaining concepts will be digested easily. Next, let's solve question 2, 3, 4 and 5. Okay, at least let us solve 2, 3, 4 first. Okay, meanings we will understand from question number 2, 3 and 4. Take question number 2. On 15th January, Mr. X has bought a January Nifty contract which cost him rupees 2,69,000. For this, he has to pay an initial margin of 21,520. Each Nifty futures contract is for delivery of 200 Nifties. On Jan 25th, Nifty closed at 1360. Calculate the profit or loss and amount realized. Read the question before we go with the solution. Completed reading the question. See here. On 15th January, Mr. X has bought a January Nifty contract which cost him 2,69,000. For this, he has to pay an initial margin of 21,520. Each Nifty futures contract is for delivery of 200 Nifties. On Jan 25th, Nifty closed at 1360. Calculate the profit or loss and amount realized. He opened on 15, he closed on 25th. What will happen? He is asking. First, we need to understand how many contracts he has opened. Okay, price per the particular share we need to understand. So first take calculator everyone. See here. Totally he spent 2,69,000 divided by each contract is having how many Nifties? 200. Means each one the price is 1345. You are buying. You buy today now, you buy in futures market, futures market. That means on 15th January you bought futures. Means what? You will have a opportunity to buy it in the futures market. Okay. So first, how to do this? Write down. Step number 1, calculation of price per share in the futures. Price per share in the futures. Total amount rupees 2,69,000. Number of Nifties in a contract 200. Price per share equal to 1345. 1345. Step number 2, calculation of profit or loss. Calculation of profit or loss. Okay. So let us now calculate the profit or loss arising out of the transaction. See here, I said I will buy at 1345. Really on maturity date, I will take a counter sell. By the time I am leaving the contract, how much is the price? 1360. Okay, I'm having a profit or loss. I sell at 1360, which I bought at 1345. This is how it will be. Really I will not buy, real I will not sell. Okay, real I will not buy, real I will not sell. When I say I will buy at 1345, one person has already agreed to sell at 1345. Buyer will become a seller. Seller will become a buyer. Means what? He has to buy at 1360. A share worth is 1345. I will sell a share worth 1345, 1360. I will make a gain. 1360 minus 1345. How much? 15. Okay. Profit per share. But we want profit per share, profit per one contract, profit for one contract. So number of nifties per contract. How many? 200. So what is the total profit? 200 into 15. How much? 3000. I paid a margin money or not? How much margin money? 21,520. Is it correct? Yes, 21,520. So I deposited 21,520 in the margin account. Okay, stock exchange will collect a margin. I kept 21,520 in that margin account. Means what? If I keep 21,520 into that margin account, from that margin account only any profit will be added, any loss will be withdrawn from that, and it will be paid to the counterparty. So I will now realize how much? 3000, 21,520, 21,520 plus 3000, 24,520, 24,520. That's what he asked. He asked about profit or loss. 3000. Amount realized 24,520. Just half a minute time. Copied on. Next one. Question number 3. Question number 3. On 15th January, Mr. X has sold a January Nifty contract which cost him rupees 2,69,000. For this, he has to pay an initial margin of 21,520. Each Nifty futures contract is for delivery of 200 Nifties. Now it is closed at 1390. I took a futures contract to sell, to buy, to sell today na in future at how much price? 269. Each contract will contain how many Nifties? 200. So per contract means I think the numbers are same na. So it is 1345. Okay. Step number 1. Right on. Calculation of price per share. Total amount 2,69,000. Number of Nifties 200. Sorry. Price per share or price per Nifty. Sir, what is the Nifty, sir? That all I will explain in the middle of the chapter. Okay. 1345. At this price, I promise to buy a sell. Step 2. Profit or loss and realization. Okay. Let's solve. Tell me. I have a original position. Okay. To sell. How much? 1345. I will buy to come out. Okay. At what price? 1390. My buy is more than sell. That means I will pay the money to the other party. The counterparty will get the profit. Okay. I will pay 1390. Technically to tell opposite party, okay, I will be buying from him at 1390. He will sell at 1390. For me, it's a loss. Extra I will be paying na. So technically How much is the loss per Nifty? 45. Number of Nifties 200. Total loss 9,000. Margin 520. So net margin amount 12,520. 12,520. So this is how it will happen. So 12,520. So I have a original position of sell. I want to come out of that market. I need to give a reversal buy. If I give a buy, someone has to take a sell position. My sell position will be taken by some person. I will take a buy and I will go. Okay. So if I give a sell position, what will happen automatically? If I original position is sell, I have to give a buy. Some person will take a sell position. My sell position will be taken by some other person. I will leave the market. I have a loss of how much? 45. I have a loss of how much, sir? 45. How this 45 will be booked? Everything we will see. Each and every point, whatever the doubts you have. To some extent, now it is clear na? This margin amounts, how this loss and gain will be booked. Everything also we will see in question number 5. 8 marks question already asked in exam. Similar model questions 3-4 times they came in examination. Okay. Let us now go to question number 4. Mr. Ram buys TCS futures today at 1500 and hold it for 3 days, and the futures prices at respective 3 days are day 1 1520, day 2 1490, day 3 1600. Explain how will he realize the profit over the holding period. Very good question. Please read the question before we start doing the solution.
So let us continue with the futures. The basic question, whatever we have done, everyone understood the concept clearly, yeah? So summarize everything. You should answer what are the 2 types of market entries: cash market and futures market. Okay. What are the price quoted in the cash market? It is a price quoted today for a transaction to happen today. What is the price quoted in a futures market? It is a price quoted today for a transaction to happen at a future date. Next, what are the various types of futures positions? What are the various types of futures positions? Futures long, futures short. Futures long position means what? Buy. Future short position means sell. Can futures be traded individually in singles? No. Standardized lot sizes. How the contracts are settled on maturity? Buyers are made as sellers. Sellers are made as buyers. Like how they will contrast the transactions will be entered. They will counter the transactions. No contracts are cancelled. All the contracts are countered. So for buy, counter sell will be given. For sell, counter buy will be given. One very important thing, futures is a market in itself. You want to enter as a buyer, give a buy and enter. Give a sell and exit.
as a seller, give a sell and enter, give a buy and exit. In a cash market, buyer will enter, seller will exit. Cash market, normally I want to become member of TCS, buy and become member, sell and become non-member. But futures market is completely virtually different market. That's why it's called as a, it's not called as a closed, it's called as an open interest market. Which market? Open interest market. Open interest means what? You can enter on both the sides. Simply to tell, you can enter as a buyer. You give buy. You will become a buyer in the futures contract. You give a sell and you will become a seller in the future contract. I want to disassociate as a buyer. Give a counter sell. I want to disassociate as a buyer. Sorry, I want to disassociate as a seller. Give a counter buy. Tell me, I want to enter into the futures market as a buyer. Take. I want to become a buyer in the futures market. Give a buy position. Take what position? Buy position. I want to come out. Sell. I want to become seller in futures market. Give a sell. I want to come out. Give a reversal buy. Everyone understood the point clearly? That's all. This is what the point. Next. What is the position on the date of maturity in the given problem? Now monetarily we have done the numbers. And can we exit before the maturity date? Yes. All the contracts are honored. No contracts are cancelled. Only just the parties will change. First day transaction is between? Answer. Who sold? Who came? Transaction is revised between C and B. Next what happened? B exited. B exited by giving the buy position to whom? D. D. So transaction continued between C and D. So the original parties who are there at the beginning are there after 3 days? No. Like that, hundreds, thousands, lakhs of parties will change. On maturity date, which two will be there? Between them, maturity prices will be shared. Clear or not, everyone? That's the point, sir. Hope everyone has got a clarity here. Now, listen carefully. Let us take calculators and do some calculations now. Take question number 2, study material question again. We will do 20 questions on futures today. How many? 20, covering all concepts of futures. 20 questions we will do. Every question in your study material also will be covered along with those. Take question number 2. Institute study material question, old study material. So, you can do roughly, no problem. But don't fail to do the answer. You help me in doing the calculations only. First tell me, on 15th January, Mr. X has bought, first one underline that, he is taking which position? Buy position. On which bought a January Nifty contract, which cost him how much? 2,69,000. So tell me, total how much amount he entered? 2,69,000. We should tell in total, we should tell per contract. Per contract. For this, he has to pay initial margin. How much? 21,250. Sorry, 520. Sorry. Each Nifty futures contract is delivery of how many Nifties? 200. Means how many units are there inside one lot? 200 units. On Jan 25th, Nifty closed at how much? 1360. Calculate the profit and loss, profit or loss, and the amount realized. First one, sir. Second question I will do. Third question I will give a time for you to do. Second question. First tell me, see the screen. See the screen, give me answer. What is my original position? Buy ya seller? Buy seller. Buy. At what rate? Don't tell like that. 2,69,000 divided by 200. Tell me how much? 1. Correct? 1345. Really, I will take a buy position on the maturity date. I will take a reversal. Reversal position is buy a seller, sell. At that time, it closed at how much? 1360. I made a gain or loss? Gain. Gain of how much? How many Nifties are there totally? What is the total profit? How much I deposited as a margin? So what is the total amount realized? 24,000. That's all. That's the answer. Everyone understood how to do the answer now? Please copy down. Make it fast. Same do for problem 3 and give me the answer. First point, tell me, everyone copied this answer? Do third problem now. I don't give you hint, you solve it easy. Original position is a sell, buy. Sell means I am entering into futures market by giving you original position of a futures sell. Okay. Futures sell if I give, I will really sell, I will take a counter buyer. Answer, counter buy. At the time I came for buying, what is the price is prevailing in the futures market? 1390. I will get a gain or I will get a loss. Loss how much? 45 into how much? 200. How much? 9,000. 9,000 is a gain or loss? How much margin I deposited? From that it will be added or it will be deducted. 21,520 minus 9,000. How much? That will be the total amount realized. Do the answer. Completed? Don't spend so much time on basic questions. Everyone understood the concept. Can I go to the next one? Next. Question number 4. Question number 4. Write down, that is also old ISM question. Old Institute Study Material question. Very good question actually. May not be tested in exam, but conceptually a very good concept will be communicated through this particular question number 4. Please see the screen once. See that. First, he asked to do this question from Mr. Ram point of view. I will do it from Mr. Ram and Mr. Lakshman point of view also. Listen why I am doing that. In the question he is asking which position? I am Ram, you are Lakshman. You will do from sell position also. We will do from sell position. He has asked only buy. But let us do from sell position point of view also. You can really understand the meaning clearly. Clear? Okay. Now, first read the question. Mr. Ram buys TCS futures today at 1500 and hold it for 3 days. And the futures prices at respective 3 days are as follows. Day 1, 2, 3, 1520, 1490, 1600. Explain how will he realize profit over the holding period. First question I ask you, listen. Ram's original position is what? Your original position is what? That's all. Because without a seller, there cannot be a concept of buyer. Buyer has to be matched with the seller. So I gave buy position, sell position, buy. You gave a sell. Both gave buy, sell at what rate? At what rate? Very good. Now listen carefully. Every day end, same price is prevailing, different prices are prevailing. Listen, this is the main structural understanding one should have when we are discussing about futures. See here. I will do and I will give time for you to copy. Please listen carefully. First, let us do for Mr. Ram. Simultaneously, I will open account also for Mr. L. See here. See the screen once, everyone. Tell me. Day. What is my original position? Buyer, seller. Reversal position will become profit or loss. Revised futures price. May be confusing initially. I will explain any number of times you want. Please listen. Same we have to replicate also here. Please tell me. First one, day. Original position is buyer, seller, sell. Reversal position will be buyer, seller, buy. Profit or loss, revised futures price. See here, everyone. First, see the question and help me with the numbers. First, both of us, me and you, opened with what rate? 15. You gave how much? 1500. So tell me, I gave buyer, seller. You gave at what rate? Ram and Lakshman are matched by the software. Both of us entered into which contract? Futures contract today. Done. Now tell me, day end. That means at the end of the first day, the price in the market is prevailing at what price? Everyone. 1520. Okay. Now, listen carefully. 1520. It closed at 1520. Now tell me. When the market is getting closed at 1520, who will get a profit guarantee? But listen carefully. Really, we are closing the contract on first day, na? Therefore, listen to my wordings clearly now. In case of futures market, exchange will close all the contracts by putting a reversal transaction as if that day is the maturity date. Repetition one more time. In case of futures, I repeat, in case of exchange will close all the contracts every day as if that day is the maturity date. Now I will ask you a question, answer. On maturity date, what will happen? Just now I said, na. On maturity date, originally what would have happened? Buyer will be made as, sellers will be made as if every day is a maturity date. At the end, exchange will make buyer as seller, seller as buyer for one good reason. That reason I am going to explain using this problem. Shall I continue? See there. Point number one. What is the original position I have taken? What is the reversal position I have taken? Sell. Sell is a reversal position. Buy is a original position. Now tell me. My original position is a buy 1500. Your original position is a sell 1500. Market prices go on increasing. Day end settlement prices ended up with 1520. Clear? If at all, not really, if at all, day 1A is the maturity date, who will win? Who will lose? Ram will win, Lakshman will lose or not? Now who have a chances of running away from the market? Who have a chance of cheating and running away? Rama, Lakshmana. In this case, Lakshman. Therefore, from his deposit account, I mean margin account, I will first deduct some amount and deposit in his account. In whose account? Therefore, now tell me, in the account of Ram, there will be a profit or loss. How much? How much loss in his account? Answer. Because the market closed at what price? 1520. Now listen carefully to the point. Who is having higher chance of default? Therefore, in order to escape from the default, first we will collect amount called as a margin. Called as what? Sir, for suppose you will get a doubt now. What doubt you should get? If the loss is going beyond the margin collected, a question will arise or not? If 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 the loss is going beyond the margin, what will happen? A question may arise or not? So listen, if the margin is going beyond if the loss is going beyond margin, that question may come. But 99.9999% of the cases that can't happen because they use a software called as a span. Span calculates the volatility of a stock by taking 365-day, technically to understand 52-week average volatility. On that basis, they will add another 20% and collect a margin. Suddenly, that much loss, no company will show all of a sudden. For example, actually 10,000 is required. They will collect 35,000 margin. Did you understand the point or not? Actually 10,000 is required, but they will collect 35,000 margin they will collect. Sir, okay. All of a sudden something happened, deposit amount has vanished, everything is drained. What will happen? They will ask you to leave the futures market and pay the balance to the exchange, or else your demat accounts will be cancelled and seized. If that amount is going beyond 1 crore, going beyond, and you are not paying, they can recover under insolvency code. Are you understanding the point or not? All avenues are available. No money is at risk in stock market today. Everyone understood the point? Okay, done. Now answer my question clearly. Listen, first day 1, I gave buy a seller. You gave. I gave buy at 1500. You gave sell at. Both are 1 day completed. At the day end, price went up or came down? Went up to how much? I will make a loss, I will make a gainer. You will make a loss, I will make a gainer. Therefore, who has a chance of running away? Therefore, without giving me the profit, you might run away or not. Therefore, from your margin, I will take that 20 rupees and deposit in whose account? Ram's account, by taking money from Lakshman's account, and both are now closed at what rate on the end of the day? 1520. We both are closed at 1520. This is called as marking to the market. This is called as what, sir? Who is marked to market now? Buyer or seller or both are? Both are now marked to market. Here, second day. You should see the question and tell me. Second day, what happened to the price? Fall or rise? I have opened with 1520. The price has fall to. Tell me. Now you should only tell me 1490. Now you should only tell me. Likewise, you also opened at 1520 or not? Reversal you will get at what rate? 1490. Now tell me. Who is getting a loss? How much? Who is getting a profit? How much? Who has a chance of running away? Therefore, from Ram account, how much I will collect? 30 rupees deposit in Lakshman. Now, anyway, I collected, you will stay now. So, performance default should not be there. For that purpose, I will maintain an account called as margin accounts. Here or not, everyone? So, day end, what is the closing? What is the closing? 1490. Now, tell me. Day 3, both of us opened at what price? How much? 1490. Okay, now tell me, at what price I have closed? Everyone, tell me, I have to write in Ram, buy ya, sell. Answer, sir. At what rate? 1600. Buy ya, sell, sell. Tell me, what is the profit or loss? Profit, how much? 110. Now tell me, Lakshman account, buy ya, sell. Answer, at what rate? Wrong. అయిపోయింది. ఇది తెలుసుకుంది నేను. See here. Hold it for 3 days. Ram is selling. 1600 is not the closing price on the third day. Somewhere at 11:30, 12 o'clock, he is selling. Say, for example, he is selling to Mr. Bharat. Example. That is not the price traded between. That is not the price traded between Ram and Lakshman. That is straight trade between Ram and Bharat, some third party. Clear or not, everyone? So therefore, here in our this account, you don't know what happened after that. Okay, here only it happened. This is to Lakshmana, not to Lakshmana. Lakshmana, not to Lakshmana, not to Lakshmana. Some Bharata Shatrugna, some person has taken this. Are you understanding the point or not? Because this is not a settlement price at the end of the day. It is the trade price happened between Ram and some other person. Means Ram is exiting on maturity or before maturity. 3 days like he is closing, he said, nah, that means he is staying till maturity or closing before maturity. Tell me, Ram has taken which position? Buy position and entered into the futures market. He want to come out. What he has to do? Sell. Sell to whom? Some person. Clear or not? He took sell. Some person has taken buy. He will come into the picture. Clear? Now the contract on the third day will end up between whom and whom? Lakshman and Bharat. Not between Ram and Lakshman. Understood or not, everyone? That's all. This is how we need to understand the mark to market. First, to answer my question clearly, tell me now. How much profit I made? Tell me. Plus 20 minus 30 minus 10. Minus 10 plus 110 will be how much? Answer. What is the buying price opening? Closing price? Difference? That 100 is collected over 3 days. Clear or not, everyone in the class? So this is how futures profit settlement will be made. Understood the point, everyone, or not? First tell me. Okay, if you want, you copy it this way. Copy this. First one is enough for that question. If you want, you copy down the second one as well. First one for the Ram, have you completed? For the other person, just for sake of understanding, if you want to copy, you can copy this. Completed. Next question. So how many questions we completed now? 4 questions we completed. Let us take the 5th one. I promise you with 20 questions totally. So take question number 5. Mark it very, very important. Recently in one attempt, this question is tested also. Mark it very, very important. Already tested in exam. Read the question once before we start with the solution. So read the question. Thank you. Okay. See here. Read the question. On November 15, when the spot price of telco is rupees 473 per share, Mr. X buys 15 contracts of July telco futures at 491. Assume that the initial margin for telco futures is 800 per contract and the maintenance margin is 600 per contract, given that each contract is for 50 shares. Daily settlement prices for the next few days are now 15, November 15, 496, 16, 17, 18 and 19. Assume that Mr. X withdraws the profit from his margin account only once on November 16. When he withdraws half the amount allowed, compute the balance at the end of each of these 5 days. This is a question that is being asked. First, read the question properly. Don't commit mistakes once we start. Before that, I will first explain you 2 basic concepts to understand on margin accounts. Listen, attentively listen first. Margin account is collected for the purpose of, margin amount is collected for the purpose of, first one is a performance default. Okay, there should not be a performance default. Therefore, there should be some sort of measures that the stock market has to take. That measure that the stock market is taking is called as what? Is called as a margin. Margin is of 2 types. Everyone attentively listen. Margin is of 2 types. First one is called as a initial margin. First one is. Second one is called as a maintenance margin. Second one is maintenance margin. Whenever initial margin I call, initial margin will be for contract. Will be for a contract. Per contract margins are collected, not on per share. One contract will have some number of shares inside. For that I will collect one margin. Clear or not? That means margin is collected per share. Margin is collected per contract. This will be helpful for you when you calculate currency futures. ఇక్కడ ఓవర్ యాక్షన్ చేసి వినకపోతే అక్కడ అయిపోతారు. So I am telling you very clearly. Point is, margin will be collected not on share basis or dollar basis or euro basis. It is collected on lot basis. Volume margins they call. Clear everyone? Those are called as volume margins. Asal margin account real name is volume margin account. Originally you see the futures contract contract settlement note. Gmail they will send whenever you buy and sell futures. They will clearly tell volume margins. It is called as a volume margin. I am not giving margin on one share. I am giving margin on a contract created. One contract will have one share. One contract will have multiples of shares. Therefore, it's not a margin. It's a volume margin called as a contract margin. Okay, point number 1 over. There are 2 margins: initial margin, maintenance margin. Listening everyone? So how many margins are collected? 1. Initially collected, initial reorder level, materials chapter. Like that, maintenance margin is a reorder level. Maintenance margin is a reorder level. Whenever, see here, like this I can explain. This is which margin? Initial margin. This is which margin? You can fall below this, but not below this. Nothing is required, no measures you need to take. Action required to be taken or not required? Answer. Very good. But fall below this. Answer. Immediately you should make a top-up recharge. Simply you can understand that way. Immediately you should make a top-up recharge. The top-up recharge should be made to reach initial margin again. So tell me, when I need to make a top-up recharge? Whenever the margin amount is falling below the maintenance margin, we need to deposit such amount in order to reach initial margin. Everyone understood the logic clearly? Second question I am asking you. Tell me. So this is one question that we need to answer. Second, whenever initial margin, maintenance margin is there, initial margin, maintenance margin are two collections, only one collected. What is that one? In the pre-order level is called as I gone below initial but above maintenance. Required or not required? Fall below maintenance. Required to reach that amount is called as variation margin, VM. In your margin accounts, VM it will be written. Okay, what it is called as VM. VM means what? Variation margin. Up to here, understood or not? So tell me, what I said, repeat. Tell me, how many types of margins? 3 types. Number 1, number 2, third one, variation margin. Variation margin is a deposit or withdrawal. Deposit or withdrawal. Deposit. Whenever the amount is falling below the maintenance margin, you should top up recharge with that much amount as to reach the initial margin. Therefore, that amount is called as variation margin. Everyone understood the point up to here? Let's continue now. That's all. Answer over. We have to just put this knowledge in the form of numbers and answer and complete this answer. 3 to 5 minutes maximum. Let us do. Take your book. If possible, turn book like this, because we will open one single account for all. Did you understand what I said? Do that now. Let us do together. I will also do. I will not just show you the answer. I will also do along with you. But help me with the numbers. Tell me. First, let us write down some working notes. Number 1. Initial margin. Tell me, initial margin that I have to deposit is how much? First, hello. 1 second. How many contracts? How many contracts? 15, 15, okay. I am also a human being here. Sometimes mistakes happen. Leave off. Initial margin. So tell me, initial margin will be how much? Initial margin will be how much? 15 contracts into 800 per contract. Tell me. Second one. Maintenance margin. Calculate. 15 contracts into and total is how much? 12,000 plus 9,000 equal to how much? Don't do that. 21,000. Oh, alganmata. నేను ఎన్నో మోసాలు చూసా. సో నేను అన్నా అనేస్తా. So listen carefully. So tell me, 12,000 is the initial margin. Maintenance margin is 9,000. So 12 plus 9, 21 will be collected. No, 12,000 lone reorder level is 9,000. Now tell me, my margin fall to 10,000. Top of recharge. For example, 9,550, 9,000, 8,000.
Yes, sir. How much? If it is really 8,000, how much you need to do? 4,000. It has to again reach initial margin. Done. Let us do. So let us solve the problem now. So please everyone do together. We started our transaction or trade from which date? Date given. November 15. Opened the contract on what? 15th November. First column date. Date. Turn the book and write down. It may not be sufficient to write directly in a paper. You have to turn into landscape or else it may not be possible. Okay. Then everything will come in one single paper. First write down the columns. First date. Original position is buy ya sell la. Write down OP buy. I will take a sell position on maturity ya every day ya. What I said? Every day alla nenu. What I said? Exchange will close all the contracts every day and as if that day is a date of maturity. Sir, tell me, in the last question also, 1520, 1490, some prices are there, na? Those are all prices at the end of the day, na? Beginning of the day, na? None of the above, those are settlement prices given by exchange. Sir, practically something different happens. 1490, 1520 are not prices given by Koushik Mukhesh. For example, sir, I will tell you, derivatives transaction in the market closed at 3:30 in the afternoon. Last transaction is me. I traded at 1512, but it is 1520. Who gave it? Exchange will close you at 1520. Those are called as settlement prices, not last traded prices. When you will know, you really see one futures contract document or do a trade, you can understand, or see futures contract traded prices now. Settlement price is different, last trade price is different. In the news you will see the last trade price, that will not be settlement, you can see immediately. Settlement price will be something different. 8-9 rupees difference will be there. Who will decide? Exchange will decide it. Understood the point or not? After Arshan Mehta scam only all this happened. SEBI has taken all the powers regarding the securities market, and what they have said is stock exchanges were given the wide powers. You decide about the settlement prices, or else market manipulation is happening. Clear? Sorry, that's not the time to discuss about that. But still, opening how much? Sorry, amount also leave off. First I have taken opening buy sell. Very good. Closing I will take a. Okay. I may get a profit or loss. Anything can happen. Okay. Total. Next. After this, the next one is opening balance. What opening balance? Margin opening balance. Margin opening balance. Total balance. Means profit loss we have to add or deduct or not? Total margin. Next, deposit, also called as a variation margin. Next one, withdrawal, which we will withdraw from the balances. After that is closing balance. This is the schedule. Help me with the numbers. Please do together. Date. First we started our trade on which date? November 15th. Opening position buy sell buy. At what price? 479. Spot price 473. It should not be taken. 473 is a price traded in. అది అందుకు చెప్పింది ఫస్ట్ లో వాట్ ఈస్ డిఫరెన్స్ బిట్వీన్ క్యాష్ మార్కెట్ అండ్ ఫ్యూచర్స్ మార్కెట్. ఐఎమ్ నాట్ ఎ మ్యాడ్ ఫెలో, ఐఎమ్ నాట్ ఎ డామ్ బ్లడీ ఫూల్.
unnecessarily to talk about certain things. Sir, నేను డెరివేషన్ చెప్పిన, కాన్సెప్ట్ చెప్పిన, ఫార్ములా చెప్పిన, వాట్ ఎవర్ ఐ సెడ్, ఓన్లీ ఫర్ యువర్ వెల్ బీయింగ్ టు అండర్స్టాండ్ ద కాన్సెప్ట్ ఇన్ ఇట్స్ రైట్ సెన్స్. So please catch it. Why I said the differences between spot price, cash price, futures price, like this confusion will come. Prices la confusion will come. So tell me, what is the price traded in the cash market? 473. Okay, but we are trading on cash, we are trading on futures. At what price? 491. Write down. 491. On that date, I closed with 491. Different price. Different price. What price? 496. Okay. So never do like this. See here. Never do like this. November 15 below, November 16, November 17, November 18. Don't do. Because you don't know what happens to the margin on the same day. You have to do on daily basis. Margin account should be prepared on a daily basis. Okay. Don't fill information in advance. So tell me, I will get a profit, loss. How much? 5. Total profit. First tell me, 5 is a profit per share. We have how many contracts in hand? 15 contracts. One contract, how many shares are there? 50. How much is the total part? 15 into 50 into 5. Anta? 3750, correct? How much is the opening balance you opened? 12,000. 12,000 plus 3750, how much? 18,000. 15,750. Do I made any deposit? Do I made any withdrawal? Closing balance is how much? 15,750. Day number 1, we closed margin accounts also. Everyone understood the point or not? Do the second one. November 16. Tell me, opening buy position is opened with how much? 496. Tell me, at what price it closed? Sir, everyone participate, sir. 503. Profit or loss? How much? 7 rupees. Total 7 into 15 into 50. 53. 5250. Okay. 5250. So totally already opening balance is how much? 15,750. Tell me, 5250 plus 15,750. 21. Stop. Here question la some adjustment was given. See the question and tell me, on November 16, he withdraws half the amount allowed. Okay. First tell me, take calculator. Please take calculator. How much is the balance in my margin account as on 16th November? 21,000. Now tell me, how much money must and should I should maintain? 12,000 minus 12,000. How much? 9,000. In this 9,000, entire 9,000 I withdrawn, half I withdrawn. So how much I withdrawn? 4,500. Withdrawal or deposit? Withdrawal. 4,500. So now tell me, what will be the revised balance? Revised balance 21,000 minus 4,500. How much? 16,500. Next, November 17. Tell me, November 17. Again, you open with 503. Oh, closed at 488. Rahu Kalan start. Tell me. Plus minus minus how much? Minus 15. Okay. Total loss 11,250. Opening balance is how much? 16,500 minus 11,250. 5,000. Now everyone answer this. 5,250. My balance has a fall. Can I continue trade? Cannot continue. First, what I have to do? Top up recharge. Top up recharge to reach. So how much I need to deposit? 6,000. So total margin balance will be revised to 12,000 again. Everyone understood or not up to here? November 18. I opened again at what price? 488. Okay. So I opened at 488, closed at Still daridram on. So how much? Minus 3. Tell me what is the total loss? Answer, sir. Everyone, don't say title. 2250. Loss again, loss. How much is the balance? 12,000 opening. Okay. Now again I have to deposit. Yes or no? No, not required. Loss came, sir. Deposit. Every loss don't require deposit because 12,000 minus 2,250 is 9,750. 9,750 is within maintenance margin, below the maintenance margin. Within what is the maintenance margin? Our balance has a fall to how much now? I told you very clearly. We are not falling below maintenance. We fell below initial, but beyond the maintenance or not. That means we maintained that level. No problem. Deposit required, not required. So therefore, deposit not required, withdrawal not required. Closed at 9750. November 19th. 485 is closed with 491. Okay. Now tell me. Profit or loss? Profit. 6 profit. How much? 4,500. 9,750 plus 4,500. How much? 14,250. No deposit, no withdrawal. Close it how much? 14,250. 6 marks. First tell me everyone, are you comfortable with margin accounts preparation and day closing, sir? This is how they will ask the questions in examination. Clear? With this, we have completed mark to market closes here. From here, margin accounts. But we completed both in a single set. Hope I can move on to the next calculations. Everyone in the class. Now we have completed futures concept. Basics to 5th question we have completely done. From now, we are going into next concept called as a futures pricing. Futures pricing. So, see the concept once. What is the name of the concept? Fair futures pricing. See here. So the name of the concept is fair futures pricing. What do you mean by a fair futures pricing? Let us try to understand clearly. First, listen. Futures pricing means at what rate futures should have been priced. I'm not telling actually priced. At what price futures should have been priced at. At what price they should be. How it can be. How it should be. That's what we are going to calculate now. Really that will be there originally in the market or not, nobody will know. But we expect that that should be there. So how much price the futures should have been traded in the market is calculated using a model called as FFP. What is FFP? Fair futures pricing. Fair futures pricing. Listen, sir. Here, there are two types of concepts. Number one, for stocks, for commodities. For stocks and commodities. When it comes to stocks, we use three kinds of model, or technically two kinds of models. See here, first model is called as no dividend model. Next one is called as a dividend model. Dividend models are again divided into two parts. Dividend expressed in rupee terms, dividend expressed in percentage terms. This is also called as a yield terms. Commodities will popularly worldwide they will follow CTC model. CTC represents cost to carry model. Okay, these are the first models that we need to understand. No dividend model, the formula is F equal to S into E power TRF or TR. Anything is correct. Clear, everyone? TRF. RF means what? RF means what? Risk-free rate. Sir, always if you observe, futures and options will use risk-free rates. Yes or no? ఎప్పుడైనా అబ్జర్వ్ చేశారా పోనీ? Always you see, entire options and futures will use only risk-free rates. There should be some reason behind that or not? That we will discuss in binomial model. Which model, sir? Binomial model. In that model, we will understand about why risk-free rates are used throughout the valuation procedures. There is a reason for that. There I will only discuss about it. So just to make you realize the fact that risk-free rates are important. See here. This is which model, sir? Binomial model. Here clearly I have given why which rates are used. Risk-free rates. Yeah, here I have given the risk-free rates. Why they have given. So this is all the reasoning. So lastly, you can see portfolio shall be risky so as to use the risk-free rates, and that's how they started developing the models. So this is all the introduction to that particular binomial model. At that time, I will only discuss about what is the concept of risk-free rates. Why all derivative models will consider only risk-free rate. There should be some logic or not, otherwise why they will use. There should be some reason behind. That reason I will tell you later. Therefore, always try to write RF. Whenever you write R, instead of writing R, you write RF. Such that your mind will always repeatedly say you that we will consider not normal rate. R means it can be normal rate also. Na? If you write RF, na, your mind will always remind you, okay, derivatives we will use only risk-free rates. That's why if you see in all futures questions you see in your book, continuously compounded risk-free rate, they will use like that. Continuously compounded risk-free rates, they will tell that. Okay, see there now. S into E power TRF or RF into T. You write RT na? RT you are writing instead of writing RT, RF into T you write down. Your mind will go on repeatedly saying you that we are using risk-free rates, not normal rates. Shall I continue? Okay. So tell me, dividend model S minus present value of dividend into E power TRF or RT, whatever you call. Next, dividend on a yield basis. F equal to S into E power T into RF minus D. Cost to carry F equal to S plus S plus CTC minus CY. Meanings I will tell you. CY means what? Convenience yield. First copy down this chart, sir. Sir, here notate everything. F equal to fair futures price. S equal to spot. T equal to time in years. Time in years. Means if they give 2 months, don't multiply with 2 into. You should multiply 2 by 12 into. That's called as year terms. Time in years. RF equal to risk-free rates. Completed? Completed everyone? PVD equal to present value of dividend. Present value of dividend. Present value of dividend. Next. CTC equal to cost to carry. Cost to carry. CY equal to convenience yield. Convenience yield. Completed. CY equal to convenience yield. Shall we continue everyone? Now listen carefully to the point. See here. These are the models. On this, minimum 10 times exam questions came. In 2 ways they will ask. Direct valuation question they will ask, or they will ask valuation with arbitrage. These are the 2 questions which are very popular. Either they will ask a plain valuation question for 3 marks, 4 marks, or else they will ask valuation with arbitrage for 6 marks. This time heavy chance is there for futures and options in exam. I am expecting minimum 25 marks to come from those 2 chapters. Then what they will do, in every model they will represent one question. Okay, in good or bad way they will represent. Let us do all the types of questions then. So therefore, first listen carefully. How many kinds of models are there? How many kinds of models are there? First, stocks, commodities. Stocks will be done using which model? Dividend, no dividend model, dividend model. No dividend model, what is the formula? F equal to S into E power TRF. Next, dividend model of dividend in rupee terms. S minus PVD into E power TRF. Next, yield basis. F equal to S into E power T into RF minus D. CTC model, F equal to S plus CTC minus CY. CY represents what? Convenience yield. First point, we will do the problems first. Logics, all these apart. First point, do you know the real logic behind how the futures formula came like that? There is a ground basic logic behind why the formula was written like that. That I will not do now. Let us first do the formula and answer. From the exams point of view, let us first do that. Once you complete, I will explain you how the formulas have been derived. How those formula came, meaning, their analysis, their intention behind, what they want to convey. I will explain in a clear-cut format once we do the problem. Clear? Let us start doing. Take question number 5 we completed. 6th one. Take 6th one. Sir, before, how to calculate E power something? Will they give an exam? Yes. Sir, listen. E power something they will give in exam. Sir, they didn't give in exam, sir, what to do? For that also we have a mechanism. Do you know how to calculate, everyone? Then okay. Sir, I'm moving on an assumption that you know that how to calculate E values. How many of you don't know evaluation? How to do? Evaluation, sir. Almost everyone know that. Then okay, let's continue. Let us take question number 6. Please. So please, let us start. Consider a 3-month maturity future contract in a non-dividend paying stock. The stock is available for rupees 200 with a continuously compounded risk-free rate of interest of 10% per annum. What will be the futures price? Dividend paying stock or non-dividend paying stock? Just apply the formula and do and tell me the answer. E values, please calculate properly. They didn't give there. Okay, done everyone. So E value is calculated. Calculate faster. E value calculate, multiply that. Completed. How much time you will take? Yeah, that's E power calculated, everyone. No. Sir, I will show you how to calculate E values. Then you said you know na. Ego na. Which ORX and chatla exams దగ్గర పెట్టుకొని see here yeah. If you don't know, if you tell, then I can understand. రాదని చెప్తాడు కొడతాడండి మిమ్మల్ని. Please see here yeah, then I thought you know that calculation. That's why I'm waiting for the answer. Please see here. Sir, E values whenever given in the question, if they don't give, you can calculate this way. For example, in that E power, how much you got? 0.025. Sir, whenever E value came like this, first listen carefully. 1 plus it is x by 1 factorial. X power 1, x means x square by 2 factorial plus x cube by 3 factorial plus so on plus xn by n factorial. Sir, why only cube? Why can't square? I stop. Institute will give the E numbers or not. Those are giving the answers where you stop at cube. For example, I can take x power 4 by 4 factorial or not. I will get one answer in decimals. Changes will be there. Institute answer is matching with the third one, cube. Okay, first tell me 1 plus, tell me x means how much here? 0.025 divided by 1. 0.025 square divided by 2 plus 0.025 cube divided by 6. That's all. Answer you will get na? Very easy. It will not take even half a minute. 15 seconds you can complete. Just see here. 0.025 m plus 0.02. Listening everyone. 0.025 m plus 0.025 square divided by 2. Again m plus 0.025 cube divided by 6. M plus 1 m plus 1.0253. See here. Not visible. Now visible. Now visible. What is the answer? Ante some people will think he know 1.0253. He is typing something. So 1.0253. 14th step. Okay. What is the answer? 1.0253. Okay. So tell me, what is the answer now? F equal to, yes sir, please. Slowly you are getting diverted again. Please come back. S into e power TRF. What is a S? Into 1.0253. Tell me how much? 2 not. That's all. This is the answer. First, everyone done the problem up to here. Take next question. Question number 7. First, this require some amount of understanding because we have to first calculate the present value of dividend. So see the question. How much dividend is there? 2.5. 1 second please. Silence sir. Let us first read the question number 7. ABC is quoted in the market at rupees 40. A 6 months future contract on 100 shares can be bought. Risk-free rate is 12% per annum continuously compounded. ABC Limited is certain to pay a dividend of rupees 2.5 per share 3 months from now. What should be the value of futures contract? This is a question that is being asked. First tell me, what is the spot? What is the spot? 40. How many futures contract make this? 100 shares makes one future contract. That is irrelevant anyway. What is the RF? At least now could you observe the point? Rate or risk-free rate? Sir, why should I use E, sir? I use normal. Then he will strike off your answer. He said continuously compounded. Okay. I will do normal compounding. Then you will get normal marks only. You will not get marks for that question. So next, ABC Limited is certain to pay a dividend of how much? 2.5 per share. When? 3 months from now. What should be the value of the futures contract? Now everyone has to tell me one question. How many months is the total life of the contract? In that 6 months, I will get dividend at the end of 6th month, at the end of 3rd month. That means when I have to calculate PVD, present value of dividend, I have to discount by 6 months or discount by 3 months. Discounting means division or multiplication. Division or multiplication. Division. What should be divided? Dividend should be divided. Dividend should be divided. Divided with that particular factor. Continuous factoring will be there. That we have to divide. Shall we do the problem? Let us do together. Step 1. Calculation of PVD. Do along with me. Calculation of PVD. First, let us write the formula. Write down like this. Dividend into e power minus TRF. Minus TRF for what? Discounting. Minus TRF can be written as divided by e power TRF. That equal to how much dividend? 2.5. Whole divided by, I want every one of you to participate. I will receive dividend today after 3 months. So 3 by 12 into what is the RF? How much is the RF? 12%. So tell me, rupees 2.50 divided by e power 0.03. Everyone take out your calculators first. Do the mechanism. How to do? First 1 m plus. I will tell you how to do. Take calculators. 1 m plus 0.03 m plus 0.03 square divided by 2 m plus 0.03 into 2 times, okay na, divided by 6 m plus total MRC 1.0305 should be the answer. Sir, 0.01 1.0025 0.02 1.0202 0.03 1.0305 0.04 1.0408 0.05 1.0512 0.06 1.0618 0.07. I didn't remember because no question is there. So 0.10 0.10 1.1052. Like that the values will come. You will remember. Almost maximum numbers you will remember except some weird numbers. Sometimes 0.0833 will come. At that time you may not remember. But tell me, 2.5 divided by what? Tell me the answer. 2.43. So tell me, 2.43 is what? Futures price, present value of dividend. We want F. S minus PVD into e power TRF. What is the S? 40 minus 2.43 into e power 6 by 12 into 0.12. 40 minus 2.43. How much? 37 point? 37.57 into 0618. 39.90. Total contract value will be 3990 for 100. Sir, more time you are taking. Can I go to the next question? So how many questions we completed? 6, 7. Come to 8th one. 8th. See there. This question is given on price dividend, yield as a dividend. Yield as a dividend. A Limited provides a dividend yield of 4% per annum. Current value of the stock is 500. Risk-free rate 8%. What would be the value of the 3 months futures contract? Will you calculate? Do this. Start. Do that. Everyone, please do. Completed? Sir, how much is the value of the futures? 505.0? Sorry, okay, 505. Okay. Completed, everyone? Next question is a RTP question asked in one of the old RTP, if I am not wrong, 2015, like that, some atom, old RTP only, but fantastic question because dividend is received 3 times. Dividend is received how many times, sir? 3 times. Let us see the answer. Before that, let's read the question together. Hello, sir, please listen. Shall I continue? Come to question number 9. Suppose that there is futures contract on a share presently trading at rupees 1000. Life of future contract is 90 days. During this time, company will pay rupees 7.5 dividend in 30 days, rupees 8.5 dividend in 60 days, rupees 9 dividend in 90 days. RF is 12%. Calculate the fair futures price. Calculate the fair futures price. This is a question that is being asked. First tell me, I will be getting first dividend at which time? 30 days. I should use e power 30 by 360, 30 by 360 into 0.12. Next one, 8.5 into, are you understanding or not? 8.5 divided by 7.5 divided by 8.5 divided by 9 rupee divided by. Shall we do all the PVDs once? Let's start doing. Keep the heading. Question number 9. 9. So we have done 9 questions till now. Okay. Now listen. First, keep the heading. Step 1. Calculation of PVDs. Calculation of PVDs means present value of dividends. Present value of dividends. Let's see. Write down. PVD 1. PVD 1. What is the PVD 1 value? Rupees 7.5 divided by E power 30 days, 60 days, 90 days, 30 days into 0.12. Rupees 7.5 divided by, tell me, 30 by 360 means? E power 0.01. Huh? Why not? You take an assumption of 365 days, no problem. Just it makes more complicated numbers. Therefore, I have taken 360. In fact, RTP also taken 360 only to avoid that complication. You can write, because since nothing is said, na, sir, in some questions they will tell assume as 365. At that time you have to do, or else you can take an assumption. So e power 0.01 equal to 1.01005. 0.001, it will not come. Correct as 0.01005. You can believe me, write down. The E factors of goda పెట్టుకోకండి నాతో. అవసరమైనవన్నీ వదిలేసి. Write down. How much? Rupees 7.4. 5 or 3? 4 to 5. 4 to 5. 4 to 5. And a 3. PVD2, tell me, rupees 8.5 divided by E power 60 by 360 into E power 0.02. You can believe in my numbers. 8.5 divided by 1.0202 rupees 8.33. Next, PVD3 rupees 9 divided by E power 90 by 360 into 0.12. So E power 0.03. 9 divided by 1.0305 rupees 7.4. Previously, when I ask you one question, your answer has kilometer difference with me. At that time, did I shout like that? So previously, morning, one question I asked. Actually, it should be 40. Some person got 567. Did I shout at that time? 100 kilometers difference came. So write down here, 8.73. F equal to, now tell me, S minus PVD1 minus PVD2 minus PVD3 into E power TRF. S is how much? 1000 minus, what is the PVD one? 7.43 minus 8 point, minus 8 point into e power 90, 90 by 360 into 0.12. Tell this number. 1000 minus 7.43 minus 8.33 minus 8.74. 975 into e power 0.03. So 975.40 into 1.0305. 5 That's all. Answer over. This is a question that is being asked in the RTP. Sir, first, done with the problem, everyone? First one answer. Sir, before we started with futures, you have one idea about the futures. Now tell me, are you all comfortable with valuing the futures now? Entire chapter will be like this only. Valuation of futures will be base for everything. Advancements will come in the form of hedging and arbitrages in the next stage. Clear, everyone? We complete, there are 5 stages in futures totally. Okay, 5 stages. Stage number 1 will be basics. Stage 2 will be margin accounts and balances. Stage 3 will be valuation. Stage 4 will be arbitrages. Stage 5 will be hedging. We completed 3 stages now. We are still having 2 stages. Number 1 arbitrage. Number 2 will be hedging strategies. Shall we continue, everyone? So, in futures, we have completed up to 9th. 10, 11, 12, 13, 14, 15, 16. Homework anta. Homework antane. Homework anta. Ikkada 7. So, first, listen. Sir, jokes apart, please listen. Point is, whenever the futures transactions are concerned, we completed up to the fair futures pricing. Now we are going to deal with one big issue called as convenience yield. Shall I continue? Please, with your kind permission, bro. Okay na? Continue cheycha nenu. Please. Bro, a blue t-shirt, bro. Hey, నీకేనా చెప్పేది? Please listen. So, the point is, there are some important areas which are difficult to understand. First, let us close those issues now. The concepts are, sir, once you complete that concept, I am the guarantee how much time it has taken to calculate these. Same time we will also take to complete the remaining 10 problems. It takes hardly 35-40 minutes to do the answers on futures. After completing futures, you do whatever question you want in futures in whatever question bank you have. You will do the right answer. But before, understand certain important concepts inside. Point number 1. There are concepts called as cost to carry. First one, cost to carry, convenience yield, basis, contango, backwardation, convergence, and day basis calculations. These are the so many concepts that we need to learn. In this you might have heard already cost to carry. Clear? Okay, cost to carry. Next models are, have you heard about a concept called as futures convergence? It is futures convergence. Anyone? Anyone can give your opinion on futures convergence? Yes, sir. Very good. When? Very good, sir. Correct. 100% right. So, the convergence concept is there. After that, there is a concept called as a basis. What is the concept, sir? Basis. Anyone has the idea on basis? Basis points కాదు, అది ఇంట్రెస్ట్ లేదు అసలు, ఇక్కడ ఇంట్రెస్ట్ లేదు. ఏం జోకా? So, listen, not basis points, yeah, basis, futures basis. Oh, sorry, okay. Contango backwardation. Yes. Anyone? What is a contango? What is a backwardation market? So these are certain things which we need to have a knowledge on. So let us start with the concept. Bro, is it okay even though you miss some concepts now? 1 minute. Because I am intimating you well in advance. After that, for unnecessary purpose, you wasted time. So, listen here. So, listen carefully. Hey, listen here. So, the point. Rani wala. ఆయన ఎందుకు వెళ్ళాడు నీకు తెలుసా? So listen now. So the point is, whenever the futures market is concerned, some important concepts are there. Number one will be the cost to carry. Number two will be the convenience yield. Why convenience yield will come is a question. Before going into that, first let us understand the interpretation of the formulas you have already written. F equal to S into e power TRF. S into e power TRF. Next, with the dividend. With the dividend. Tell me, with the dividend? S minus PVD into e power T. Why you have done that? Yeah? After answer you have to get, okay. Other than that, why you have done that? One second. Anyone? Why you have done S minus PVD? Chorus la SPB also could not stand with you. How beautifully you give chorus. Individual singers I want. Tell me, why you calculate S minus PVD? Yes, sir. S minus PVD opportunity cost enti? Why? That's what I am asking. Why? Yes. In the future, dividend. Sir, okay. Listen. See here, sir. F equal to e power, sorry, F equal to S into e power TRF. F equal to S minus PVD into e power TRF. F equal to S into e power T into RF minus D. Or F equal to S plus CTC minus CY. నేనేం చేయలా. నథింగ్ ఐ రిపీటెడ్. దిస్ ఇస్ సీరియస్లీ. ఏమీ చెప్పలా. చెప్తే నీ గురించే చెప్పా. రిపీట్ చేయమంటే చేస్తా. So nothing great I discussed. So listen. So the point is, CTC and CY calculation is very important from the exam's point of view. Before that, listen. F equal to S into e power TRF. F equal to S minus PVD into e power TRF. F equal to S into e power T into RF minus D. F equal to S plus CTC minus CY. These are all the four formulae or not? Huge derivation is there behind. Let us go into the interpretation. You can only understand very easily why they are written like that. See here, I have, for example, a stock today. I have a share in my hand today. Okay. Now tell me, I want to sell this share in the future market. Yeah, not futures. In future, after 6 months, I want to sell this share. Sir, a person bought share today. I asked him, why you bought the share? He said, I want to sell in the future. I anticipate that the share price will go up in the near future by 20%. I will sell at the time. He is anticipating a bullish market in the future. Clear or not, everyone? So tell me, why I am buying the share? To sell in the future. To sell in the future at a higher rate. That is my anticipation. Then only I buy. Sir, no fool in the world will buy for a loss. Intentionally in future the price will fall, like that no one will buy. Anyone buying the share will buy only to have some profit in future or not. Sir, now listen carefully, sir. Not that easy, please listen. So, tell me, spot, I have to buy a share at 100 rupees. Am I clear? 100 rupees I have to buy a share. Anyway, we know that futures can't be transacted in singles. We have to buy in lots. 1000 shares made a lot. Share price is 100. Means how much I would have invested? 1 lakh. How much? So one contract value, you tell me. How much is a contract value? Listen. How much is a contract value? 1 lakh is a value of share, value of a contractor. Futures are traded in singles, a contractor. Therefore, contract value I am telling. So tell me, what is the value of a contract? 1 lakh is the value of a contract. S equal to 1 lakh. Say, I bought 1 share. 100 rupees I have to spend or not? My intention is to sell in the futures market. My intention is to sell in the future at more than 100. Say 120 rupees. Now, I gave you another chance. Enter into futures market today. Enter into futures market today to buy a share at 100 in future. At 100 in future. And sell at 120 on the same day to a person. Tell me, how much is the spot? Listening, how much is the spot price? Answer, 100. Futures also, a share is traded at 100. Okay, share is traded at same 100. Now tell me, when I buy in the spot, I have to spend 100 from my pocket or not? I have to give this 100 and buy a share, yes or no? Futures la, I will buy today na, in future. Answer, in future also it is trading at how much? Same 100. Now, in future, I will buy at 100. I will get the share. Immediately, I will sell at 120. Now, I am getting an eventual gain of 20 rupees or not? Then tell me, will there be spot market in this world? If that really happens, will there be spot market in this world? No, it will not be. Everyone will try to transact only in what market? Answer, futures market. Why? If you buy a share in the spot, you have to borrow money and you have to invest. Or your own money, if you invest, opportunity cost is there, yes or no? Now answer my question. You will borrow money. I have to purchase a share today. I spend 100 rupees or not? Answer. I am selling it today na, after 6 months. Or say after 1 year. I will sell this. Tell me, how much I spend? 100. I put in the market. I purchased a share. I will sell this share today na, after 1 year. After 1 year, my cost is not 100. My cost is share price plus financing cost. What cost? Everyone, what cost? Financing cost. Because of holding this 100 rupees share with me, I am blocking my fund worth 100 rupees or not. If I wouldn't have blocked this, I would have used it for some other purpose. Say for example, 10% return is there for me. How much, sir? 10%. So tell me, cost of this share will be 100. Actually, after 1 year, it will be cost will be 110 for me. Why 110? Tell me. Today I purchased at what price? Answer. Futures also it is traded at what price? Futures, 1 year futures I clicked at 100. Spot I clicked at 100. Futures also clicked there. Tell me, both the hands, both contracts are there with me. In one hand, I am holding a share or contract to buy a share. Cash market I bought. I will have a share, contract to buy a share. In one hand, I click the futures buy. Okay, futures buy and futures sell also at the same time. Okay, so tell me, in one hand I am having a asset. In one hand I have a contract to buy an asset. Clear everyone? Both are traded at the same 100 rupees. Now tell me, first case I have to buy today na, after 1 year. How much? This 100 rupees is blocked for how many years? That means I am losing interest on it or not? I should add to the cost or not? So 100 plus 10, how much is the cost of the share after 1 year? Answer, I entered into futures transaction now. I entered into future. I will buy anything today na, I will not buy. I just give a click. That's all. After 1 year, I will buy at how much? Answer, In both the cases, I sell at how much? 120 I will sell. Yes or no? At what price I will sell? 120 I will sell. Up to here, understood? So now tell me, my position after 1 year. Cash market la I purchase share it. Purchase share. My cost after 1 year became. Futures la I bought a share it. My cost become 100. In first case I sold it. Profit. In second case I sold it. My profit is. Which is more profitable? Now who will trade in cash? No, fool will trade. Fooler will trade. You understand the point or not? Will there be a trade in the future cash market if this is like this? Therefore, in order not to have the economy disproportionately, a concept was introduced called as futures should be traded in such a way that it should be spot with its financing cost, therefore F equal to S into E power TRF. Are you understanding the concept or not? F equal to S into E power TRF. That means today, listen, today S is how much? In our example, futures today will be 110 for future price. If you click futures today, you will buy today after 1 year. After 1 year price today, how much it is getting traded? Answer. Tell me. Cash market, futures market. Which is more beneficial now? Both are equal now. Why? Anyway, if you buy a share today at 100, it will become cost of how much? 110. Futures are anyway traded at how much? 110. Which is more beneficial now? Both are equal. That's called as S equal to F equal to S into E power TRF. It will equate both the markets. That's the idea behind calculations. Everyone understood the point of futures valuation? Everyone in the class? Moreover, tell me, future is a asset, future is a derivative instrument. Derivative instrument derives its value from underlying asset. Now tell me, spot 100 E power TRF is 1.035, say for example 1.0305. Listening, F equal to S into E power TRF. Okay, 100 is the S. 100 is the S. E power TRF is 1.0305. So what is F? 103.05. Yes or no? Spot is a 50. 50 into 1.0305. Some amount will come. Yes or no? It is at 10 rupees. How much it will become? S equal to 10. 10 point? Some 30 something will come. Yes or no? 1 rupee. Yes. 0. That's why future is a derivative. It don't have its own value. It derives from spot. Spot is an underlying asset. Spot is a share. Everyone understood the point clearly? So therefore futures are which markets? Derivative market. It don't have its own value. It derives its value from spot. Yes. Sir, S is a futures derivative instrument. Actual asset. Answer. Therefore from that underlying asset, F value will be derived. That's why futures are called as derivatives. Hope you understood the logic clearly. This clarity, if you miss 100 problems you do also, you don't get a proper clarity as to what you are doing. Sir, okay, now answer. A person holding share will get a dividend on the share, yes or no? A person holding the futures will get a dividend, will not get a dividend. So because of holding a share, I would have got a income. Because of holding the futures, I will lose that dividend or not? Again, I am asking, tell me. If I hold a share, I would get the dividend or not? But if I hold a future, I will get a dividend, I will not get a dividend. That means it is an advantage of a dividend, advantage of futures, disadvantage of futures. Disadvantage you call negative or positive. That's why S minus PVD. What you don't get on futures, you should not consider into that. Therefore, you have to deduct it. Clear or not, everyone? While deducting, you are deducting from spot. Therefore, you have to bring the dividend also to the spot terms. Therefore, you will calculate what? Present value of dividends. Understood or not? Next. Dividend is given in which terms? Rupee terms over. Dividend is given in which term? Yield terms. Yield is given in rupees or percentage terms. Now everyone answer to my question clearly. Point number 1. Tell me. Whenever F equal to S into E power T into RF minus D. Tell me, what is RF here? Risk free. Okay. What is RF generally considered? Finance cost. What cost? I got dividend of 4%. RF is 8%. Means the net cost is how much? That's why you are considering net financing cost. Are you understanding or not, everyone? What is my financing cost? Actually, what is my financing cost? 8%. How much yield percentage I am receiving? Now, really I am paying 8, I am receiving 4. Net how much is my benefit? That's why we are considering RF minus D. Net financing cost I will consider. Clear or not, everyone? You are paying how much interest? Sir, I borrowed money and purchased a share here with 8% interest rate. How much I have to pay? 4% is coming in the form of dividend on the share. Means how much I am receiving. That means net how much you are bearing. That's why you are taking RF minus D. Understanding the point or not, everyone? That's how all these formula have been derived. First, everyone tell me, understood the point clearly or not? Okay, so with this we have completed the understanding the futures of formulae, how all these formulae have come. Okay, next we are going into another area called as futures convergence, futures convenience yield, futures basis, futures contango, futures backwardation. Unless and until you understand those, it is nonsense doing question number 10, 11, 12, 13, 14, 15, 16. All are past examination questions. All, every question is a past exam question. So, shall I continue or in tomorrow's session? First tell me. Answer. Something you tell on that basis I will prepare myself. Listen. So listen. Morning I will do that. Anyway, I have to continue this. I will continue this. Listen. First, listen, sir, listen. Point is, whenever this particular calculation of futures happen, CTC model also long discussion is there. I will crisply convert it into 10 minutes discussion. I will complete off. Problem solving, I told you 40 minutes. Hardly it will take to solve all the 11 questions after this. Okay, we will do. So first, listen carefully. Point number 1. What is this CTC CY concepts? Let us understand. So convenience, dividend will be there in case of stocks. Commodities will have dividends. But gold, all these things are also subjected to futures or not. Gold will have gold dividend. Wheat will have wheat dividend. Wheat, iron, scrap, all these things are traded on futures today or not. Oil and oil commodities are also getting traded. Okay. So many products are getting traded on the futures. Clear or not, everyone? So therefore, futures is subjected to so many things today. So it is bigger than life market. So what you think that these are traded, you can't even imagine. Those are also getting traded on futures. Guntur is very popular because tobacco is traded on futures. Tobacco is getting traded on futures today. So from this place also people are trading. Very popular. So every product is subjected to a commodity trading today. How delivery all these happens? Practical situations we can see. From exams point of view, let us look into this. Listen. If I purchase a stock, my only cost will be the finance cost. But if I purchase a commodity like wheat, etc., I have storage cost, okay, inventory carrying cost, I have insurance cost, I have finance cost, I have care costs. Care cost, one exam question also given. Sir, for example, mice, insects should not come. For that also I should spend thousands of rupees or not? Mice, insects, etc. They should not eat away the product. Those are not storage costs. Those are not inventory carrying costs. Those are what? They are called as a care costs. So all these costs will be incurred. These all will be incurred in case of commodities. in case of stocks. Stocks, we don't spend anything. Stock, you only one cost. What is that one cost? What is that one cost? Finance cost. Okay. So, in case of stocks, there is only finance cost. But in case of commodity, there are so many costs incurred on that. Yes or no? These costs are incurred if I am holding. Okay, I repeat. These costs are incurred if I am holding real commodity futures. Sorry. So listen. These costs are incurred if there is a real trade, if there is a real commodity, if there is a futures contract to sell or buy commodity. Answer. If I don't have a real commodity, just I am entering into futures market contract to sell or buy commodity, do I incur all these costs? Answer. First tell me one point. These costs are incurred if I buy commodity in spot, buy commodity in futures. Sir, I entered into 6 months contract to buy 1000 wheat bags. I will not buy today. I will spend entire money only in future. Now tell me, I will incur storage cost, inventory carrying for 6 months, I will incur. So all these costs are there if I buy commodity at spot in futures. Spot or futures. So if I buy in spot, then only all these costs are incurred. If I buy in futures, I will not incur all these costs. Am I clear? Yes or no, everyone? Therefore, I will incur all these costs if I purchase in the spot. That means cost to carry means these all the costs. These all costs are incurred if I am buying in spot, buying in futures. I can escape all these costs if I buy the commodity in future. That means futures will escape all these costs or not. That is advantage of futures or disadvantage of futures. Therefore, while valuing the futures, yes plus CTC, add the advantage of futures. Did you understand what I said? Yes plus CTC. Sir, yes plus CTC is okay, sir. Minus CY, what is it? A question will arise or not? It is like dividend. It is like dividend. Commodities, why they will pay dividend? Can anyone explain this? Why commodities will pay dividend? It's not a dividend, it's a convenience yield. A question will arise or not? So I also got the same question, but institute didn't answer anywhere in the book. So, I will answer here. Then why I will ask that question unnecessarily? To make a hit wicket? I also don't know. I am telling that institute didn't make any proper promising attempt to tell what is this convenience. They said convenience yield will be there. When they borrow content from other books, they should also borrow the contents. They should borrow reasoning as well. So they should not leave over to the student to read the remaining parts. Listen, after that, I also started searching for that, reading so many books. But CFA modules contain okay type of analysis on convenience yield. They also made a proper analysis, but not so promising. Later, one person called as a book was found. The book name is called as a Drury's Derivatives. DRUDY. DRURY. Drury. There are two persons called as a Drury and Hull. Those people write a book on derivatives. So those called as a Drury and Hull derivatives. These people only found out binomial risk neutral to make our life miserable. So these people only have found out that Drury and Hull. So those people are the makers of binomial and risk neutralization model. Okay. Sorry. Main point is I started reading that pages and pages. After reading, then I came to understand what he want to convey and what is this convenience yield. Dividends paying on a stock is a common thing, nothing great, nothing what is the surprising. But how convenience yield can come on the commodities is a question. See here, I will give you one diagrammatic presentation to make you understand this. See here, everyone. Okay. See here, I am having a futures contract. Participate and answer. I am having a futures contract. Today, 3 months, 6 months. Today, I entered into a contract to sell 1000 wheat bags at the rate of 1000 each. I am very bad at tracking commodity prices. Example I have written. Okay, don't question me on the prices now. So 1000, I thought 1000 each, 1000 wheat bags. First one, everyone understood up to here? This is the situation. I am a wheat producer. I have a wheat field. Okay, I am a wheat producer. I have a wheat field. So to sell 1000 wheat bags at rupees 1000 each. So 0 here. I mean today. I entered into a contract. So what happened is 0 period to sell 1000 wheat bags. I entered into a sell contract. I mean futures sell. That means I will sell today na after 6 months. After 6 months. This is which date? Expiry date. Now listen. 3 months after, what happened? Let me explain. Suddenly, after me entering into the futures sell contract, I am a producer, means I have a wheat bags ready. I need not buy from anyone. I already have the wheat bags. Suddenly, there had a supply shock. Supply shock means suddenly stock market received information from the weather departments and other persons that there will not be a proper monsoon in the next 3 months. This period is called as a supply shock period. Okay, supply shock. Suddenly, supply of wheat is coming down. During the war between Russia and Ukraine, oil prices in India has raised by 78%. Have you observed that? A oil packet which is available at 180 rupees is available at around 320 rupees during that time. Basic tracking, sir. I am also bad at tracking prices. At least some things which are really impacting. Oil prices have raised like anything. Packet oil, groundnut oil, which is at 180 rupees previously, is traded at 312 rupees exactly. These are the prices. 180 packet traded at 312. Imagine. 78% increase is there. Now tell me, if a person who bought 1 lakh oil packets and kept in stock would have celebrated. A person had 1 lakh packets of oil futures. He will cry. Are you understanding or not? So tell me, how many wheat bags I am deciding to sell? Answer. Now some person will stand and ask me a doubt, if at all you are listening properly. Sir, delivery not there in futures. Commodities has derivatives. Commodities has delivery. Except gold and other precious items. Gold don't have delivery. Then gold will be delivered through? Gold futures are there, everyone answer. Then traded through what? Gold prices. Yaradi? Gold. Sir, there will be it will be traded through gold fund units. What it is? Gold fund units. How it will be also, I have one problem. Institute question. Then I will show you. Sorry. Okay. Now see here. Tell me. I am holding how many wheat bags? I have lakhs of wheat bags. I decided to sell in futures market how many wheat bags? Everyone in the class? 1000 wheat bags. Now tell me. There is a abundant supply shock. Sudden supply shock happened. Prices of wheat has increased to 2500 per bag. Okay. Wheat prices went to 2500 per bag. Now, what I have done is, instead of selling here, I thought that anyway after 3 months, Monsoon will be coming. Delay is by how many months? 3 months. Delay is by how many months? 3 months. Supply shock is there for all the 6 months. Only 3 months. 3 months supply shock is there. So in these 3 months time, let me sell all these 1000 wheat bags at 2500 each. So 1000 wheat bags into 2500 will make how much totally? Everyone in the class, tell me how much it will be. 25 lakh. If I would have sold here, I would have got an amount of how much? 10 lakh. But I could sell because of having the commodity with me. The supply shock is giving me a amount of how much? 25 lakhs. Technically, I am getting a profit of 15 lakhs or not. That 15 lakhs we call as a convenience yield. Convenience yield will come if I have the stock, if I have the futures contract. Common sense, sir. If you have a stock, if you have futures contract to buy the stock. If you have the stock only, you can sell during this supply shock period. Sir, I entered into futures contract to 2. Futures contract to 2. Buy and sell wheat bags. You have really bought wheat bags and you entered. Yeah. You are not entering into futures buy. Listening, you already have wheat bags with you. Now compare you and me. You are having how many wheat bags? I am having how many wheat bags? 0. Nothing is there. You will sell when? After 6 months. I will sell when? After 6 months. How you will buy? You bought today itself. When I will buy? After 6 months I will buy and immediately I will sell. Tell me, I have wheat bags during supply shock period or no wheat bags? Can I enjoy this profit of 15 lakh? Can you enjoy? That means you are holding the commodity. I am not holding the commodity. Because of not holding the commodity, but because of holding a futures contract, I am losing the convenience yield or not? Losing convenience yield is an advantage of holding futures or disadvantage? Disadvantage should be deducted or added. Therefore, minus CY. That's how the formula has been derived. Understood or not, everyone? So that's why S plus CTC minus CY. That's how the formula has been derived. So everyone, first tell me, are you convinced with all the formula? No, everyone. Answer. About remaining points of this particular issue, we'll discuss in the next session. Tomorrow's session, first we'll start with the futures. Once it is completed, we'll go into the options as well. I will give the questions also for the options markets. Okay. Once the futures completed, next we'll go into the options. Nine. Sir, everyone first tell me, understood all the concepts clearly for the today's session or not? Thank you very much. Tomorrow we'll meet again.